Before we start this video, do like and subscribe to our channel and not miss on any updates.
Welcome to the revision session of the derivative analysis and valuation chapter. This is purely a revision session. I will be definitely covering a lot of concepts, but I will not go too deep into them. The focus will be on understanding concepts from an examination perspective, and we will be solving roughly 15-20 questions, which are very important, which I think there's a very high chance that these may come in your exam. And I will also be explaining certain key questions with very specific adjustments. There are some very specific adjustments or specific variations in some questions what Institute has been asking for the last few years. So that is how we will approach this particular revision session. You would have seen my several other revision sessions of Forex and several other chapters that we have recently come out with. Now this is in addition to those ones, right? So this revision session we will be focusing on both the practical as well as theoretical aspects. But before we start off, I want to highlight for you things, the approach. First is, of course, we will be talking about what are forwards and futures, very basic stuff. I will not go too deep into them, and we will also go into options. Okay, we will split this into three parts actually. This whole thing about this particular chapter, forwards and futures, we will look at theory plus practical. First part is this. This is part 1. Then this is part 2, where we will look at theory plus practical. Okay. This is part 2. Then there is a third part, which is a lot of new theory. This is very important in my opinion. This new theory is come up from May 24 attempt onwards, once the new syllabus was introduced. And this new theory, has some very interesting topics and very unique and very complicated, I won't say complicated, very confusing topics, or very confusing concepts where they have just given the concepts without any problems also. So what are these new topics? You have something called as exotic derivatives. The name itself sounds exotic. Let us see. Credit derivatives. They have given good explanation on credit derivatives. They can taken it from old syllabus CA final elective paper FSCM. From there they have taken some elements. Then you have something called real options. In this they have given questions also, and they have introduced this concept of how do you compute the using in the Black-Scholes formula, and in this they have also given the Black-Scholes formula with dividend option, right? If there is typically the Black-Scholes formula does not have dividend accruing. If there is a dividend, then what do you do? That is also given. Then you have weather and electricity derivatives, and you also have learnings from derivative mishaps. So these are the new concepts that they have introduced. They have not introduced 2008 crash, which according to me is a very big miss from the CA Institute side. They ideally should have even introduced that as a topic. But this is the third aspect that we will be covering. As I said, first is forwards and futures. Not too many problems. Understanding certain concepts, probably will solve a few problems there. Then we'll come to options, where we will again focus on very specific aspects of this particular chapter, where the institute has been asking some very unique, tricky, and what can I say, questions that are designed to confuse the students. And then of course we will look at this theory. Okay, so this is how we will be approaching this chapter. So first let us go to the theory and practical aspects of forwards and futures. And before we go even further, I want to highlight one more thing. There are three things that you should have. One is called P600 plus, other one is called T380 plus, and then there is a formula sheet. All these three items, okay, are given free of cost by us, soft copy form only, on our website. Okay, you can go to the website, go to free resources, go to the notes and look at it, or you can actually look at the description of this video. And there you will see the links for these three particular items. What are these? P600 plus is a compiler of practical questions, all the questions of CA final, past exams, study material, then MTP, RTP, practice manual, everything has been solved. Why is it called 600 plus? Because there are 600 plus questions and updated, latest update. This has, as of now, it has updated for the immediately previous exam. Then you have 380 plus, which is all theory questions. 380 plus theory questions. Then we have a formula sheet which basically lists down all the formulae. And as we are preparing, I suggest that you make your own notes or short notes or keep things aside rather than listening to this as some kind of podcast or listening to this as some kind of or watching this as some kind of a Netflix or Amazon Prime video. Okay, this is not OTT, this is your CA final preparation. So I would request you to please give that much amount of serious thought to this. Okay, so this is another thing that you guys should remember. If you don't have it access to this, please go and click the link on the YouTube description below and you will get the access to this. Okay, fair enough. Having said that, now let us jump right away into the first aspect, which is forwards and futures. We will look at both theory and practical aspects. I will first take you through theory and there I will explain to you certain practical concepts and we will dive into them, integrate both theory and practical concepts as well. Okay, let us move forward. So friends, first, when we before we get into the futures and forwards, you have to understand what is a derivative. What is a derivative? If anybody asks you what is a derivative, the simplest answer is you should say it is actually a contract. It is a contract where you agree to do something at a future date. Okay, now what you do, how you do, who does what, all those are secondary. It is a contract. Think of it as a piece of paper. Okay, it is a product whose value is derived from the value of one or more basic variables called underlying asset. So it is a contract where the contract derives its value from an underlying asset. You can think of an asset as gold, as a stocks or bonds or anything like that. Right? It's a contract which derives its value from the value of an underlying asset. The underlying assets can be equity, forex or any commodity. They will have marketable value and usually subject to risks. A derivative is a financial security with a value that is derived from an underlying asset. Generally, it is a contract between two parties, so on and so forth. Exactly what I was telling. Okay, let us move forward. I will not be going deep into everything. We will, because this is a revision session, we will cover things fast. Now, let us look at forward contract. What is a forward contract? A forward contract is an agreement wherein it is an agreement between a buyer and seller wherein the buyer agrees to buy something definitely on a future date at a predetermined price for a predetermined quantity. So, I, Sriram, am agreeing to buy something from you, a student, on 1st Jan of 20x1 at 10,000 rupees per unit and 10 units I am going to buy. It is an agreement. Today I am on, probably September, but I am agreeing to buy something from you in upcoming Jan. I am entering this contract in advance. Now, I am in September, can I enter into a contract for month end of September? Of course. Can I enter into contract for October, November, anything? All of them are known as forward contracts. Can I enter into something which is 3 years, 5 years, 10 years? Yes, I can enter into. Technically, there is no issue. Okay. These kind of contracts are called forward contracts where I am agreeing to buy something from you at a predetermined rate, for a predetermined quantity on a predetermined date. So, date, quantity, and price of an item all are predetermined. This is what is a forward contract. Now, I am a buyer in this forward contract, you are a seller, because when I am agreeing to buy, you are also agreeing to sell. So, you are agreeing to sell, I am agreeing to buy. This is a very, very simple way to look at a forward contract. Okay. What is a futures contract? A futures contract is exactly like a forward contract, but a forward contract is entered into between two parties who may or may not know each other, but it is entered into them on an over-the-counter basis. What is the word? OTC. OTC means over-the-counter basis, meaning there is a table, you are on that side, I am on this side. Between two parties on a very, very specific, customized dates, customized terms, customized quantities. Why am I using the word customized? Because a futures contract is not a customized contract. It is a standardized contract. So, there is a standardized contract which is traded on an exchange. It is compulsorily traded on an exchange and it is entered into between two parties who are unknown to each other. So, I am buying on the exchange, you are selling on the exchange, somehow there is a matching happening and the buy and sell transaction is happening, right. So, it is a standardized contract to buy or sell something at a future date of certain item for a specified quantity at a specified price, but in standardized lots, okay. It is, and specifically it is done on an exchange. And forward contracts, typically what happens is, in forward contracts, there is settlement by way of delivery. Let's say I am agreeing to buy gold from you. You have to give me gold. This is what? This is a forward contract. In a futures contract, let us say I am agreeing to buy gold from you on stock exchange. The stock exchange will not enforce delivery. They will say, whatever is the price, do some cash settlement. What is this whole cash settlement business? Cash settlement is, what is this whole cash settlement business? Let us say I agree to buy 1 gram of gold, okay, at 7,500 on 11x1, 20x1. Today what is the date? 3920x0, okay. On this day, I am entering into contract to buy 1 gram of gold at 7,500 rupees. Now, on that day, I am agreeing to buy, you are agreeing to sell. When you are going to sell it to me, right, you may have the gold, may not have the gold, that's an independent thing. But on 11x1, if the price of gold is 8,000 rupees, you made a mistake by entering into a contract with me 3 months in advance to sell it to me at 7,500. So, you are a loser. Loser by how much? By 500 rupees. So, you are a loser by 500. And what am I? I am a gainer. Why am I gainer? Because even though the market price is 8,000, because of my foresight, I agree to buy something from you 3 months in advance itself at 7,500. So, I am the gainer. Whatever is your loss is my gain. Now, in this case, buyer is gainer. Can buyer be loser? Of course, buyer can be loser. Because if the price in the market on 11x1 is 7,000, I have agreed to buy it at 7,500. So, I am the dumb person. I have agreed to buy it from you at 7,500 when the market price on 11x1 is 7,500. But when did I agree? I agreed 3 months ago. Why did I agree? Because I thought prices may go up. That is why I agreed. And why did you agree? You thought probably price may come down. That's why you agreed to sell, right? So, both parties have opposing views. Now, in that case, the 500 loss is of the buyer. Here, 500 loss is of the seller, right? And gain is of the seller. And gain here is of the buyer, right? So, this kind of thing can happen. Now, when this kind of thing happens, where is the source cash settlement coming in? Cash settlement comes in wherein this 500 rupees is what is exchanged between the parties. Okay. If you are a loser, you give me 500 to the gainer, 500. Over, matter close. Okay. Issue is resolved. Instead of you actually giving me 1 gram of gold, I paying you 7,500, then I going and selling it in the market at either 7,000 or 8,000, me either making a gain or loss, wo sab chodo. Leave all that and directly do a transaction where you do this cash settlement of 500 rupees. Whoever is the loser gives it to the gainer. Okay, loser can be buyer or seller, doesn't matter. Okay, so this is what cash settlement. Futures are cash settled. Forward contracts, actual, genuine, original delivery happens. The gold has to exchange hands, the wheat has to exchange hands, shares have to exchange hands, currency has to exchange hands. But in a future contract, all that does not happen. Just generally the 500 rupees. Here it is 500, it can be any number. Settlement happens between two parties. Okay, so that is the broadly a futures contract and a forward contract. Forward contracts are physical delivery or rather delivery based. Futures contract are net settlement based on cash settlement, net cash settlement or cash settlement or net settlement, whatever you want to call it. You can do that. Okay, next. What are the differences between those two? Just now I explained. Forward contract agreement between two individual parties, they are traded on a futures exchange. There is credit risk in forward. Why is there a credit risk? It is over the table, over the counter, right? I am on that side, you are on this side. So, both of us, you may run away. How will I know? How can I enforce the contract? Or I may run away. How will you enforce the contract? But in case of an exchange-led transaction, have you ever heard of exchange going on defaults on exchange? No, because exchange will ensure they collect money from both you as well as me, keep that money as margin. What is this margin? It is a concept we will understand in some time. Okay, they will keep some deposit from both the parties just so that the loss or gain is covered and they will take the money from the loser, give it to the gainer. So, that whole deposit money, collateral margin, those we will come later. Okay, because of that there is no credit risk, virtually zero credit risk. Then contract is customized, I told you in forwards, it is standardized in future contracts. Then it is over the counter. Okay, in forwards it is traded on exchange in futures. Parties of contract need not pay any margin. In forwards, they need to pay margin. I just now explained in case of futures. Contracts will be settled on maturity date. So, contracts will be settled by exchange on daily basis. What does this daily basis mean? When we come to the margin discussion, I will explain to you. Because the prices can fluctuate every day, the deposit that you have, that you maintain with the exchange is varied every day based on certain rules. What are these certain rules? Based on VAR. The concept that you learned in chapter 1, 2, 3. There was some concept, no, risk management chapter 2, right? Where you learned that what is VAR, what is value at risk and all of that. Based on that, they decide how much margins have to be kept. And every day, depending on the volatility, the margins may change, may not change. And there are a variety of features and the loss is adjusted from the deposit. Okay. Then in forward, there are minimum transaction costs. In futures, there are more transaction costs. Why? Because there is an exchange margin, you have to put money, then there is a STT, then there is a bunch of other things that are involved in futures. Whereas forwards, just between two people. One stamp paper, you write, I write, 100 rupees over. Okay. Then usually delivery based is forwards, settlement based or net cash settlement or cash settlement is futures. Okay. Very, very simple. It's a good question. It is a potential question that can actually be asked. I have highlighted it as important also. Now, what is an option contract? We will come to options once we reach the options chapter. For now, we will keep these pending. For now, we will keep this pending. Now, what is the difference between cash market and derivative market? What do you mean by cash market? Please understand, forwards and futures both are derivatives. Cash means you are trying to buy something today. You are trying to make a transaction. You are giving money today, getting the product today. Okay, it may be today or T plus 2. There is a whole settlement concept called T plus 2. So if you do pay the money today, you will get money things after 2 days. So that is called as a spot transaction. Please don't say because it is coming after 2 days, it is a forward transaction. No, spot means up T plus 2 is spot. Anything beyond T plus 2 is a derivative, which is a future or forward or whatever it is. Okay. Now, spot transactions are called cash or delivery based transaction or cash markets, and derivatives are beyond, other than cash or derivatives. What are the difference? Cash market majorly deals with tangible assets which are purchased and received in exchange for cash. So immediately then you give cash, I give the product over. It can be share, it can be car, whatever. Derivative markets deal with intangible assets like stock indices. So cash market can be both tangible and intangible, but futures market, derivatives market can also be both tangible and intangible, but most volume is in intangible. Whereas cash market, more volume is in tangible. You think no, more rice gets traded on cash or more gold gets traded on cash or more tangible assets get traded on cash than intangible assets. Then the cash market, no specified lot size. I can buy one share, I can buy one car, I can buy one tire, anything. Whereas derivatives market, typically you have to buy, $100,000, $1 million, one share, 10 shares, anything like that. In a cash market, a person either consumes the asset or invests in the asset, whereas hedgers, speculators, arbitragers deal with the derivative markets. Now, who are these people? Hedger. Hedger means someone who has a risk and he is hedging the risk. Hedging means you have read in FR, financial instrument chapter, hedge, HEDGE. You must be aware of all of that. Hedge means you have a position, you are entering into a contract to counter that position so that the gains and losses of this are offset by the gains and losses of this. Okay, that person is called hedger. Then speculator. Speculator means I will take open challenge. Tomorrow Nifty will rise, so I will buy Nifty today. If Nifty tomorrow doesn't rise, you are loser because you have bought it. If Nifty falls tomorrow, then you have agreed to buy at 100, Nifty has come down to 90, you have lost 10 rupees. Right? A person who takes open positions is called speculator. And arbitrager means a person who buys and sells in different markets at same point of time to earn riskless profit. So think of this. Let us say you are in, I'll take an example of Mumbai. Let's say you are in Andheri. You are buying something in Andheri and selling it in Malad. Same time, probably half an hour gap. You are buying a chair in Andheri, selling it in Malad. Okay, you are selling in Andheri market, selling it in Malad market. Okay, and you are getting 100 rupees riskless profit. You have on the phone, you already entered into the contract with the person in Malad that I will sell you. So you will buy here, you will sell there. So basically, you are entering into a transaction at the same time, both buy and sell in different markets. Now the markets I told you, Andheri and Malad as example. But this can be cash and futures also. This can be BSE cash, BSE cash and NSE cash also. It can be across different, different kinds of markets or across different geographical locations also. Okay. And you earn riskless profit. Why is it riskless? Because you do both the transactions same time. You agree to buy and sell almost instantaneously so that there is no loss. So it is a riskless profit. In cash market, no margin. You are buying, you are giving full money. Whereas in derivatives, typically in futures and all, you have to pay some margin. We will discuss that. Ownership will be transferred immediately in cash, no ownership transfer. Till when? Till the contract is executed. One is executed, the date of maturity. Whatever you write on that piece of paper, I told you, till that date. Then upfront cash commitment, only margin. So even if you are buying a car, you have to upfront give cash. Even if you are taking a loan, the lender, even if you are taking a loan from a bank, the banker is paying full cash to the car company, So cash is going out. Whereas in case of futures market, you need not pay full cash. You can pay only margin. I told you, you deposit some money as collateral. Only that needs to be paid. Okay. So this is cash market, derivative market. This is also an important question. What are various types of derivative users? I just explained to you. Dealers, that is institutional investors, for hedging position, taking, exploiting inefficiency and earning dealer spread. So dealers are people who buy and sell. So if you go to a bank and ask for currency, you want to buy currency, so the bank is selling. Same way, you go to the bank and sell currency, the bank is buying currency. Now, bank does buying transaction with you, selling transaction with somebody else, and they are not doing this for Arbitrage, please don't confuse this with arbitrage. Arbitrage is you find an inefficiency in the market and you, in order to exploit that inefficiency, you are buying and selling. You are in dealer is not going to the market and selling. Somebody is coming to the market where dealer is there and they are asking for either buying or selling. That is a critical difference. So dealers buy and sell from different people for a small spread that is called bid-ask spread, the rate at which they buy, the rate at which they sell. Do not confuse this with arbitrage. Arbitrage is single person do on their own going to different markets, searching for opportunities and then buying or selling at the same time. Whereas dealer, he is not searching for opportunities, people come to him or her and then they ask for buy or sell and he quotes a bid-ask. Then hedgers, usually corporate. So let's say you're Infosys, you're going to get a lot of foreign currency next month. Today rupee is 85. Next month will rupee be 85? It may be 83, it may be 84, it may be 87, nobody knows. So what you will do? You will say, I will whatever foreign currency I am going to get next month, I am going to sell it in the market next month. I am entering into a contract today at 85.5 itself, I will sell on next month. So a corporate is hedging its position of exposure that it has. Now I have given an example of a exporter. You may have importer. Reliance is importing oil. For that they have to make payment. When they make payment, rupee may be 84, 85, 86. They are saying, today itself I am deciding, whenever I am making payment, I will make it at 85. So it is crystallized. The exposure is crystallized. So hedgers, usually corporates, are people who hedge their exposure. Then you have speculators. This individual investors, institutional investors, I am just open speculating. Tomorrow morning Nifty will go up, currency will go up, gold will go up or come down. You take positions opposite to that. Then you have arbitrages. I fully explained to you what's an arbitrage. They can be both institutional as well as individual investors. Then, now let us come and understand, how do you price a forward and future contract. Before we price, there are two words that you have to understand. Three words actually. One is called basis. Second one is called contango. Then there is something called as backwardation. It is here. Backwardation. There are these three terms. Basis, contango and backwardation. This can be probably a MCQ question. Okay, and these are all twisted things, or not twisted, I will say these are all important small snippets that you can be asked for 1 mark, 2 marks. Okay, so if you look at futures price, okay, today let us say, and I will take my favorite example, HDFC Bank. Today you are on 11x1. Let us say there is a price for 3112x1. Okay, 1 full year. In this, on today, currently HDFC share price is quoting at, I am taking round numbers purposely and not actual numbers because 1000, okay, 1000 rupees is the share price of HDFC Bank on 1st Jan 1 year. You believe that the price will go up or go down, you have a view. But in the stock exchange, already lot more people have a view. So there are people buying and selling and all of that, and the future contract is, let us say, trading at 1100. So for what date? For 31st December. If anybody wants to buy HDFC on 31st December, I am willing to enter into a contract to buy or sell from you at 1100. Alright. You may think that it may be 1200, but in the market, the rate that is quoted, the buyers are quoting, sellers are quoting something around 1100. Buyer will quote 1099, seller will quote 1101. Okay. Always there will be a gap between buy and sell. Eventually they both merge at one point at which transaction happens. But you may think it should be 1200, 1300, 1400. Market mate is available at 1100. That is what is available. HDFC share today is only 1000. But agreement to buy HDFC share after 1 year is at 1100. You think it will be 1200. Okay. Now what is happening in this? The future price, this is future, 1 year future, and this is spot. And in between, let us take, again there is one more future contract on 30th June X1. This is at 1050. So this, the market price is going up. The market price is going up. The market price, you typically, for most of the assets, the prices go up. Okay. Now when we understand how the pricing happens, you will appreciate this concept. Typically, most of the assets prices goes up only. Why? Why? We will understand. But for now, please take this logic that they go up. When the market is in this position, this is called contango. This is generally how market is. This is generally how market is. This is general, normal. Okay. Then, if today HDFC is at 1000, okay, people expect it to fall to 900. Then, market is in something called as backwardation. Backwardation means future price is less than spot price. How can it happen? It can happen. Did the prices of some commodities not fall? Don't you think gold price may fall? It may fall. Don't you think Sensex may fall? Sensex may fall. Nifty may fall? Nifty may fall. So somebody thinks it is going down. A lot of people in the market think it is going to fall down, which is why it is trading at 900. So when futures price is less than spot price, the market is said to be in backwardation, and futures price is greater than spot price, the market is said to be in contango. Please don't confuse the spelling as conganto, contango and all that. Contango. Okay. T-A-N-G-O, tango, con. Okay. Now, what is basis? If once you have understood this, basis is the difference between spot and futures price. So, in our case, what is basis here? Spot is 1000, future is 1100. Difference between spot and future. What is the difference? Spot minus future. Please note. So, what is basis? Basis is minus 100. So, what is basis? Basis is negative. So, in normal markets, basis is negative. In backwardation, what is basis? Spot 1000 minus future 900, basis is positive 100. So, basis is positive in backwardation and basis is negative in normal markets which are contango. Okay. So, basis, when we say basis, we are referring to the difference between spot and future. Again, this could also be a potential question, which is why I am explaining this in some time, taking some 5 minutes time to explain. Okay. This is what is the basis, what is contango, what is backwardation. Sometimes spot is higher than futures. Okay, I have explained this. What is cost of carry? Now, after having understood this, future and spot. Let's say spot is 900 and generally forward is higher than spot, which is 1000. Okay. I told you basis is negative, contango, general market and all of that. Basis is difference between those two. But how is the difference arrived at? Or what is the logic? What is the logic for this 900 to go to 1000? Please remember, in almost everything in finance, the first thing that you should have read or you already know, time value of money. 100 rupees today is 110 rupees tomorrow. 110 rupees tomorrow is 150 rupees day after tomorrow. Okay, I am just giving example. It is not 110, 150. It is interest. There is always an interest component. So, asset prices constantly increase because instead of buying this at 1000 rupees today, you can place this in FD and get extra 50 rupees after 1 year, 5% interest. If you do that, you are going to gain 50. So, this future contract, you are agreeing to buy something. Assume that the whole market is normal, everything is sub, everybody is okay. Markets are generally behaving rationally, it's a perfect market and all of that. Then, unless HDFC Bank goes to 1050, there is no logic for you to hold HDFC Bank share today at 1000. Correct? So, always future is equal to spot plus cost of carry. Cost of carry is basically the interest cost. It also has other elements. We will understand that when we reach there. But please think of this, anything, forward price, future price, everything has a time value of money component. Everything has a time value of money component, which is basically largely interest cost. Okay. So, this is what is how the price is. Futures price is spot plus cost of carry. Okay. Then, what is convergence of spot and future? On the date of settlement, here I said 31st, what is the date that I gave? Here I gave a date, 31st December 2000 X1. On that date, if the futures price is remaining there, same 1100, spot should catch up. See, you cannot have something in the market, you cannot have 100 rupees today, if you put it in FD, it becomes 105 after 1 year. Okay, is it possible that 105 is worth 104 just 1 day before, or is it worth only 102 1 day before? 1 day before when? 1 day before the maturity date. See, let's take 1 year FD. On day 1 it is 100. On day 365 it is 105, 5% interest. What is the value just 1 day before? It will be 104.95 or something like that. Correct? 1 day before the maturity. So, as the days pass, the spot price catches up to the futures price. Okay. In case of a FD, the value of the FD is moving closer to the price that we have agreed. Same way, the spot and futures price also will converge. So either the futures price will come down or the spot will reach the futures contract value. Okay. So either this 1000 will become 1100 or the futures contract, if the spot is not moving, if the SDFC share price is not at all moving, it is same at 1000. How can it move to 1100 rupees next day? If I know on 1st Jan that spot is 1000, I agreed for 1100 on 31/12. On 29/12, will anybody enter into a futures contract for same 1100 with you? I will agree to buy and sell. Array, market is at 1000. On 29/12 also it is at 1000. In 2 days, do you think it will jump 1100? No. They will say, I will not, market is at 1000. It may move up plus or minus 1%, 2%. I will enter into a contract probably for 1010. So what has happened? From 1000, the futures contract, which was at 1100, has fallen to 1000 and coming closer to the spot. Why? Either the spot has to move up to future or future has to move to the spot level, closer to the spot. So both the prices converge. Why does this happen? Because you cannot have a case where you are agreeing to buy or sell at 1100 and the market is at 1000 and in 1 day do you think it will jump 100 rupees? No, it may not happen. It may jump by 5 rupees, 10 rupees, 15 rupees. Right. So that is the reason why both spot and futures converge. Either spot will move up. If spot does not move up, futures will come down. Okay. Now, I said move up, that is in case of a contango. If it is in backwardation, other way it will happen. Spot will fall to the futures price or futures will rise to the spot price. Okay. This is what is convergence of your spot and futures price. Then, now let us understand what are these initial and maintenance margin, what is this whole MTM business. After having understood this, we will go and solve some problems. We have understood enough of the concepts now. Once we understand this concept, understand this MTM wala concept, we will go and solve problems and then again we will come back to some amount of theory before we move to options chapter, or rather options section of this particular chapter. Okay. So now let us go and understand what is this whole MTM business and then I will explain MTM theory only when we are looking at that particular problem. Okay. Fair enough? Chalo. All future contracts are marked to market every day. That is, all gains and losses and daily closing values are computed and settled between gaining and losing parties. All players in derivative markets, all players are required to deposit a certain margin with the exchange in order to trade. The margin is used to fund the losses. There are two types of margin, initial margin and maintenance margin. There is a problem that we have on this. Before we get into the problem, let me actually, briefly explain. Then when we solve the problem, obviously you'll understand it much better. So what is it that we are saying? So let's say there's a buyer of forward. Then there's a seller. Correct? There are two people. This guy agrees to buy wheat 100 kilo at 50 rupees per kilo after 3 months. Forget the date, what is today's date and all that is irrelevant. So 50 into 100, 5,000. Correct? This person agrees to sell 100 kg for 5,000 bucks. Right? Now, both the parties have agreed on what they are going to do. Okay? This fellow is going to buy, this fellow is going to sell. Now, on the due date, one of them can run away. Let's say this 5,000, instead of, on the due date, you're agreeing to buy it at 5,000, but in the market on that day, let's say the wheat is selling for this, 50 kg, for this 100 kg, what is supposed to be 5,000, let's say that it is 6,000. On the 6,000, so the seller will say, I don't know who you are, I've entered the contract. Is it? Did I enter? Where did I enter? Oh, there's a paper. Oh, please go and file a case in the court. Okay. So this is what happens. This is what can potentially happen in a forward contract. Why? Because it is between two parties. Whereas in a futures contract, that cannot happen. Why? Because there is one big brother called as exchange. Exchange in between. So both the parties deal through the exchange. Now what happens when you deal through the exchange? Exchange on day one. Okay. The day one when you entered into a contract for 5,000 rupees. Now let us say on that day, we will call this as forward price or futures price and spot. Let's say that day spot is same 5,000 bucks. When I say spot is 5,000, it means the rate is 50 per kg, it is 100 kg, 50 to 100 is 5,000. Okay, I am saying the spot is 50 rupees per kg. On day one, exchange will say, dear buyer, deposit 10% of this, which is 500. Dear seller, deposit 10% of this, which is 500. Why are they asking both people to deposit money? Because you don't know which way the market will move. Whether the rate will go up, whether the rate will go down. So what? The so what is important because it can move on either side. So there may be profit, there may be loss. So if it goes up, one party is at a profit, and if it goes down, the same party is at a loss. So what happens? Both of them deposit 500. Now on day 2, let's say the price becomes 5,500. 5,500. So the buyer, right, is already how much in profit? You have agreed to buy at 5,000 after 3 months. On day 1 itself, it has become 5,500. Okay, so you're already at a profit of 500 rupees. Seller is at what? Seller is a loss of 500 rupees. Okay, so the buyer is profit of 500, seller is loss of 500. Now what happens in this? What the exchange does is, from the seller, they will take away whatever he has deposited, this 500 they will take away and give it to the buyer. They will give this money to the buyer. Okay, and they will say, dear seller, you have agreed to sell after 3 months. Now on day 1, we are adjusting for losses. But you know what can happen? This market can go not only from 5,500, can go up to 6,000 also. So I want you to maintain more margin. How will they say? They will say, again, please maintain 10%. 10% of what? 10% of 5,500. So seller will have to bring in 550 more. Whereas what happens to the buyer? Buyer also has to maintain 10%. But 10% of 5,500 is again 550. But he initially put 500. Then this loss of the seller, which is the profit of the buyer, has become another 500. So total he has 1,000. But he has to maintain only 550. So you subtract minus 550. So the buyer is the seller. Seller gets seller puts fresh margin. Buyer already 500 that he has put, plus new 500 that has come from the seller, total 1,000, minus the margin that the buyer is now supposed to maintain. Again, why margin? Arey boss, today it is 5,500, tomorrow it may be again 4,500. You may say I will discount the quarter. So you also have to maintain margin. How much margin? 10% of today's contract value, which is 5,500. So you have to maintain 550. So 1,000 you are maintaining, 550 is what you are supposed to maintain. So 450 is the profit. This you can take away. Now this initial margin what you maintain is called, initially what you deposit is called initial margin. Every time you have to maintain certain percentage, based on daily movements. So let's say next day, the movement is only 1%. Movement is 1% means what happens? So 5,500 by 1%, 5,550. Okay, now they say maintenance margin is 8%. 8% of 5,550 is how much? Is 444. Okay, 444. So this is moved up by 50. So the seller has lost another 50. Seller maintained how much? Maintained 5,550. Why 550? Because initially his 500 is lost, but he is now required to deposit fresh 550. Out of that 550, what is the loss? Loss is 50. How did I get 50? This 5,500 minus 5,550. So minus 50. I am now at 500. But how much I am supposed to always maintain? 444. So out of that 444 is there. Yes, I am higher than. This is higher than 444. So I need not bring any fresh money. Suppose this instead of 5,550 it becomes 5,800. Then you are supposed to require to bring in. Why are you supposed to bring in? Because you have incurred a loss. That loss will get adjusted here. Net amount will come down. Margin that you have, and your minimum margin requirement will be something else. So you will be required to bring in fresh margin. When it falls below maintenance margin, you will be required to recoup till initial margin level. As long as it is above maintenance margin, you have to maintain the maintenance margin level. This is required both for the buyer as well as the seller. How is this margin amount determined? Based on VAR concept. Okay, this is broadly what it is. Let us have a look at a problem so that you understand it better. And this problem also, I will need not necessarily solve it because you have this P600 plus. There you can go open it, have a look at it, and I will explain to you how each of the step functions, or rather how things function in this particular. Okay, this is one problem because there is way too much computation. I would rather explain to you the logic than sit here and type my calculator and do it, because this is a revision class. So friends, now after having looked at the theoretical, or rather the text-based information on what is MTM, let us actually look at a question which will help us understand this concept much better. Okay, this is question number 27 from my P600 compiler. This is an easier way to understand, and rather than me explaining the concept over pen and paper taking artificial numbers, we will take some real numbers in the problem itself that are given and we will solve it. Okay. The price of Nifty futures contract on a particular day was 9170. So the futures contract is 9170. Minimum trading lot of Nifty is 50 futures. What do you mean by minimum trading lot? A minimum trading lot means, we discussed forward and future contract. A futures contract is one where there is standardization, where There is a minimum quantity that you have to buy and sell. You can't randomly say, I will buy 1 share, I will buy, 100 shares, I will buy 50 shares. You have to buy in lots of 50. You have to buy 50 shares, 100 shares, 150 shares, like that. So, minimum lot size. Minimum to lot means basically how much you have to minimum buy number of Nifty future contracts. Initial margin is 8 and maintenance margin is 6. What is this initial margin? What is maintenance margin? I will explain. As we move along, I will explain. The index closed at following levels on next 5 days. What do they mean by here? Here, the same futures contract, you agree to buy something after a March future at 9170. Let us assume you are in Jan or February. It doesn't matter because this is a simple question. Okay, you are in 1 month before March and you have entered into a contract for buying March and future at 9170. You are buying March and future at 9170. You entered into a contract today. For the same contract, that is March and future, which is you are on Jan 1st. On today, March and future is at 9170. On Jan 2nd, March and future is at 9380. On Jan 3rd, it is at this rate. Jan 4th, this rate, Jan 5th, Jan 6th. So the same contract, okay, you are agreeing to buy something on March end or the last day of March, whatever is said, last trading day of futures for March. Same contract, following are the prices. That is what they mean. Please don't get confused. This is not the spot price of the Nifty. This is not the spot price of the Nifty. This is the futures price of Nifty on day 1, on day 2, on day 3. Futures price, what futures? March end futures price on every consecutive day. This is not spot price. Please do not get confused. Why am I saying that? Because MTM, margin, everything is compared against the futures price, not against the spot price. Okay, that's a very, very important thing. Now, this is the settlement price. What do we mean by settlement price? End of the day closing price for end of day 1. Here, this is day 1. End of day 1. What is the settlement price for futures contract for March end date? You are required to calculate MTM cash flows and daily closing balances on account of an investor who has taken a long of 9170 or a short of 9170. Net profit or loss of each of the contracts. So, what they are saying is the price of the futures contract on the day when you entered is 9170. Then lot size is 50 and on day 1 the price changed to 9380. Same futures contract, month and future 9380. Day 2 9520, day 3 so on and so forth, every day it changed. Now if you go long on Nifty, what do you mean by going on Nifty? You have agreed to buy Nifty after some period, March end, that is here March end future. So you are agreeing to buy Nifty at March end at 9170. So on day 0 you enter into this. On day 0 you entered into this contract. So on that day, you assume that you entered it towards the end of the day, there is no index movement, the futures contract movement. What is the lot size? 50. Okay, so if it is 50, 9170 into 50, this is the contract value. 9170 into 50 comes to how much? Some 4,58,500. This is the contract value. But against this contract value, so the entire working of margin is against this contract value. What is the margin here? They gave what numbers? They gave 8% as initial margin and 6% as maintenance margin. So 4,58,500 into 8% is this value into 0.08, 36680. So you deposit this much amount of margin into the account with the exchange with your broker. The broker will keep it mark some lien on it and all of that, and then he will inform the exchange. Same 36680 or something like that will be deposited by the other party. Who is the other party? You are a buyer, that is your long. The other party is seller, somebody who is short. So they will also deposit 9170 36680. They have asked us to see how does it work if it is long and short. So I am doing both of them together at the same time. Okay, so they will also deposit. Next, what happens? What is the minimum margin, maintenance margin required? Is 6%. 6% of how much? By 0.08 into 0.06. So you get 27,510. 6% of what? Of 4,58,500. Of that 6% you should always maintain. If it falls below maintenance margin, you have to come back to the initial margin. Now on day 1, what happened? Day 1, the Nifty price. Is it Nifty price or Nifty futures contract price? Day 1, Nifty March futures contract price is 9380. So 9380 is the day price. So if you have gone long, that is you are a buyer, then you have made profit by, you agree to buy at 9170, already the price has gone up to 9380. So how much profit you have made? 9170 and 9380 difference, which is 210. On how many contracts? 50 contracts. So 210 into 50 is how much? 10,500. Now 10,500. So you had opening margin of 36,680. This profit gets added to that, and your total margin becomes 47,180. And again, your maintenance margin is computed. How much is maintenance margin? This revised value 9380 into 50 gets a value into 0.06. This is how much? 28,140. 28,140. Is your closing margin greater than maintenance margin? Yes. Can you withdraw some money? Yes, you can withdraw some money out of this. But we have not discussed this in our classes or our material, so we'll keep that aside. Next day what happens? Nifty moved to 9520. Arre baapre. From 9380 it went to 9520. So how much has it gained? See, what has happened here is you have computed gains till previous day. So when you compute gains today, you will do the accounting only from previous day till today. So the gain is from 9380 to 9520. It is not from 9170 to 9520. Why? Because whatever gain or loss is there for the previous day, you have already been marked to the market, and there is a settlement of that is also done. Okay, so all fresh works is comparison with 9380. So 9520 minus 9380, 140. 140 into 50 is 7000. So that 7000 gets added to your original closing margin of 47,000. Your margin becomes 54,000. Now what is the minimum margin you are supposed to maintain? 9520 into 50. 9520 into 50 into 6%, which you get as 28,560. Now we've seen 3 days. Same 3 days. What happens for the seller? Initially this was the case. Same maintenance margin, initial margin. There is no change. First day there is a loss. Loss of how much? From 9170, you have agreed to sell at 9170. Already the market for a similar contract on the next day is 9380. So you have also agreed to sell it at a lower rate than a higher rate. So you have made a mistake. So if you have made a mistake, you are incurring a loss. What is the loss? 210. 210 into 50 is how much? 10,500. So this 10,500 gets deducted from your margin. 36,680. Original margin was 36,680 minus 10,500. Which is how much? Minus 10,500 is 26,180. 36,680 minus 10,500 is equal to 26,180. What is the minimum margin you are always supposed to maintain? On this 9380 into 50 into 0.06 is how much? 28,140. Are you above 28,140? Below 28,140 after the losses? You are below. So you have to bring in money. Do you bring in only the difference? No, you have to bring it back to the maintenance. You have to bring it back to the initial margin. What is the initial margin on 9380? So you compute 9380 into 50 into 8%. So 37,520. So you have to bring it to 37,520. How much is it? 26,180. So difference between 26,180 minus 37,520 is 11,340. So you add margin of 11,340. And how much your margin now becomes? 37,520. So you are suppose there is a margin shortfall which you have to recoup of 11,340. And then your closing margin becomes 37,520. Your minimum you are anyway supposed to maintain 28. It is higher than that, so no problem. And then what happens on next day? Again the index went up. Again you are shorted, so you lost. So how much did you lose? 140. 140 into 50, 7,000. 7,000 is the loss. Now if it is 7,000, your 37,520 becomes how much? 30,520. What is the minimum margin you are supposed to maintain? 9,520 into 50 into 0.06. 28,560. Is your margin above that? Yes. 30,520 is greater than 28,560. So you need not bring fresh money. So your closing margin is greater than minimum margin. So no problem. Okay, we have completed till day 2 here. Here also we have completed till day 2. Now let us come to day 3. Day 3 what happened? Index, the future contract of the index fell from 9,520 to 9,100. So it fell. So if you have long, you have lost. How much have you lost? 420. 420 into how many contracts? 50. So how much have you lost total? 21,000. So from 54,000 whatever you have closing margin of previous day, you lost 21,000. How much the margin become? 54 minus 21, which is 33. How much should you minimum maintain? 9,100 into 50 into 6%, which comes to how much? Which comes to 27,300. Are you above that? Yes. As long as you are above the maintenance margin, you need not bring in fresh margin. Okay. So 27,300 is minimum, 33,180 is what you have. So that becomes your opening margin for next day. Whereas what happens to this fellow? you have shorted and index has fallen, so you have made a gain. How much gain? 420. 420 into 50 is how much? 21,000. Same 21,000. Thus 21,000 gets added to your account. How much was your margin? 30,520. To that 21,000 gets added, it becomes 51,520. Now where did this 21,000 get come from? This 21,000 came from this fellow. So the 21,000 whatever is the loss here is coming here and it is getting added to your margin and becoming the closing margin. Same way, whatever is the gain here is coming out of the loss here. It is getting reduced from this margin and coming and getting added to this margin. 47 and 54. Okay. This is how margin money moves from one person's account to another person's account. It moves through the exchange and broker and all that process is there. Next, what happens? It falls again to 8960. Again loss for the long guy. So 140 into 57,000. You subtract 33,000 minus 7,000. Subtract 33 minus 7. You get how much? 33,180. No? You get 26,180. But how much are you supposed to maintain? 8960 into 50 into 6%. You are supposed to maintain 26,880. So there is a shortfall. If there is a shortfall, you have to come back to the initial margin level. What is initial margin level? 8960 into 50 into 8%, which is how much? 35,840. How much are you at? 26,180. So the difference between those two is how much? 26,180. 9660. So you have to bring in 9660 so that you come back to the initial margin requirement on the contract because you have fallen below the maintenance margin. Now what happens to this fellow? Because it is 8960, he's made a gain because it is short. So the 7,000 comes into his account. So 51,000 it becomes 58,000. Okay. Last day, what happens? The index slightly gains by how much? 180 points. So 180 into 50 is 9,000. So this 9,000 comes to your account and your margin increases from 35,000 to plus another 9,000, which is 44,000. Okay. Now, whereas for this person, the same 9,000 decreases and your margin goes up to 40, goes down to 49,000. How 49,000? 58,520 minus 9,000. Now you see what has happened. You take all the MTM gains, all the MTM gain loss. You get a total of 1,500. 1,500 is a gain for the short party. Whereas same 1,500 is a loss for the long party. Why is it 1,500 loss? You started at 9170, ended at 9140, difference is 30. For a long party, after you purchase, it has fallen, so that 30 is lost. How many contracts? 50 contracts, so 30 into 50, 1,500 is the loss. 1,500 is the loss for the long party. How much is it for the short party? 1,500 is the gain. This is one way to compute. What is the other way? Other way is, which is you take all the closing margins, okay, and adjust the margin shortfall that you have funded. You will get the same 1,500. You take the closing margin, whatever is the closing margin here, which is how much? 49,520. What did you initially deposit? 36,680. What is the difference? 49,520 minus 36,680. So your margin has increased by 12,840. But out of that, 11,340 is what you yourself deposited. So the difference is 1,500. So this 1,500 is your gain. For a short party, 1,500 is the gain. For a long party, 1,500 is the loss. So this is how you solve this problem. This is called MTM, marking to market daily. It is called MTM or it is called margin. Any kind of question that you get in this particular chapter, this is how it works, this particular working happens. And this is how it happens in real life also. Only one thing that happens in real life, you're allowed to withdraw some money if you have profits in your margin account. Okay, fair enough. So after having understood this, we said we will go and discuss some questions. Let us look at those questions. Now, what are the other questions that we are supposed to cover? 5, 11, 15, 17, 24. Okay, let us go and look at those questions. These are the important questions what I have highlighted. Let us go and look at them. This 27 is already done. So 5, 11, 15, 17. So let us look at this question, and through this question I will explain to you the concept of cost of carry, which we will try and understand in greater depth. What is the question? Illustration. BSc illustration 5. BSc value is 5,000. Value of a portfolio is about 10 lakh 10,000. Risk-free interest rate is 9%. Dividend yield on index is 6%. Beta of a portfolio is 15. We assume that a future contract on BSc index with 4-month maturities to use to hedge the value of portfolio over next 3 months. One future contract is for delivery of 50 times the index. Based on the above information, calculate price of the future contract. Gain on short futures position if index turns out to be 4,500 in 3 months. So, what is the price of a future contract? I told you initially that future is equal to spot plus cost of carry. And I said we will just leave it there, we will come back and discuss in greater depth. Now is the time when we are going to discuss it in greater depth. What is the price of a futures contract? F is equal to spot, today's rate, plus interest, which is cost of carry, which is basically the compensation for time value, minus you have something called as dividend. Why are we subtracting dividend? See, in a futures contract, you are agreeing to buy something on a certain date at a certain price. If you already know that in between 50 rupees will go away, so let us say you agree to buy some kind of wheat after a month at 1000 rupees, but you know that within a month, on 20th day or 28th day, wheat will lose certain value. Will you still pay same 1000? No, you will say I will adjust for the value that is lost. So I will not pay the value that is being lost, I will pay only net of that value. So from spot, dividend is reduced. That is, from today's price, going forward, some cash is going out of the company, so the value of the share will fall. So if you look at the share prices, the record date, whenever the dividend is declared, there is a record date that is set. You would have studied about this in law chapter, law subject also. On the record date, whoever is holding the shares, they will be entitled to get the dividend. So the next day is called ex-dividend date. On the day, the price of the shares falls exactly by the value of the dividend that is lost, or the dividend that is paid. Okay, so you are subtracting dividend. Now here the question is, see, this interest is computed on spot. Okay, dividend, if they give absolute value, you will deduct. But are you supposed to deduct present value of dividend, future value of dividend? What are you supposed to do? Before we understand present value, future value, I want to explain one more concept, then we'll again come back to dividend. Okay, whenever we take interest, okay, there are two ways to compound. One is normal compounding, one is continuous compounding. Continuous means keeps on compounding every single instant, okay, or sometimes they use the word daily compounding also. For this, you use e power rt. For normal compounding, you use 1 plus r whole power t. Now, what do I mean by this normal compounding? So, let's say I have 100 rupees. What is the value of it after 1 year? If 10% interest rate. So, I multiplied 1 plus 10% whole power 1 by, because this 1 year. Same thing, if I have to compound it on a continuous basis, I will do it as e power 0.1 into time of 1. So I will compute the value of e power 0.1. E power 0.1. Now what is value of e power 0.1? Please remember, this e value is given in the value of e is given in the question. Okay, so in our question, have they given value of e? They have not given value of e. So it is not a question of continuous compounding. Okay, you can directly take this normal compounding. When you do normal compounding, you can take any number 100 into 1. If it is 10%, you just multiply 1 plus 10% for 1 year. If it is half year, you do by 2. In our case, right, they have not given what it is e, so we assume it this. Now, why am I explaining this before I explain dividend logic? Because how do you adjust dividend? I have been telling everything. You adjust dividend. Dividend is present. See, spot ke liye you take future value. But what about dividend? Dividend is taken at present value, future value, what value? See, you have to make one assumption. Okay, let us take a simplified assumption. Dividend is paid on the last day. Dividend is paid on last day. And typically, if they do not mention anything in the exam, my suggestion is take the dividend on the last day. Okay, dividend last day. What is dividend payment last day? If you recollect, you would have read this in your law paper also. There is something called as a record date. The people who hold the shares on that particular date in the register of members, it is recorded, and those people are paid dividend. So the day after the record day is called ex-dividend day, and on that day, if you look at it in market also, the value of shares drops by the dividend value. The value of the shares drops exactly by the amount of dividend. Why? Because some value is going away from the company. So value is going away from the company. Now, here we are assuming this dividend is being paid on the last day of the futures contract. Okay, that is what we are assuming. Why are we assuming? Because they have not mentioned anything. And why should we assume this? I will explain to you. Spot plus interest minus you always assume future value of dividend. Future value. Okay. When you are subtracting, okay, you should always subtract the future value. Suppose, let us say they give you in between days, the dividend is paid on 20th day. The contract is for 70 days. What you do is spot minus, so let's say dividend on day 20 is given. What do? You do present value of dividend day 20, then come and subtract this. So PV of dividend 20, you arrive at this spot. On this, you compute 1 plus interest. Okay, this is one way. And this works perfectly well even when you have this continuous compounding. It works brilliantly well. But if they have not mentioned when the dividend is paid, you assume, easy to assume, very, very easy to assume that it is paid on the last day. Now, this is one way. What is the other way? You can do spot into 1 plus interest, where you are computing the future value of the spot, minus dividend future value for 70 days. Why am I taking 70 days? The contract is for 90 days. Dividend is paid on day 20. You either subtract, bring present value to it, subtract from the spot, and compute future value for everything, or you take spot into future value minus future value of dividend. Dividend D20, uska future value. So either bring dividend back and move it forward, or move entire dividend forward and subtract. What did I tell you here? What was my assumption? Assumption is dividend is on last day. Do you have to bring it back? No. If you can directly subtract it as forward date. So you can directly subtract dividend because it is on the last day. Again, no forward value or future value needs to be computed. So you can directly subtract it. That is the logic. Okay, that is the logic. This is something that you have to remember. Even if the question is twisted or confusing, if you remember that it is spot minus present value of dividend, whole thing ka future value is future price or forward price. If you remember this, what will you do? If dividend is paid on last day, you are bringing back dividend to present value, that is day 0 or that is spot date, and then again doing future value. Where are you going to arrive at? If 1, you do present value and you get 0.98, and again 0.98 you do future value, you will again land up at 1. So if you do this future value, present value for a dividend that is paid on the last day, you arrive at the normal value of dividend, you directly subtract. So in which case, you need not do present value, future value adjustment for the dividend. If it is paid on the last day. If it is paid on in-between date, bring that in-between date to day 0, and for the whole thing compute the future value. Spot minus the value of the dividend, present value of the dividend which is paid in between date. What is in between date? If the contract is for 90 days and your dividend is paid on day 30 or day 40, bring it to 0 date, that is present value, subtract it from spot, for the whole thing compute the future value. Okay? I have to remember this. These are the 2 points. Now when we talk, this is with respect to stocks. Okay? With respect to commodities, you have one more adjustment. What is it? Another adjustment for stocks. It is e power R minus D. R is interest rate minus D is dividend. Okay, into T. Okay, assuming dividend is R is the yield, interest yield, interest rate, continuous compounding interest. R is continuous compounding interest rate, D is dividend yield on a continuous compounding basis. What I told you here is for normal compounding, for continuous compounding, this is how it works for stocks. For commodities, it works as e power R minus R plus storage cost. There is an additional cost that you have to bear the cost. The person who is going to buy from the seller is not only having to bear the cost of carry, he also has to bear the storage cost. So storage cost is added, and convenience yield. There is something called as convenience yield that is subtracted for time. Okay, storage cost is added, convenience yield is subtracted. This is for commodities. When we come to a commodity, we will see that question, but please remember this formula. R plus storage minus current. They may use different notations, Y, D and all of that, but logic is storage cost is added, convenience yield is subtracted. If there is insurance is also added. Okay, this is for commodities. Now let us come back and look at the question and then use all the information that you have learned so far. What is it? BSc current spot is 5,000. Okay, value of the portfolio is 10 lakh 10,000. So you have some other portfolio which has a value of 10.1 lakhs. Okay. The risk-free rate is 9%, dividend yield on index is 6%. Okay, so here what did I say? This interest is 9%, dividend is 6%. Think of it simply. Then, portfolio beta 1.5. So we will come to this portfolio matter slowly. They have asked, first question is, based on the above, first of all, find the price of a future contract. What future contract? We assume a future contract on BSc with 4 months maturity is to hedge the value of the portfolio over 3 months. So they have a portfolio of 10,10,000 which they wish to hedge. But they cannot hedge it with a ready-made futures contract. What is this hedging of a portfolio with a contract with the futures? If there is a portfolio which is volatile, you are entering into a contract hedging. You remember I explained what is hedging, arbitrage, speculator, and all of that. This portfolio may go up. I need a contract on the opposite side which will offset this gain. On the contrary, the portfolio value goes down. I need a contract on Nifty which will have a gain which will offset this loss. So I need something that counterbalances the movement in portfolio. That is what they are referring to by saying that use Nifty futures to hedge the portfolio. And what is the portfolio beta? 1.5. So how is the portfolio beta used? We will discuss. But enter into some Nifty contract, future contracts, opposite direction of your portfolio. If your portfolio is long, your Nifty contract should be short. So short some contracts. But how many contracts that you have to figure out? But how do you figure that out? They are saying portfolio value is 10,10,000. So if your portfolio is long, you have to short Nifty. But portfolio, you need to hedge it over 3 months. But the Nifty is available only for 4 months. So what are they saying? We assume that future contract is with 4-month maturity used to hedge the value of a portfolio for 3 months. So first of all, find out the contract value of the Nifty for a 4-month future. Okay. So 4-month future, what is the price? How do we arrive at the price? Spot. What did we discuss here? Spot, which is 5,000. Correct. Spot is 5,000 plus cost of carry, which is 9% into 4 by 12. Why 4 by 12? 4 months. Nifty future contract is for 4 months. That's what they said. 9% into 4 by 12 into 5,000 minus 6% into 4 by 12 into 5,000. Why are we subtracting dividend? Because the dividend is, we assume the dividend is paid over the end of the term. This is why we can simply subtract. So you get a value of 5,050. 5,050 is the value of the future contract. If the spot today is 5,000 and interest rate is 9% and the dividend yield is 6%. Okay, so 5050. This 5050 is the value of each future contract. But how many, if you enter into one contract, the minimum lot size is 50. So you have to enter into 50 into 5050. What is the value? 5050 into 50 comes to how much? 25 lakhs, 2,52,500. Now please note this logic. What is the logic? Portfolio is 10.1 lakhs. Nifty, one lot is 2.52 lakhs. Nifty has a beta of 1. This portfolio has a beta of 1.5. The counterbalancing should happen such a way by taking beta into account. Whatever is the movement in the portfolio should be offset. So, if 10.1 into 1.5, what is this? If the Nifty moves by 1, this moves by 1.5. This should be equal to X into 1. What is X? X is the value of the total Nifty contracts that you enter into. What is each Nifty contract, each lot? 2.52 lakhs into Y is equal to X. So 2.52 Y into 1. This should equal, the movement in this should equal the movement in this. You go this long, this you go short. So when the movements both balance each other, that is when there is a hedge. So if you come and arrive at a number Y, 10.1 into 1.5 by 2.52, you will get how much? 2.52 or 2.525? Actually 2.525. So 2.525 into 4 is equal to 10.1. So this goes 4 times. So 4 into 1.5, 6. So you have to enter into 6 lots of Nifty such that, so that whatever is the movement in portfolio gets offset by the movement in the Nifty futures contract that you have entered into. And Nifty you will short. Why? Portfolio you are long. So first part of the question. What is the first part of the question? Price of the future we already found out 5050. Okay, simple. The gain on short futures position if index turns out to be 4,500 in 3 months. So they have not even asked you how much hedge has to be done. You have to figure out how many contracts you have to enter into, which is 6 we already found out. If after 3 months index turns out to be 4,500. If after 3 months index is 4,500, see what happens? You enter into 6 contracts. Okay. So after 3 months, the spot value is 4,500. Then on the ending date of 3rd month, what is the future contract value for 4th month? Why are we doing this? Please listen again. We have initially entered into a futures contract for 4 months. After 3 months, spot is 4,500. So when you are trying to settle this particular contract after 3 months, the contract, you have to figure out the new value of a 1 month future based on spot of after 3 months. So spot after 3 months is 4,500. 4,500 into same logic again. What logic? 4,500 plus 9% into 1 by 12 into 4,500 minus 6% into 1 by 12 into 4,500, which is basically 4,500 into 0.03 by 12, which is 11.25 plus 4,500, which is 4511.25. So you get 4511.25 as the value of the Nifty future contract for 4 months after 3 months. So this is the value. Whereas you entered into a contract at 5,050. So the difference between those two, that is the Nifty value has gone down. And what did you do? Did you go long on Nifty or short on Nifty? You shorted Nifty. So if Nifty has gone down, then you have shorted Nifty, you will make a gain. What is the gain that you will make? The difference between these two. The difference between these two is what? 4511.25 minus 5050. The value is 538.75. 538.75. On how many lots? How many lots? 6 lots. And each lot is how many contracts? 50. So into 6 into 50, 161625. This is the gain that you will make on Nifty. 161625. Nifty has gone down, you have shorted it, so you make a gain. If Nifty has gone down when you go long, you make a loss. So now this gain will compensate exactly the loss you incur in your portfolio. Why is your portfolio incur loss? Your portfolio is beta. Nifty beta is 1, your portfolio beta is 1.5. And if Nifty falls, your portfolio falls 1.5 times. So Nifty has fallen from 5,000 to 4,500 by 10%. So your portfolio would have fallen by 10 into 1.5, which is 15%. How much is the loss in the value of your portfolio? 15%. 15% of how much? 10,10,000 into 15%, which is how much? 1,51,500. Right? Your portfolio has lost 1,51,500, but your Nifty has gained higher. Why is there a difference? Arey Baba, your portfolio is for 3 months, Nifty is a 4-month contract. So that 1 month differential is where the whole story is. Okay, that 1 month is where the whole story is. Okay, so now this is how you solve a question in this particular kind of model, where in which I try to explain to you how the future is priced, how the index beta, how do you consider beta value, how do you take E, how do you take present value of dividend, future value of dividend, all of that. Okay, after having understood this, let us move to the next problem. So friends, now looking at this question, we have finished question 5. Now let us go and have a look at question number 15 and 17 and so forth. First, let us go to 15, then we'll go to 17 and 24. We anyway have solved 27 already. So 15, 17 and 24. 15 is a very interesting question. Suppose there is an future contract on a share presently trading at 1,000. So the share is presently trading at 1,000, or is the future contract? Okay, it's a share. The life of the contract is 90 days, and during this time company will pay dividends of 7.5 in 30 days, 8.5 in 60 days and 9 in 90 days. So there are 3 dividends. Assuming continuously or compounded continuously risk-free rate of interest is 12%. That is, whenever they use the word continuously compounded, it is E power. Okay, please note, it is E power. E power is what you mean by continuously compound risk-free rate of interest. You are required to find out fair value of the contract if no arbitrage opportunity exists, value of cost to carry, and given e power minus 0.1 is so much, minus 0.02 is so much, minus 0.03 is so much, and plus 0.03 is so much. Why are these so many e power values given? These many e power values are given because dividends are given here. Okay, dividends are given here because dividends are after 30 days, 60 days and 90 days. Now in this problem, I am going to explain to you how are you going to consider dividends. How do you value dividends? So the assumption behind dividends always is, okay, spot minus present value of dividend into future value of dividend. So basically you are subtracting the dividend yield, correct? But when you have different dividends that are given and it is not a dividend yield, you are supposed to directly subtract the dividend, but then all the dividends are at different periods. So what you do is either you subtract the future value. So you do spot into future value minus dividend into future value. In our earlier questions, we assumed all dividends are paid on last day. If it is paid on last day, is there any relevance of future value? No, you don't have any relevance. So this is way number 1. or when I say future value here, it means e power RT. Okay, I hope you have understood that by now. Or you do spot minus present value of all dividends, and the whole thing you do future value. So what are you doing here? Here, in our case, in this particular question, you are getting dividends at different points of time. You're getting in 30 days, you're getting in 60 days, you're getting in 90 days. The transaction is for 90 days. That is, the future is for 90 days. The current spot is at 1000. So this spot is 1000, for which you are doing a future value. But then you are bringing all the dividends to present value, that is day 0, and then doing a future value for them. That is, dividends are subtracted at future value basis. Please remember that part. Please remember that part. If they are anyway paid on the last day, then you don't have to do any future value adjustment. But if they are paid in between, you either bring them to the present value and then do overall future value, or the other way is S0 into future value minus dividend future value, which is what I was explaining here. Okay, these are the two ways. Now in our question, what did we do in our question? What is it that they have given? 30 days, 7.5. So let me just write down. Solution, S0 is 1000, T is 90 days. Continuously compounded rate of interest, risk-free rate of interest is 12%. Then D1 is 30 days, is 7.5. D2 is 60 days. D3 is 90 days. And what are the dividend values that they have given? 8.5, 9.5. 8.5 and 9, I'm sorry. So the goal is, now you have to bring all of these to present value and then subtract that from the spot, and for the whole thing you have to do future value, or you can directly do a future value for all of these and compute. So I'll give you an example, then you'll understand, or rather I will take this 30 days thing. See, if dividend of 7.5 is there, if you have to bring this to present value, you will do what? E power minus RT. R is what? R is 12%. What is T? T is, see, have they said 365 or what days? They have not said 365, but here everywhere they have given it in number of days. So into 30 by 365. This is T, this is R. So what will happen? E power, that is 7.5 into e power minus of 30 by 365 into 0.12, which is e power minus 0.00986. Okay, this can also be written as 7.5 into e power minus 0.01. Have they given e power 0.01 value anywhere? Yes, e power minus 0.01. So if they have already given you this value, you are supposed to bring this particular dividend to present value. So if you are going to bring this to present value, you cannot take this to future. So if you are going to do present value, you will not do future value for the same dividend. You will subtract it from the entire spot, and then for the spot you will compute the future value. So how much is it? 7.5 into, they have given some value, right? I have kept the thing open here so that I can read it. 7.5 into 0.9905. So P of D1, PV of D1 is how much? 0.9905 into 7.5. That is 7.42875. Okay. Now, instead of taking 30 by 365, can I take it as 30 by 360? Even then, you will get actually 0.01 only. Why? 12% into 1 by 12, which is 12% is 0.12. 0.12 into 1 by 12. So, e power minus 0.12 into 30 by 360. So, 1 goes 12 times, 12 goes this will be 0.01. So, we basically got the same value. I did it more exact, they gave more in the rounded off terms. Okay. And then PV of D2. What is PV of D2? 8.5 into e power minus 12% into 60 by 365. This will be 8.5 into e power minus 0.12 into 60 by 365. 0.0197 or 8.5 into e power minus 0.02. Have they given the value for 0.02? Yes, they have given the value for 0.02. It is 9802. So 8.5 into 0.9802. 0.5 into 0.9802, which is 8.3 3317. Then present value of D3, which is 9 into e power minus 12% into 90 by 365, which is 9 into e power minus 0.12 into 90 divided by 365, e power minus 0.03, which is 9 into 0.03 also they have given value here, which is 97045, which is 8.73, 73405. Okay. Now we have got the three values, 1, 2, 3. Now how did I decide that I should do present value and not do future value? It is very clear. How is it clear? They have given power minus, power minus, power minus. So when you have power minus, you are bringing it forward. The values here also less than 1. If it is less than 1, you have to do present value. So these numbers have been given for present value purposes only. Okay. So future is equal to value of future contract is spot minus present value of dividends whole thing into future value factor, which is 1000 minus, what is the present value of all dividends? 8.73 minus 8.33 minus 7.43, whole thing future value, that is 8.73 plus 8.33 plus 7.43 is 24.49 minus 1000 is 975.51 whole thing into future value factor, which is again, what are we computing the future for? Future contract is for how many days? Future contract is, this is 1000, life of the contract is 90 days. For 90 days, have they given a future value factor? Yes, they have given a future value factor. What is the future? It is actually the inverse of e power minus 0.03. So 1 by 0.97045. You will get 1.03045, 1.03045. See, that is what they have got. So that is 975.51 into 1.03045. That is equal to futures price is equal to 1005.21. Okay, 1005.21. So 1005.21 is the value of the future contract. In case they don't give you all these numbers 1.01 or 02, 03 and all of that, how do you compute it? So you can use interpolation exercise to figure out. That is one way. Second thing is you can also use this calculator. If you know, remember this calculator trick. What do we have here? I will do this for one of them. E power 0.01. What is the value? E power 0.01. Yes. So e power 0.01. How much did we get? Got it as 0.9905. How do you compute this 0.9905? I will show you. E power minus 0.01 is equal to 0.9905. Please remember this number. If you need to compute this, when if let's say they're not given e power value, they have not said anything how you're supposed to compute, but they want you to compute using continuously compounded risk-free rate of interest, then, so how do we compute this value here? You take this normal calculator, write the number what you want, which is minus 0.01, okay, because we need to compute for e power minus 0.01, correct? Write this number, then divide this by 4096. minus 0.01 divide by 4096, you get a value. To that you add 1 plus 1, you get some value. Then you do into is equal to 12 times. So into is equal to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So you get a value of 0.990049. You get a value of 0.9904. This is very, very close to this. This is not exact, but very close. So you can use calculator tricks to arrive at this value. Okay, if at all they don't give, which is very unlikely in the exam. Okay, that is one more thing I wanted to teach you in this particular topic and chapter. So friends, after having found out this futures price of 1005.21, Is that the end of the question? No. In fact, you come back to the question, there is one more point in this whole, trying to figure out the answer. You should not forget that there are more than one questions that are asked in the exam. What is the fair value of the contract? We have already found out. What is the value of cost of carry? What do you mean by cost of carry? What is basically the interest component? What is basically the interest component? See here, we've got three numbers. Okay, what are the three numbers? First, I'll say the spot is 1000. Then we have arrived at future value, which is 1005. Okay, but in this there is dividend value. What is the dividend value? Dividend value is summation of these three. This is the present value of dividends. So if you were to write it more clearly, 1000 minus present value of dividend, whole thing into future value, which basically is whole thing future value factor, okay, is equal to 1005. 1005 point something, right? 1005.21. So 1000 minus what is the present value of dividend? We have here 8.73 8.33 and 7.43, 24.49 minus 24.49 into future value factor is giving you 1005.21. Okay, so if you subtract this 1000 from 24.49, you actually are getting 975.51. Okay, plus your cost of carry, which basically is the future value factor what you have considered, is equal to 1005.21. So 1005.21 minus 975.51. So cost of carry is equal to 29.7. Cost of carry is 29.7. Cost of carry is 29.7. So here, please note, my friends, even though you have computed, done a future value for the entire spot minus your present value of dividend, the element that is getting added in order to account for interest or in order to account for time value of money, that basically is the cost of carry. Here, you have subtracted dividend, but on the entire value, you are computing the future value. Okay, which is why I would always prefer subtract all the dividends to bring all the dividends to present value, subtract them from the spot, then do a future value for the whole thing. In this case, you will be very clearly be able to give the answer as 29.7 as the cost of carry. Okay, now after having done this, let us move to the next aspect. Then moving forward, where are we? We finished illustration number 15. Next, we have to go to illustration number 17, what we discussed earlier. Mr. V decides to sell short 10,000 shares of ABC PLC when it was selling at yearly high of 5.6 pounds. So it was selling at a high of 5.6 pounds. His broker requested him to deposit a margin of 45% and commission of 1550 pounds. While Mr. V was shorting the share, ABC paid a dividend of 0.25 pounds. At the end of the year, Mr. V buys 10,000 shares of ABC at 4.5 to close out the position and was charged a commission of 1450. You are required to calculate the return on investment for Mr. V. Now you see here, what are the various things in this particular question? First, you are selling short. What is selling short? Selling short basically means you are selling something that you do not have. Okay, you generally shorting means you can, I go long, I go short. Go long means I buy. I go short means I sell. Now, when he is doing a short selling here, he basically doesn't have the existing shares. Okay, which is why he's trying to buy them back when their price comes down. So when do you sell something? See, when do you buy something? You buy something when you believe that the price will go up. When do you sell something? You sell something when you believe that price will come down. So when you short sell, you basically, what do? When you short sell, you basically sell today at high, buy tomorrow at low, same quantity, X quantity, price, let me take Y plus 5 and you buy it back at Y. So what happens? You bought and sold X shares, you sold them at X plus Y and you bought them at Y. So you basically make 5 into X, 5X is the profit. So short selling is a process whereby you first sell the shares. But how do you sell a share that you don't have? You borrow the shares. You borrow the shares from somebody. So there is this thing called security lending and borrowing mechanism, SLBM or SBLM, I think, SLBM, security borrowing and lending, SBLM, I think, SBLM. security borrowing and lending mechanism. Even in India it is there. So you can borrow securities. When you borrow, what do? You pay interest. So when you borrow security from somebody, you have to pay some interest to them. At what rate is interest calculated? It is typically the call money rate, or there is some reference rate that is given, you pay them that interest. So the person who is lending the securities is earning income. And what happens when this particular security, when they borrow, let's take a party called X. X is borrowed and then sold off. But borrowed from whom? Borrowed from Y. So X has borrowed some securities from Y and sold them off in the market. Now Y is supposed to get some dividend every 3 months. So whenever a dividend is declared, X is supposed to pay the dividend to Y. Why? Because that security, there is dividend, and dividend, Y is supposed to earn the dividend frequently. So instead of company giving the dividend, X is giving the dividend to Y. So the dividend also has to be adjusted. Then there is some commission that you have to pay to the broker, there is some interest that you have to pay to Y, so there are all of these. And finally, you make this profit of some 5 rupees, 6 rupees per share, and from that you subtract all of those costs, and then you figure out whether you made a profit or not. Okay, this is one way. Now in this, what are they saying? What are the various costs? You are selling at a yearly high of 5.6 pounds. So sale price, 10k shares, right? 5.6 pounds, 10k only, no? 10k, and at the end of the year buys back at 4.5 pounds. Day 0, day 365, buyback, 10k shares at 4.5 pounds. Okay, then you are requested to deposit a margin of 45% and commission of 1550 pounds. This is when? Initially itself. So margin 45% of 5.6 into 10,000, which is how much? Which is 25,200 pounds. Then commission, upfront commission, 1550 pounds. 1550 pounds. Commission of 1550 pounds. And when Mr. V was short, ABC paid a dividend of 0.25. So this dividend 0.25 into 10,000, which is 2,500 pounds. This dividend is also there. Then at the end of 1 year, he buys back 10,000 shares at 4.5 to close out the position and was charged a commission of 1450 pounds. Initially 1550, closing commission 1450 pounds. Okay, see the expenses this man has to incur. Now, what is the investment here? Investment that he made is actually the margin that he has deposited. This is the investment. Okay, this is the investment. What are the expenses? These are expenses. Commission upfront, dividend that he has to pay to from whoever he has borrowed, closing commission. These three are expenses. What is the profit that he has made? The difference between these two is profit. So you have to compute, or rather gross profit, I'll say gross profit. Gross profit minus expenses, you will get net profit by your investment is basically your return. Investment is equal to pounds 25,200. Expenses is equal to all these three together, which is how much? 3,000 plus 2,500, which is pounds 5,500. Gain gross is equal to 10,000 into pounds 5.6 minus 4.5, which is 1.1 into 10,000, which is 11,000. Net gain is pounds 11,000 minus pounds 5,500, which is equal to pounds 5,500. So return, see there are two ways to compute return. One way is simply compute end of the year net profit divided by the original investment, which is 5,500 divided by 25,200, which is 21.83%. This is one way. Another way is, I believe you can actually compute IRR also. IRR. What is day 0? You spent how much? The reason why I am so specific you have to do IRR is they were also very clear. This is upfront, This is in between. When did they say in between, or what date did they say? They paid a dividend. They didn't say which date, but they said in between sometime it was paid. End of the year, you charge 1450. So these, one of them is beginning of the year. This is end of the year. This is beginning. This is end. So both of them have to be treated differently, right? So day 0 minus 25,200 minus, because these are all two expenses that is incurring, minus 1550. Okay. Day 365, he gets plus 11,000, which is basically this gain. Then minus 1440, which he, not 1440, 1550, yeah, 1450, minus 1450, which is the commission paid at the end of the year, minus you can take dividend. Dividend you can take here or there or somewhere in between also, but I will take it towards the end, it makes life simpler. Minus 1250, no, minus 2500, I'm sorry, 2500 is the dividend, minus 2500. So, what is the IRR for this? Day 0 is minus 26,750, day 365, and you get your 25,200 back. You get your 25,200 back. You deposit the margin, you get back the margin. Day 365 is 11,000 minus 1450 minus 2,500 plus 25,200, 32,250. So IRR here is 32,250 divided by 26,750 minus 1. You get 20.56%. Now if you assume that this dividend is not on this day but somewhere in between or some other date, then obviously a lot of things will change. Okay. Okay, so you can compute this IRR way or you can compute simple ROI. I would prefer this IRR way simply because, in fact, in an exam I would suggest do both. The simple reason is they've given specific dates. Okay, when somebody gives you dates, they expect you to use the formula that you have learnt, right? So you can do either way, and I would presume that you do both of them, okay, if possible. Otherwise, at least do this, and I would typically prefer this. Okay. Fair enough. Now we have done 17 also. Now let us go to the next problem. What is the next problem? Next problem is problem number 24. We've already done 27. Let us go to 24. Let us look at this question. Mr. A has a portfolio of 5 crores consisting of equity shares of X Limited and Y Limited with beta of 1.15. Other information is as follows. Value of index future is 21,000. Multiplier is 150. You are requested to reduce beta of the portfolio to 0.85 and increase the beta to 1.45 using change in composition through risk-free securities and index futures. So there are two ways in which you can reduce or increase beta. One is using risk-free securities, other one is using index futures. They are asking you to do the both. Okay. So now, what is the portfolio value? 5 CR. Beta 1.15. Current Nifty future or index future, no? They said Nifty or index? Index future. $21,000, lot size 150. One future contract value is equal to 21,000 into 150, which is equal to rupees 31,50,000. Okay, 31,50,000. Now, what are they saying? What is the first part of the question? You are requested to reduce beta to 0.85, increase beta to 1.45 using, first we will take risk-free securities. So, let existing portfolio be P. Okay. Let new portfolio be Q. Okay. So, Q is equal to P into weight of P plus risk-free into weight of risk-free, correct? because our portfolio, new portfolio is combination of old portfolio into some weight for that and risk free into some weight for risk free. Now, what is it that they are saying? Such that the beta of new of Q is equal to 0.85. They gave two options, right? Reduce it to 0.85, increase it to 1.4. Beta of Q, first we will take 0.85. So, 0.85 is equal to, what is the beta, current beta of the portfolio? 1.15. 1.15 into weight of P plus, what is beta of a risk-free portfolio? 0 into weight of risk-free. Now, what is rate of risk-free? Weight of risk-free is equal to 1 minus weight of P. Correct, no? Because if there are only two items, one of them is X, other one is 1 minus X, if you are looking to see the proportion. So, 0.85 is equal to 1.15 weight of P into, plus 0. Okay. So, weight of P is equal to 0.85 divided by 1.15. So, weight of old portfolio is is 0.7391. So, if this is weight of portfolio is this much, what is weight of risk free is equal to 1 minus 0.7391, which is 0.2609, that is 26.09. That is 26.09%. Weight of risk free is 26.09. Now, what is the value of the assets? Value of the asset is 5 crores. So, 5 crores into 26.09, 5 CR into 26.09, that is rupees 1.30 crores or 3045 CR. So, this much amount should be withdrawn. Rupees 1.30 CR should be liquidated from portfolio P and invested in risk-free securities to lower beta to 0.85 from 1.15. Same way, to increase beta from 1.15 to how much? They gave a number, what is it? 1.45. If you have to increase beta from 1.15 to 1.45, same logic. Beta of Q, which is a combined portfolio, is equal to 1.15 of P, of weight of P plus 0 into weight of risk free. Why? Beta of risk free portfolio is 0. But what is beta of Q? 1.45 is equal to 1.15 weight of P. So, weight of P is equal to 1.45 by 1.15. Weight of P is equal to 1.260. How can weight be greater than 1.26? If weight of P is 1.26, weight of 1 minus P will be how much? Minus 0.26. See, both weights, weight of risk free and weight of main portfolio P, both of them combined together should be 1. If one of them has a higher weight, weight greater than 1, other one is lower. What is this? This is basically shorting or borrowing. So, instead of investing in risk-free securities, you are borrowing from risk-free securities. That is, you are shorting risk-free securities and getting the money. You are getting the money. How much? 0.26. 0.26 is again same percentage, I think. 0.2609 only, if I am not wrong. Yes, 0.2609. This is also 1.2609. So, in order to increase beta, the company should borrow risk-free securities of 1.3 CR and invest in the portfolio P. Okay. So, this is the first part, which is basically about risk-free securities. Then using futures. Risk-free security beta is 0. Beta of index futures. What is beta of index? Is equal to 1. Okay. Now, so beta of index futures is 1. When you get index future related problems, you should not, I would typically not prefer that you do something like this. You do it for the full value. Why am I saying that? You will understand. Because in case of risk-free securities, the weight of the future contract, the weight of the risk-free security is also considered, whereas in case of a future contract, there is no weight. Only for a beta purposes it is computed, but the overall value of the portfolio will still remain at 5 crores. Okay, so what I mean, you will understand. So, portfolio futures contract, okay, beta 1.15, this is 1, correct? Now, total portfolio, total, what is the beta? That is at 0.85. Now, what is the amount in crores? 5 crores, right? So, here the total value here of the portfolio will still remain at 5 crores, okay, because futures contract is just a contract, whereas in case of risk-free securities, you are buying and selling securities. Here you are buying and selling a contract. The contract, there is a value to the contract, but then from a total perspective, that does not get added to your overall portfolio value, whereas in case of risk-free securities, it gets added, but in this it doesn't get added. You are basically not selling some part of the portfolio to enter into a future contract. Are you doing that? No. See here, what have you done? You have sold some amount, this 0.260 or 1.3 crores. You have sold risk-free securities, invested in portfolio, or sold portfolio, invested in risk-free. Whereas when you come to futures contract, there is no selling of portfolio or liquidating the portfolio. You are entering into fresh contract for futures. So your portfolio 5 is going to be at 5, and futures contract is just a contract notional value. So this total of 5 will be put here, and you will work backwards here. So what you will do is, beta into value is what? 5 into, this is current, 5 into 1.15 is 5.75. Here it is 5 into 0.85, which is 5, 8 5s are 40, this is 4.25. This has to be a number which is the difference between these two, which is 1.5. If this is 1.5, beta is 1 and this is 1.5, this has to be 1.5. Why? Because 1.15 into 5 is 5.75, 0.85 into 5 is 4.25. So 1.1 into 1.5 is equal to 1.5. So when you are given beta for futures, please don't do the normal way in which you do for risk-free securities. That is precisely the reason why they give this kind of questions in exam. So beta, so the total value of futures contracts. Now what do you have to do? See here, please note, you subtract 1.5 from 5.75 to arrive at 4.26. This is positive, this is negative. So you have to short. The total value of futures contract to be shorted is 1.5 CR. If it is 1.5 CR, each lot is how much? We computed it above somewhere. 31.5 lakhs. 31.5 lakhs. So total contracts to be shorted is equal to rupees 1.5 CR divided by 31.5 lakhs. 1.5 divided by 31.5. That gives you 4.76 contracts. Now, can you enter into 4.76 contracts? Maybe, may not be. Most likely, you will, in market you can enter into only for 5 contracts. So rounding off 5 contracts. Okay. Now, the other side. What is the other side? Other side is increase beta to 1.45. So if you have to increase beta, you have to enter into more. That is, you have to go long. That is, go long on index futures. Same logic what we did earlier. Portfolio, futures, total portfolio, beta, value, beta into value. What is portfolio beta? 1.15. What is the value of the portfolio? 5 CR. This is 5.75. Total portfolio, what do you want it to be? The beta has to be 1.45, but the value of the portfolio is same 5 crores. So 5 into 1.45 is how much? 1.45 into 5. You get 7.25. So the differential is addition. So plus 1.5. This future has a 1 beta. So you enter into 1.5 crores worth. So go long on 4.76 or 5 contracts. How did I arrive at 5 contracts? Same 1.5 crores. 1.5 crores by 31.5, which is the each lot size, you get arrive at same 5 contracts. So if you have to go long on if you have to change beta of portfolio using futures, you have to either buy or sell 5 futures contract, and if you have to do the same thing using risk-free securities, you have to buy or sell 1.3 crores worth of risk-free securities. Very interesting problem, right? That is why I gave this problem. Okay, that is why I chose this problem for revision, because so that in one single problem we will understand every single concept that is there. Now after having understood this, let us go to the next one. What is the next one? We have done 27. Now we are at 29 and 30. Let us go and have a look at 29 and 30. From let us go to the next one, which is this 29 illustration, basically RTP November 23. Good question actually. A company is long on 10 metric tons of copper at 474 per kg spot. Current is spot, it is long, meaning they have purchased, and intends to remain so for the ensuing quarter. So they will have purchased it, they will keep it with them. The standard deviation of changes of its spot and future prices are 4% and 6% respectively, having a correlation coefficient of 0.75. So spot and futures are moving together, or they have a correlation of 0.75, and the standard deviation of each of them is given. What is its hedge ratio? What is the amount of copper future it should short to achieve a perfect hedge if initial margin is 8%? See, this kind of question has never been asked. In fact, we have never even been taught this. Okay. The key thing here is you have to figure out what is hedge ratio formula. What is formula for hedge ratio? Hedge ratio is how much of futures basically you have to buy. See, you have gone long on spot. So short futures, how much, such that portfolio is hedged. So basically you are trying to find out some kind of a beta variation here. Okay, some kind of a beta. Now here thing is, what is beta formula? R standard deviation x by standard deviation y. So here the hedge ratio is basically equivalent to beta. The sensitivity of the spot to future, future to spot, whatever it is, R standard deviation x by standard deviation y. Here it is, R is correlation 0.75. Now the thing is, we have to figure out, see, future spot is driving future or future is driving spot. That is a critical question. In normal case, if you look at our normal beta for equity stocks, R standard deviation of stock by standard deviation of market we do. Okay, basically the stock is moving because of the market. That is the understanding. Stock is dependent on the market. Even in real world, more than the spot prices, future prices actually affect the spot price. So instead of spot affecting future, future affects spot. See, what all did we discuss initially? S into E power R plus storage cost minus convenience yield into T for commodities is equal to price of the future contract. But in reality, this is just a pricing mechanism. Reality, futures prices, I want wheat future on that day at that price, that actually determines the spot price today. This is reality. Huh? In markets, futures actually end up, if you know, if there is a lot of activity in futures, spot will reflect it. A lot of activity in spot, future also reflects it. But as far as this question is concerned, the assumption is the futures prices drive the spot prices. So beta is equal to R standard deviation of spot by standard deviation of future, which is 0.75 into 4% by 6%, which is 2/3 of this, which is 0.5. So beta is 0.5. If beta is 0.5, how many contracts should you hedge? Exactly half the contracts, right? Why? You have taken 10 metric tons of copper here at 474. Now how much should you hedge? How much should you short of futures? See, 10 million tons at 474 per kg, 10 metric tons, 10 MT, which is 10 into 1000 kg into 474 rupees per kg. So what is the value of this copper? 474 into 10,000, 47.4 lakhs. This is long. So what should be short? Futures 0.5 beta. What do you mean 0.5 beta? If future price goes down by 1, spot buy price goes down by half. So how many futures should you short of copper in order to hedge this 47.4 lakhs fully? See, here you have done 10 MT. So you should short 5 MT of copper. Short. This is what is the answer. You should short 5 metric tons of copper in futures of not copper, copper futures should be shorted. That is the answer. Now say what is the second one? What is the hedge ratio? Hedge ratio is 0.5. Then what is the second question? What is the amount of copper it should short? The quantum of copper is 5 metric ton. Then what is the, if initial margin is 8%? If initial margin is 8%, what is the margin deposit? They didn't ask it, but that is what they meant when. Margin to be deposited is 474 into 5 into 1000, 5 metric tons into 8%. 474 into 5 into 1000 into 8%. You have to deposit 1,89,600 as initial margin. Rupees is initial margin. What did they ask here? What is the ratio? What is the amount of copper you should short to achieve a perfect trade if initial margin is 8%? So what is the initial margin? You have to give the initial margin value, which is 1,89,600. That is what is the answer. Okay. Now this is a weird kind of question which we have not encountered anywhere, which has not been explained in any of the book ICA study material, but it's a good and important question, which is why I wanted you guys to solve it. Okay. Now we have done question number 29. Let us move to question number 30. Question number 30. This is a good question. Let us move to question number 30. What is this question? On August 1, 2023, an investor has a portfolio consisting of 5 securities. By the way, this is November 23 actual exam question. There are 5 securities A, B, C, D, E. There is a market price. Each one has a number of shares. There is some beta. The cost of capital for the investor is 20% per annum compounded. Did they say continuous compounding? We will see. The current Nifty value is 19,500. Nifty futures are available with expiry for 3 months and 4 months and are currently quoted at 19,700 and 19,900. Both of them have different codes. Each Nifty futures can be traded in units of 50 only. You are required to calculate beta of this portfolio. Very simple. Multiply. Theoretical value of futures contract expiring in October and November given e power 0.05 is this 0.06, 0.07. So they have given e power value, so you have to do continuous compounding. The number of contracts of the Nifty the investor needs to sell to get a full hedge until November for his portfolio. So this man is on 1st August. So August, September, October, November for 4 months. If you want to hedge it till November, you have to enter into the, consider it with a 4 months future contract, which is 19,900. The number of future contracts investor should trade if he decides to reduce the beta of the portfolio to 0.25. So again, I think if he is talking about 4 months, we should take that 4 months future contract to find out what is the number of contracts that you should short in order to reduce the portfolio beta to 0.25. So we have done similar kind of problems, but not exactly all of them together in one single problem, which is why I wanted to solve this. So first, let us compute the first part, which is calculation of beta. And here I will again not solve it manually because here it is more manual computation than actually understanding. There is very little computation part, so which is why I want to actually spend time on discussing that rather than doing A into B into C into D. Okay. So let us see what I mean. Price of the stock is 60. So we have copied all of this 60, 320, so on and so forth. Number of shares we have copied. Then what is the value of the entire portfolio? So you multiply 60 into 450, get this value. Same way you get all values for all the 4 stocks. What is the amount invested in each particular stock? So the total value of the portfolio is 7,80,000 here. Okay. Now you compute the individual weightage. 27,000 divided by 7,80,000, some percentage. 2,72,000 by 780, some percentage. Like that you have 5 percentages. Now you have beta. What is beta? Beta they have already given 0.87, so on and so forth. Simply multiply the weightage into the beta, you get weighted average beta of 1.2501. Okay, multiply these two, weight with beta and sum it up, you will get 1.2501. This is the first part. So beta of this portfolio we have already got. Theoretical value of futures contract expiring in October and November. Now current spot is 9,500. Have they given any dividend yield or anything like that? They have not given any dividend yield. They have just said cost of capital of the investor is 20% per annum component. So there is no dividend logic here. So for October contract, you have 3 months. October end, okay, August full month, September full month, October full month. So 3 months full. So you have to take 3 by 12, which is 0.25. Further, forward contract value is S into e power RT. So here S is 19,500 into e power time is 0.25, R is 20%. So 0.2 into 0.25, which will make it 0.05. Have we been given the value of 0.05, e power 0.05? Yes, they have given e power 0.05. So we need not compute anything, use any of these calculator tricks. 1.05127, 1.05127, you get the value of the theoretical futures for October. Same way you compute for November also, which is 4 months. 4 by 12 is 0.33 and 0.333 into 0.20. 0.20 is a interest rate, time is 0.333 or 4 threes, you get 0.0667. Now there are two ways here. And I think that when they have given 0.06 and 0.07, what is the value of 0.667? You have to interpolate between these two values. I hope you remember the interpolation concept that you studied in CA Inter FM chapter. So for e power 0.06, it is 1.06184. E power 0.07 is 1.07251. So I'll write it here. E power 0.06. Sorry, it is plus only. 1.06184. E power 0.07 is 1.07251. The difference between these two, for 0.01 movement, 6 to 7 it has gone up, this value has gone up to 1.07251 minus 1.06184. It has gone up by 0.01067. Whereas we need per 0.0067. Why? We are looking at e power 0.066667. Okay. So 2/3 of this value, 2/3. That you have to add to this. That's all. So 0.01067 into 2 by 3 plus 1.06184. So you will get this value is 1.068953. Is that what we got? 068953. Okay. That you multiply with 19,500, you get the 4-month future contract. This is also over. This is also second part. Second part is done. Now the number of contracts of Nifty you need to sell in order to get a full hedge until November. So when you look at this third part of the question, to get a full hedge, what is the number of contracts? Please do not make this mistake of using 2844.59 for your answer. You have to use 19,900, which is the 4-month future contract value. So please do not use the 20,000 what you find out. In a hurry burry you do that, gone, marks gone. How do you find out the number of contracts? 7.8 lakhs into 1.2501. This is basically the value of the portfolio into beta is equal to beta of the Nifty index into index future value 19,900 into 50 into number of lots that you are going to buy. This is number of lots, and this is number of lots or number of future contracts. Okay, each lot has 50 units. So you multiply 7,80,000 into 1.2501 divided by 19,900 divided by 50. You get 0.97997. Approximately one lot. One lot has to be shorted. Approximately one lot has to be shorted. 0.9799, one lot has to be shorted. Then, what are they saying? The number of future contracts you trade if you desire to reduce the beta of the portfolio to 0.25. So, if you want to reduce the beta of the portfolio to 0.25, then the summation of beta of what you have gone long plus or rather minus of the beta of what you have gone short, both should give you a beta of 0.25. So 7.8 lakhs into 1.2501 minus 9,900 into 50 into y into 1 should give you 7.8 lakhs into 0.25. This is what you should do. So you have to solve for this y value. Okay. So 7,80,000 into 1.2501 minus 7,80,000 into 0.25. So basically 7,80,000 into 0.25. Basically you can take 7,80,000 common. So you will take 7,80,000 into 1 divided by 9,900 divided by 50. You will get 0.7839 lots to be shorted. How did I get this? 7.8 into 1.2501 minus 7.8 into 0.25 divided by 19,900 into 50. This will be the value of y. So you'll get answer of 0.7839. Again, one lot, you have to round it out. So 0.78 lot to 78, which is one lot. So whether it is October or November, they have not told, but I am taking November only because the logic is that their previous part they have asked for November. Okay, if you want to solve for October also, you can solve and leave it. Okay, so this is how you solve a problem like this. I wanted to specifically show it because this was asked in November 23 and this is a super simple question. Okay. Now, in addition to this, are there any other questions? These are the important questions. If there is any additional question, I think there is one more question that I want you guys to have a look. It is question number 6. It is question number 6, which is about please construct a arbitrage strategy. Question number 6, where is it? Yes. The share of X Limited is currently selling at 300, risk-free rate is 0.8%, 3-month future is at 312. Develop an arbitrage strategy to show what the riskless profit will be for 3 months, assuming they will not pay any dividend. What is arbitrage strategy? I told you. Very simple. Whatever is costly, sell. Whatever is cheap, buy. Now, if future contract is currently selling at 312. That is the current market price. Is it really high or is it low compared to theoretical price? So, first you have to find out theoretical price. How will you find out theoretical price? 300 plus 0.87 per month. So, 300 into 0.8%. Here it is simple compounding. It is not continuous compounding. So, 2.4 is the value that gets added and it is a 3-month contract. So, 2.4 into 3 is 7.2. 7.2 plus 300 is 307.2. Ideally, the contract should sell at 372, but it is futures contract is getting traded in the market 312. So whatever is costly, sell. What is costly here? 3-month future is costly, sell. So sell the 3-month future contract. Okay. And here I have done in all 3 methods. If you do compound interest, if you do continuous compounding, what will happen? In this question, they have not mentioned it. So I have initially done a very simple computation of 7.2. Okay. If you want to do compound interest, which is 1.08 power 3 or e power 0.08% into 3, you can do either way. You will get very close answer only because time is very small, interest is also very small, the answer will not differ. So you should, on day 0, you short futures. There is no cost attached to it, just short. Then you buy the stock. Buy the stock at 300, but for you to buy the stock, you don't have money. So you borrow money at 0.8%. You borrow money at 0.8%, you get 300 rupees. Using that, you pay and buy the stock. So you now have the stock and you have shorted a future contract. Now, on maturity, what do? Whatever you have shorted the future contract, you have to deliver the stock. What will you deliver? You already have a stock that you purchased. So the existing stock that you have, you deliver against the future contract. And how much money will you get? You will get 312 rupees. And with that 312 rupees, you have to repay the loan. What is the loan that you have taken? 300 rupees is the loan, plus you pay 3 months interest. What is 3 month interest? 7.2 rupees. So you repay, out of this 312, you repay 307, you are left with 4.74 as your cash flow. This is riskless, no arbitrage way to make profit on this particular transaction. Now, what is the other way? What is the other way? And have they asked anything else? No, they have not asked anything else. Now, if it is ulta, that is 3-month future is not 312, but let's say 30, instead of being 307, it is 305. What will you do? Whatever is cheap, buy that. So if spot is 300, future is 312, ideal future is 307.2. In this case, you short future and borrow and buy stock. If it is ulta, spot is 300, future is 302 and ideal future is 307.2. Then what do? Then you buy future. Because you don't have money to borrow. So basically you are buying future. So you have to sell on spot. So sell on spot, short sell on spot, invest money. So when you short sell, you actually are delivering, you are borrowing a security and selling it to somebody. Okay, assume that the short selling cost is 0. So you are selling it off to somebody, you don't have any interest cost attached to that borrowing, but you get the money. How much money do you get? You get the money of 300. Okay, you invest that money. With this money that you have invested, you will keep that money, put it in deposit. Basically, investing is deposit only. And whatever future you have purchased, on the due date, you will get the stock. That stock you will deliver against the short sale and close the contract, which is what I have explained here. If 3-month future price is 303 instead of 3, I said 302 instead of 302, let's say it is 303. Then what do? Buy future contract, sell the stock by shorting it, there is no shorting cost. Then whatever money you get on shorting, you invest that money in deposit. On the due date, the deposit matures and you get 307. Whatever future you agree to buy the stock at 303, you out of this 307 you pay 303 and take the stock. That stock you deliver against the whatever you have shorted and close out the short contract, and you are left with 4.26. This is the contra way. Okay, this is one additional problem which I think I did not give in important list questions, but if you want, because how do you create an arbitrage strategy, this is what you do. Okay, so this concludes the part with respect to futures and forwards. Now let us move to the options revision part, and then we will complete this entire chapter. Okay, in options also we have some 7-8 questions. Let us go and have a look at them. So friends, before we actually move to options, there are 2 questions that we actually have are required to cover. In fact, which if you remember correctly, I said that we'll cover them towards the end. What are these 2 questions? We have already discussed about this margin and solved problems. Now, after having solved these problems, it is very easy to figure out. What is a single stock future and index future? Index future is something which is representing an index. What is single stock future? It is representing a stock like HUL or Reliance or HDFC Bank or whatever. A single stock is standard futures contract with individual stock as underlying. So basically, an individual stock is underlying. These stock futures do not carry voting rights or dividends. Each contract is comprised of specified lots, which we know. When futures contracts anyway don't have voting rights. The contracts are standardized, making them liquid. To get out of an open long position, the investor simply takes an offsetting position. Conversely, if you have sold a short, if you need to close it out, you go long. So basically, it's normal stuff. If you go long, you do in order to close out. In order to square off, you do short. Index futures, stock market is made up of a basket of stocks that indicate general movement of stock prices. A contract for stock index futures is based on the level of a particular stock index, such as S&P 500 or a Dow Jones Industrial Average, or Nifty or BSE Sensex. Stock index futures may be used to either speculate on equity market general performance or to hedge the stock portfolio against a decline in value. These futures are not based on tangible goods. That's all settlements are in cash. See, as far as stock market is concerned, both index futures as well as single stock futures, both are net cash settlement only. There is no delivery. But one of the things about index futures is you can use index futures to hedge your other portfolio risk. We looked at those problems where we do beta, ensuring that the beta of the portfolio comes down or increases or decreases. You typically use index futures to hedge the risk of a portfolio. This is a key point you have to highlight if this question is asked. Whereas in case of stock futures, those are typically used only for hedging the position of the stock. You don't try and use one stock future to hedge something else. That is very unlikely. You would rather use an index future. Okay, this is a key difference that you have to highlight in this. Then why do people trade in futures? Speculation basically involves I take a risk, I want to make some money. Hedge, mitigate risk against investment. We discussed this also. Then these are 2 large things why people trade in futures. Of course, you have this arbitrage activity also. What are advantages of futures trading versus stock trading? Compared to stock trading, that is you buy and sell stocks, what is the advantage of futures? First, it adds flexibility and works as hedging tool to one's investment portfolio. See, it is one more way to hedge. That is, futures trading can help you hedge against any adverse movements or of HUL stock. It creates possibility of speculative gains using leverage because of relatively smaller margin amount. So this is the point that you have to understand. See, when you are buying a stock, you have to pay the full amount and buy the stock. But when you are entering into a futures contract, you have to pay only that initial margin and are required to maintain maintenance margin, and that margin is 10% or so. So by putting in 10% of the money, you can participate in the entire gains of the movement of that particular stock future or index future, whatever it may be. So the ability of a derivative is leverage. It gives you leverage. Leverage means debt. So by putting in 10% of the total money, you can participate in the full gains of the movement of a particular stock or index. Then in stock index futures are most cost efficient hedging devices. They cannot be easily manipulated. They are very cost effective because stock futures, they are efficient because index futures, typically index cannot be manipulated easily. Okay, you can manipulate a stock, but you can't manipulate 50 stocks. That too large cap stocks. So manipulating index stocks is difficult. Second, index has lower volatility because if one sector moves up, something moves down. So basically volatility cancels out and it has lower volatility. So basically the margin that you put for an index future versus a stock future is largely different. So index future will have lower margin requirement versus a stock future. stock index is less volatile when compared to individual stock price, and the stock index futures will be cash settled only. So all stock index futures are cash settled. It provides hedging or insurance protection for stock portfolio in a falling market. So that's what I was telling you. You can use it to hedge the portfolio what you have in a falling market. Okay, so that is one thing. So these are the things that are advantages of futures trading compared to stock trading. Now let us move to options. There are about 10-11 problems. We'll solve in options problems also. But before we go there, we have to understand certain things, key terms. I know this is a revision class, but basic terms I will try and explain to you before we actually jump into the problems, because I don't want to directly jump into the problems. There is some basic context I'll give, then we'll solve problems, then again we'll come back to some theory, then we'll go to problems. So we'll follow a rather structured approach. So first is options. Options are of two types. Okay, call, put. Call is a right to buy. Please note, it is not an agreement. In your forwards and for future contracts are agreement, that is you will compulsorily buy. Here you have a right, there is no obligation. Put is a right to sell. That is no obligation to sell. It is at your choice. At your choice or option. You can choose to, if you want, you can exercise the option and buy. If you want, you can exercise the option and sell. So a call option is useful when stock price goes up. So options are also again in stocks, indices, currencies, a variety of asset classes. You have options. Think of a stock option. You have ICICI Bank stock. You have ICICI Bank stock. Let's say, I don't know the current price, I'm just taking a random number, 500 rupees. Today's the stock prices on 11x1, it is 100 rupees. Now this price you think may go up, but it may fall down, you don't know. So you are saying, I'll pay you 10 rupees, give me a right to buy ICICI after 1 month at 550 rupees. So I'll buy at 550, after 1 month, I'll pay you 10 now. This 10 is called premium. And this 550 is known as strike or exercise price. It's denoted by K or X. This is denoted by premium. This is known as spot. This is known as spot. Now this is a call option. You have a right to buy. So what is the expectation here? ICICI will go up beyond 550. It will go up actually by 560 or more. Why? Then I will buy from you at 550, and 10 initially that I have paid you, I have already paid you, is my expenditure. So 550 plus and 560. So ICICI will definitely be 560 plus, which is why I am agreeing to buy it from you after 1 month at 550 by paying you 10 rupees in advance. Why am I paying 10 rupees in advance? Because I can choose not to buy. Why not to buy? If market falls and ICICI let's say is 450, you will say, okay, it is there. Okay, I am choosing not to buy. So you have an opportunity, an option to say, I will not buy. If it is against you, instead of moving from 500 to 570, if it moves to, or 560 or 570, it moves to 450, you will say, okay, no problem, my 10 rupees gaya, I will leave my 10 rupees. You keep the 10 rupees, no problem, but I will not buy. So this is optionality. So a call option is a right to buy, a put option is right to sell. What is put option? Put option is exactly ulta. That is, I have the right to sell it to you at 500. Same ICICI. What do you think? Why do you think you will enter into a contract like this? Because you believe that at a future date, the ICICI might fall down to 450. So I have a right to sell to you at 500. Right now, I will pay you 10 rupees. On that day, if I want, I will sell to you or I will not sell to you. So if I can sell to you at 500 and the market is 450, I make 50 rupees gain. Even though I have incurred 10 rupees initially, my net gain is still 40. This is how you look at it. Okay. So now in this, both these things, right? Call, put, spot, let's say is 500, 500, strike price is 550, let's say is 450, premium is, let's say, and premium is denoted by C0 is equal to, let's say, 10, P0 is equal to 10. This is buy call, buy put. Okay, in both these, if let's say market price on ST, that is on due date, okay, is let's say 600. Okay, here also it is 600. Then what happens? Your gross payoff. What is gross payoff? I have a right to buy at 550. Market is at 600, so I am making a 50 rupees gain. Here, what is the payoff? I have a right to sell to you at 450, market is at 600, I will sell it in the market, so I will not exercise it at 450, so payoff is 0. What is the premium paid? Minus 10, net payoff 40 and minus 10. From the option, because of exercising the option, what is the payoff that you are computing? Or not exercising the option, what is the payoff? Right, now this is how you look at it. Now there are some couple of more aspects that are linked to it. You can buy a call. When you are buying, there is other party who is selling. So you are called buyer of the call, other party is called seller of the call. If you have to cancel this contract, after buying a call, if you want to cancel, you have to sell the call. For same thing, for your strike price has to be same, spot can be different, premium will be different. So you enter into a call option on day 1 for month end maturity on, let's say, HDFC stock to and the strike price of the HDFC is 550. If you have to cancel the contract, if you have to cancel this call, you have to sell the call. So again, you have to enter into a month end contract, you have to enter into a sell call, same strike price of 550. That is when you cancel it. You can't enter into a strike price of 700 and say they both cancel. No, that is a different contract, this is a different contract. As long as the contract maturity and maturity exercise price are same, premium will be different, today's spot will be different. But as long as these two are same, you can use one to cancel the other. That is, you buy the one thing, you can sell the same thing and cancel it. You cannot, and this is also called as squaring off, right? Now, you cannot cancel a call with a put. Call is a right to buy, put is a right to sell. Both are independent. I buy one call, I buy one put, they go and cancel each other. No, it doesn't happen that way. You have a right to buy, you have a right to sell. Okay, this right to buy you have purchased. You have to now sell this right to buy. You have purchased the right to sell. Now you have to sell this right to sell. Please remember this one aspect. Then there are two types of options. One way is call and put. Other one is American and European. What is American? American is, I have a right to buy ICICI stock at 550. Let's say time is 1 month. Any time in next 1 month, whenever I want I can buy. During this 1 month, anytime I can buy. Whereas European is on the last date of 1 month only I can buy. So American means anytime. Please remember, American means anytime. European means only on expiry date. Last day of the contract is called expiry date. So American is anytime, European is expiry. So an option, call option can also be American, put option can also be American. Okay. Then one more way to look at options. These options are called in the money, at the money, and out of the money. What is in the money, at the money, out of the money? So let's take a buy call. Okay. Spot is 500, K is, I have a right to buy it at 550. Now, on the day when I made the purchase, it is out of the money. Why it is out of the money? Because I have a right to buy something that is not in profit as on date. See, as on date, what is the difference? On day 0, stock price is 500. You have a right to buy at 550. Will you buy? You will not buy, because if you can buy in the market at 500, why will you execute this or exercise this option and buy at 550? So, if market is at 500, the option is out of money. You are not making any profit. It's called out of the money. If market is at 550, then you are called at the money. That is, you are making profit now from this point onwards. If let's say the market is moved, that is the spot price. This is on spot price on day you purchase. Then day 1, day 2. On day 2, spot price increases to 600. Spot price means the rate at which the HDFC stock is trading in the market, or any stock is trading in the market. So at 600, it is in the money. That is, I am making a profit now. Why? Because I have a right to buy it at 550, whereas market price is at 600. So I have a right to buy at 550 and make money extra 50 rupees. This is one more way to look at these options. Right. Now, how are these options valued? See, in case of a future is equal to spot into e power RT. That's what we said. Forget RKSR, that dividend, storage and all that, keep that aside. This is what we discussed. In case of options, how is it? So we will come to option valuation. There are a bunch of techniques, but before we come to option valuation, which is actually what is usually tested in exam, I want to explain some other important concepts which are very, very important and required. Let us see. European option, it gives the buyers a chance to exercise the contract only at maturity. There is no freedom for an early exercise. Whereas American option is one allows to exercise the option at any time, including the date of expiration. It allows an investor to capture profit as soon as the asset underlying price moves favorably. So American anytime. What are stock options? Basically on stocks like HUL, RAL, ICICI and all that. They have no commitments on the parts of the buyer of option contracts, individual to purchase or sell stock. It is usually exercised by buyers only in case price of the stock is risen above specified price or fallen in case of put option. These options are just contracts that give you right to buy or sell a stock at a specific price. Basically, they're explaining what is how an option works in case of a stock. In case of a stock index, these are for indices, index values. So I have a right to buy Nifty index at 80,000. So I have a right to buy Nifty index at 30,000, 20,000, 50,000, some number. So in case of stock options, it is on the value of the price of the stock. Whereas in case of index options, it is on the Nifty or Sensex or any index value. So we have options on multiple kinds of assets. Then how do various things impact option prices? So let us see first. You have something known as spot, then you have something known as strike, then you have something known as premium, then you have something known as time, then you have something known as volatility. These are all the things that impact the price of an option. Now, how they all impact, we will understand when we look at Black-Scholes or when we look at your binomial model, risk neutral model, all of that will come to it. But these are the various factors that affect. In addition to this, there are some other factors also, they all will affect. In fact, interest rates also is there. Interest rate. All these will affect the price of an option. Spot, strike, premium. Premium, it doesn't affect, premium is an outcome. We are actually valuing the option. So all these will affect the price of the option. I stand corrected. So spot, strike price, time, volatility, interest rate, they all affect the price of the option. Okay. Now one more point I wanted to highlight in this. What is the payoff of a call? Let's say buy is equal to max of 0. So either you will make no profit or you will make profit. You will not make a loss, which is why max of 0. If there is a loss, 0 will come under this max within the bracket. So maximum of the loss or 0. So 0 will be the gain or payoff from the particular option. So 0 comma your spot on due date minus the strike price. So I have a right to buy something at 550, market is at 600. So 600 minus 550, 50 is profit. So max of 0 comma 50. If let's say the market is at 500, then 550, then 500 minus 50 is minus 50. So max of 0 comma minus 50 is 0. So you will not exercise the option. Why? Because the market rate is 500. Why will I buy from you at 550 when I can buy from the market at 500? So this is the payoff of a call option, payoff of put option. I have a right to sell. So max of 0 comma k minus st. So k or x, okay, it doesn't matter. So if market price goes below a certain level, I have a right to sell to you. So if it is going below, so instead of I have on the day when I enter into the contract, the rate is 600. So let's say the strike price is 600. I have a right to sell to you at 600. Let's say the market the price is only 550. So 600 minus market price of 550, 50 is the profit. Let's say market price is 700. Why will I sell to you at 600? I will sell in the market at 700. Why? Because it's an option. So this is max. Now this is the payoff for both buy. Now what is it for sell? So I have a right to buy, means somebody is obliged to sell whenever I exercise my right. So in case of a sell call, the formula is minimum of 0 comma k minus st. Exactly this becomes ulta. It instead of maximum, it becomes minimum and it becomes k minus st. Why? So if you have a right to buy, it means I am obliged to sell. So let's say the market price is 600. Okay, I am a buy call, I have a right to buy at 550, meaning you have to sell to me at 550. You have to sell to me at 550 even though market price is 500. So you have to sell to me at 550 even though the market is at 600. So you make a loss. You as a seller of call option, minimum of 0 comma minus 50, minus 50 will be the value. So you will make a loss of 50, whereas I will make a gain of 50. Okay, exactly ulta happens for put also. Put will be minimum of 0 comma st minus k. St minus k. What does that mean? I have a right to sell to you at 600 even though market price is 550. So if market price is 550, I will sell to you at 600. So 550 minus 600. 0 comma this minimum. So you have to bear the loss of 50, which is minus 50 here. Okay. So these are the things that you should remember. Even if you don't remember the formula, you can normally logically think and you will get the answer. Okay. So no need to worry about that. Okay. This is done. Now let us look at other aspects. What is the impact of current spot price on pricing of an option? This is where we were. So as I said, spot, strike, time, volatility, interest rate, all of them increase. All of them impact the price of an option. So if the spot keeps increasing, increase in current market price. Call option value will increase. Why? I have a right to buy from you at 500. The market price will become 600, 700, 800, 900, 1000. So my right to buy, whatever I will exercise, and then I will make a profit. The profit that I make is basically the price of the option. Okay, this is in case of call option. In case of put option, what happens? I have a right to sell to you at 500. Market price is 600, 700, 800, 900, 1000. So as the market price keeps increasing, I don't make any money. So the put option loses its value. Exactly ulta happens when there is a decrease in market price. So call option decreases in value and put option increases in value. What is the impact of strike price and option? So in the money options, I told you, in the money, where there is more profit, they are highly priced. Out of the money, they are very, very cheap. And at the money, they are cheaper than in the money options, but costlier than out of the money options. So they are somewhere in between. Now, why are they priced like this? We will discuss. What is the option price? What does it consist of? I will come to all of that. But first, let us look at other aspects. Greeks, all of these will come back later. This is broadly what I want to discuss before we jump into problems. We will first discuss a few problems and then come back. Okay? Let's look at illustration 3. We have 3, 8 and 11. These are 3 illustrations, first 3 illustrations that we are required. So first look at illustration 3. Equity share of PQR is presently quoted at 320. The market price of the share after 6 months has following probability. The share has following probability. Please note, in this entire options questions, you are given price and probability, you should never multiply both. That is a fundamental principle. In fact, in most of the cases, even when you look at in Forex chapter also, you should never directly multiply price into probability. You should first wait, take 2 deep breaths and then take a decision. Okay. A put option with a strike price of 300 can be written. You are required to find out the expected value of the option at maturity. So, when you are given data like this, you should not multiply price with probability and then arrive at, do all the probability multiplication, arrive at a weighted average or expected price and then say that, option is in the money, out of the money, what is the value of the option. No. You should basically compute individually at each level. So, after 6 months, if price is 180, 260, 280, 320, 400, then there are probabilities. Okay. Then you should not do this, which is 180 into 0.1, 180 into 0.2, all of this you should not do. What you should do is, you have a right to sell. Put means what? Right to sell. You have a right to sell at 300. So, if you have a right to sell at 300, when the market is at 180, you will make 120 profit. Then you have a right to sell at 300 when market is 260, 40 profit, 20 profit, 0, 0. Okay. So, you have these multiple levels at which you can make, at which what are the various payoffs that you make. This payoffs you should multiply with probability. That is the whole point. So, 120 into 0.1, 40 into 0.2, 20 into 0.5. After that 0, 0 doesn't matter. So, 12 plus 8 plus 10, which is 30. So, the expected value of the option after 6 months on the date of maturity is 30, not 300 minus 282, which is 18. If you have got 18 as the answer, it is wrong. In this chapter, Forex chapter, please remember, do not multiply probability with the stock price to get the value of the option or value of the future or whatever you are doing. Please always at each level compute what is the value or a payoff that you get on exercising the option, multiply that payoff with the probability. Okay, this is question number 3. Before we move to question number 8, what is question number 8? This is a binomial model question. So, we have to first understand how to value options before we jump into this question. Okay, now we have to first understand option valuation. The option has 2 things, intrinsic value plus time value. This is what the premium is. When I said C0, P0 and all that, C or P or whatever, it contains 2 values. What are these 2 values? Intrinsic value means, if let's say I have a right to buy, I am taking call option, buy call, spot is at 500, strike, I have a right to buy it at, let's say 450. Let's say this is today's rate. Okay, I want to buy it from you at 450, even though market is at 500. How much will you charge from me? You will charge me minimum 50 rupees. That is difference between these two. Plus, you will say, the market is at 500, it may go up to 600, 700, 800. There is some probability attached to how much it can go. So, I will, over a period of time. So, intrinsic value I will put 50 plus that time and the volatility what the stock exhibits, because of which it may go to 600, 700, 800, I will multiply with those probabilities and volatilities and I will figure out what is the time value. So, this time value may be anything 10, 20, 30, 40. This is how an option is valued. I'm not saying valued, this is how an option value, or this is what an option value consists of. An option value consists of these two things, intrinsic value and time value. Now, how do you value an option? There are methods. Binomial method, risk neutral method, and Black-Scholes method. 1, 2, 3. There are 3 methods here. You have to, so in question they typically in exam they ask you which kind of method to follow also. Okay, Black-Scholes very rarely they give, but binomial and risk neutral they have asked multiple times. In binomial also again there are 2, delta shares approach or portfolio equivalence approach. We will understand what each of those is, how it works and all that. Then you have this risk neutral approach, then you have this Black-Scholes method. These are the 3 methods you use in order to value an option. An option has 2 components, intrinsic and time. So once we look at these methods, then we will understand the other aspect, which is, I was telling you, how does time impact, what is the impact of strike price, how does volatility impact, all of that will come. But for that you need to understand this theory. Let us first understand how an option is valued, then we will solve problems on that, then we will come back again here. Okay. So friends, now let us look at these 2 approaches. One is delta share approach, other one is the portfolio equivalence approach or replicating portfolio approach. We will see both these methods. Now, these methods are very closely linked to the risk neutral method, and eventually all of them tend to this Black-Scholes method. And in both this binomial method as well as risk neutral method, we will consider 2 alternatives, or rather we will look at the portfolio from 2 angles, or we will, so when I say 2, you will understand when you look at the examples that I will take. Okay, now I will take one common example to explain to you all these 3, delta shares, portfolio equivalence and risk neutral. All 3 I will take one example. Each same example I will solve using all 3 methods. Okay. Now let us say we are trying to value a call option. Okay, call option, and current price, and I will not take the name of the stock, some stock of X Limited. The spot price we got denoted by S0 is, let us say, 100 rupees. Okay, strike, which is denoted by X or K, that is you have a right to buy this at certain price. Okay, let us say the price is 105. Okay, then let us say you buy the call option. You are buying the call option. What is the price of the call option? We don't know. This we are supposed to find out. Okay, how we will find out? Using one of these 3 methods. Okay, then time period. Time period is, let's say, 1. That is 1 year. Okay. And let's say risk-free rate of interest. There is a risk-free rate of interest which, let us say, is about 5%. Okay, then we make one more assumption, which is the share, right? This share is expected to go either up or down. There are only 2 probabilities. There are only true probabilities. What are these 2 probabilities? It will go up, it will go down. What will it happen when it goes up? If it goes up, it will achieve share price of 120. If it goes down, it will go down to 80. Okay, there are these 2 probabilities. I will call this as S0U. I will call this as S0D. Okay, it goes up, it goes down. I am denoting this by 2 numbers. Now, given this information, can we find out what is the price of a call option for you to buy it at a price of 105? At a price of 105, what is the value of the call option? That is, you have a right to buy at 105 after 1 year, and this is again European call. Okay, when the risk-free rate of interest is 5%. So when you look at a question like this and they want you to solve using delta shares. Delta shares. First, you have to understand meaning of the word delta. This is delta. Delta means it is equivalent to hedge ratio, and it basically refers to change in option price due to change in underlying stock price. So in our first case, let's say our stock goes to 120. What will be the value of the option? See, I am asking you, what will be the payoff? Okay, we will come back to the price of the option. What price will you buy? We will come back. But first tell me, what will be the payoff of this option? See, if I have a right to buy it at 105, when the market is at 120, I am making 15 rupees straight profit. Then in the second case, when I have a right to buy at 105 and market is at 80, I will not buy anything at all. Why? Because I can buy it in the market. At that point of time, the option payoff is 0. So the option is moving from how much? From 15 to 0. That is the payoff of the option. The change in the payoff of the option is 15 to 0. So delta is equal to 15 minus 0, which is CU minus CD divided by what is the change in the stock price? The stock price has changed from 120 to 100. We are not bothered about the initial stock price. Please pay attention. We are bothered about the ending stock price, what is happening. Because of the change in stock price from 120 to 80, that is a change of SU minus SD, right? That is a change of 40 in the denominator is giving us a change of 15 in the numerator. Okay. So the option, the delta here refers to 15 by 40, which is what? 37.5, if I'm not wrong. Yes, 37.5. So delta 37.5%, or usually you denote it as 0.375. So please note, delta is always less than 1. Delta is always less than 1. And what do we mean by delta? Delta here means the number of shares that you should take in order to fully hedge an option. Please note, delta or hedge ratio here. Hedge ratio refers to number of shares one should have in order to hedge a position in options. So what are we saying here? What we are saying here is, let's say I have one option, and instead of buying an option, let us say I have sold an option. One call option sold. So if I have sold one call option, on the upside I am making how much money here? What is the payoff? 15 rupees. Okay. Upside I am making 15 rupees. Downside I am making 0. This is for making is for whom? Buy call. Whereas if I have sold a call option, for a sell call person, on the upside he is losing 15 and on the downside he is losing 0. Correct? Whatever is profit for buy call is loss for sell call. So the buy call person is making 15 rupees on the upside, and so a sell call person will lose 15 rupees on the downside. Now here I am referring to the gross payoff. Please ignore the cost of the option. We will come back to the cost of the option. You will understand it why I am saying that. Okay. So a sell call person will lose 15 rupees. So now if I have sold an option, forget how much. If I have sold an option, I will get premium. Forget what premium I have got. Okay. We will come back to the premium later. If I have sold an option, I need to enter into some other contract such that when I make a loss in option here, 15 rupees that I have to make payment to the buy call person because I am a sell call person, I need to get compensated by change in some other asset. And what is the asset? Same stock. The stock of which company here? We said X Limited or something, no? X Limited. So if I have delta shares, that is 37.5% of one share or 0.375 shares. If I go long means I buy, and parallelly I go short on one call, then this will be fully hedging. It will be perfectly hedge my call movement or the loss that I will generate on call. Let us see what I mean. So let us look at this portfolio. Minus one call plus delta shares, right? Minus one call plus delta shares. Now, if I have this portfolio, what is the cost of this portfolio? Cost of this portfolio. When I sell a call, I will receive money. Okay. So, premium, which is a receipt, and I am spending some money. What is the money that I have spent? I have acquired some share. The share current price is how much? Share current price we have written somewhere, 100 rupees is the current share price of the share. So money is gone out for 37.5% of share. So the value of this portfolio is P plus 37.5. Correct? Why 37.5? 0.375 shares I have purchased plus delta. And what is delta? This is 0.375 or 37.5%. 0.375 into 100. Okay, so that is how I got 37.5. This is the value of the portfolio today. Now this is first step. Now come to second step. The same portfolio, what is the value of this portfolio? What is the value of this portfolio in SU case? What is SU case? Stock is 120. My call option, I have a payoff. The payoff is how much? Minus 15. Why minus 15? Because I am a sell call person. I have to make payment of 15 rupees and the share is 120. So I have minus 15 cash flow from this portfolio plus 0.375 into 120. Correct? Then third case is SD case, where the share price is 80, in which case my call option is worthless, so I don't have to make any payment on the call option. So it is, the value of the call is 0 plus 0.375 into 80. Now let us see what happens. 0.375 into 120. 0.375 into 120, which is what? 45. 45 minus 15 is how much? 30. Correct? This is 45, this is minus 15, 30. Then 0.375 into 80 is how much? 0.375 into 80 is how much? Is 30. So, because I have hedged it fully by, when I have shorted a call, I have purchased delta shares. On either case, that is when the stock price goes up or the stock price comes down, my portfolio is having the same value of 30 rupees. The portfolio is having same value of 30 rupees. Okay, whether it goes up or it goes down, my portfolio is having same value. Okay. Now, if a portfolio has same value in both the cases, portfolio value in up also 30, in down also 30. So, this kind of a portfolio, irrespective of volatility, portfolio value is same. So, that kind of portfolio is what kind of a portfolio? It is a risk-free portfolio, correct? It is risk-free. If it is a risk-free portfolio, what returns will it generate? Generating risk-free returns. If it is generating risk-free returns, we have taken here risk-free rate as what? 5% if I am not wrong. 5% for 1 year. So, if it is generating risk-free returns, ending value of portfolio is 30. So, beginning value of portfolio is 30 by 1.05. Why? 5% is a risk-free rate. What is 30 by 1.05? By 1.05, which is 28.57. Beginning value of portfolio is 28.57. Then what is the equation 1 here that we have noted down? Cost of the portfolio is P plus 37.5. So, minus C because you have sold a call plus 37.5 is equal to 28.57 implies call is equal to 37.5 minus 28.57, or the call value on day 0 is 8.928. So, I will take it as 93. I will take a round number. Call price is 8.93. So, I told you two things. Because you have delta shares, the value of portfolio is not changing. So, you are perfectly hedging. When you have a perfect hedge, that kind of a portfolio will generate only risk-free returns because it is not having any risk. Because it is not having risk and generating risk-free returns, the ending value of the portfolio divided by the risk-free 1 plus risk-free rate will give you the beginning value of the portfolio, which we equated to the beginning value of the portfolio, which is what? Which is this, which is P or minus C. You can call it as premium or you can call it as minus C. Okay, minus C because you have sold a call. Okay, you have sold a call and you have purchased this one shares, 0.375 shares. So, this portfolio value is same as 28.57. So, you will get the value of the call option as 8.93. Now, this is one way where you use delta shares and say that there is a portfolio is going to generate a risk-free return, and hence you arrive at the value of the call. This is one method. This is method number 1, which is the one This is what it is. Now, we will come to second method called portfolio equivalence or replicating portfolio. Okay, replicating portfolio, that is a better way to remember that. Replicating portfolio. In this, we take the other example. Here we say there are two portfolios generating same return. Then portfolio same return and same ending value. Then portfolio will have both portfolios. Then both portfolios will have same beginning value. So this is the principle of no arbitrage. That is, if you put 100 crores in one portfolio and 100 crores in another portfolio, okay, if both are generating 5% return, both of them will be 105, 105. Ulta, if you look at it, if there are two portfolios which have same ending value 105, 105 and are generating same returns, then they both will have same beginning value, right? So this is normal logic only. There is nothing fancy about it. Same thing we are going to use in this particular scenario, or rather in particular method, saying that we are trying to value two portfolios, or we are trying to look at two portfolios and equate the beginning value of both the portfolios. So let us see what I am saying here. You take delta shares plus loan. So this word delta is never going to go away. Same delta, whatever you used in the previous. Delta share plus loan. Okay. Now, what is this loan? And loan again will be negative value, so don't worry about it. Delta shares plus loan. How much loan? We don't know. Let us see whatever that loan value is. We will figure that out. You buy delta shares. What is delta shares? Delta is 0.375. Okay, we know, right? So 0.375 shares plus a loan. Now, assume that this loan, this portfolio is giving return same as call option. I am saying there are two portfolios, both of which are giving same return. So their ending if their ending values are same, then their beginning values are also same. Okay. From same logic, I am now saying one of these portfolios is loan plus share, another portfolio is a call option. These portfolios, if they both have same ending values, then they will have same beginning values. This is the logic I am bringing. Okay. There is a option, there is delta shares plus loan. If they both have same ending value, then they both will have same beginning value. Correct? So what happens is, let us say delta shares plus loan has ending value. What ending value? This is the portfolio. Let's say ending value in scenario SU. In scenario SU, when the share price is 120, if you recollect these numbers here, what we wrote here and all that. $120 and 80. So in this scenario, payoff of the call option in first case is 15. Same portfolio, delta shares plus loan in second scenario has a value of 0. So what is the current value of this portfolio on day 0? This is on SD scenario. On S0, what is the value of this portfolio? Delta shares. Delta share is, each share is 100 rupees. So 0.375 shares. So 0.375 plus loan. Okay. Initial date, this is the value of the portfolio. In SU scenario, what is the value of this portfolio? This value of this portfolio is, you have a share. See, here when I say 0.375, I am referring to I have a share whose value is 100. Correct. That is why I am arriving at 0.375. In SU scenario, you have the same 0.375 shares. Each share is worth how much? 120. So 0.375 into 120 is how much? 45. In SU scenario, the value of this portfolio is F plus future value of the loan, correct? Because loan, you have on day 0 it is loan, after 1 year it is future value of the loan, that is including interest, right, which is 1.05 into loan, correct, and this is 0.375 into 120. Same thing in SD scenario, what is the value of the share? 0.8 into 80 into 0.375, which is 30. 30 plus again same future value of the loan, which is 1.05 loan. We are saying this portfolio in both scenarios is going to give you same return as a call option. That is, this portfolio behaves same way like a call option. What is the call option payoff? In first case, call option payoff is 15. In second case, call option payoff is 0. Right? C value. Right? If this is the case, then let us find out what is the value of the loan. That is, you subtract one from the other. So you get 45 minus 30 is 15, future 1.05 of loan minus 1.05 loan is 15. So 15 minus 0 is 15. So on both cases you are getting the same value. So 45 plus future value of the loan or 1.05 loan is equal to 15. Then 1.05 loan is equal to 15 minus 45, which is equal to minus 30. Then loan is equal to minus 30 by 1.05, or loan is equal to 30 by 1.05, which is minus 28.57. Minus 28.57. So loan value is 28.57, and here I have taken future value of the loan. So please remember, when you are saying future value, this loan 28.57 is present value, and because it is a loan, it is in minus number. Okay. So if loan is minus 28.57, does this equation satisfy? Second equation also satisfies, first equation also satisfies. Then you have solved and arrived at value of loan, then present value of portfolio is equal to present value of call. So present value of call is equal to delta shares minus 28.57. What is delta share value? 0.375 into 100 minus 28.57, which is equal to this minus 37.5. We will get 8.93. Call value is 8.93. Now what did we get in the previous case? In the previous case also 8.93. Now also 8.93 only, no? 8.93. So there is absolutely no difference. See, this is different way of looking at things. One is you have delta shares and a loan, which is this scenario, which is giving same, the portfolio is giving the same returns in both scenarios. So hence the value of the call option will be same as the value of the portfolio in the beginning. This is first scenario. Second scenario is I sell a call and I at the same time have a shares, delta shares, and that portfolio is giving me same ending value irrespective of which way the market is moving. So that portfolio is going to generate risk-free returns. So if it is going to generate risk-free returns, then that portfolio is a risk-free portfolio. So that particular portfolio's present value, right, what did we do? Can be found out, and you can substitute it, or you can use the equation what we have here, which is call minus call plus 37.5 is the present value of the portfolio. You can equate it to the present value of the portfolio that we have found out, and you can arrive at the value of a call. So these are two methods. Now we have seen two methods. Now let us come to the third important method, and which is important method, which is risk neutral method. What is this risk neutral method? This is the risk neutral method that we are going to go through. Risk neutral method. Then we'll come to Black-Scholes. Black-Scholes is a different thing. In a risk neutral method, same example again. I am not going to make any changes in the example. In a risk neutral method, you basically draw a binomial tree. What is a binomial tree? So initially 100, it can go up to 120, it can come down to 80. This is called SU, this is called SD, this is called S0. C0 we have to find out. This is CU is 15 and CD is 0, given that K is equal to 105. And RF is equal to, we have got a risk-free rate of 5%. Given this, how you find out is, in this binomial tree, so in exam also, if they say binomial model, using binomial model, you are required to follow either this delta shares or portfolio replication approach only. If they said using a binomial tree, you have to draw a tree and follow any of these methods. If they say using a binomial tree and risk neutral, then you are supposed to follow this method. So, repeating again, if they specify binomial model, either you follow the delta shares or the replicating portfolio approach. If they say binomial tree, you have to draw this tree. If they don't specify in the binomial tree whether to use a binomial model or risk neutral model, you can follow any model. However, if they say specify binomial tree and risk neutral, you are supposed to follow risk neutral. If they don't say binomial tree and follow risk neutral, then you can draw the binomial tree and follow the risk neutral method. Okay. Now, in this method, you have a formula. What is the formula? You find out risk neutral probability. Risk neutral probability. What is risk neutral? Risk neutrality refers to the fact that you cannot, or rather a person, irrespective of the risk, wants same return. This looks data, this looks weird. Correct, it is weird. It is an artificial world. It is a perfect world where irrespective of what the risk is, my return expectation is the same. Whether the risk is, in terms of standard deviation is 10% or 50% or 20%, my return expectation is only 5%. The standard deviation doesn't matter. So, it's an artificial, mentally created world called risk neutral world. In this, you compute something called as risk neutral probability. The formula for that is 1 plus RF or e power RT. Okay. This is compounding, this is continuous compounding. I have explained to you both of them what they are. Either ways, minus D by U minus D, wherein you actually find out what are value of U and D. What are value of U and D? Value of U and D is SU by S0, SD by S0. So, this is what 120 by 100, which is 1.2. This is 80 by 100, which is 0.8. Okay. So, these are the values. So, in our case, what is going to be P? P is equal to 1.05 minus 0.8 divided by 1.2 minus 0.8, which will be 0.25 by 0.4, which is 62.5%. So, the probability of it going up, and this is probability of up. Okay. So, they are saying this probability, the probability of this up move is 62.5% and probability of this down move 1 minus P is 37.5%. Okay. Now, once these numbers are given, how do you arrive at risk neutral probability? What you are basically saying is value of the call C0 is there is 62.5% chance that you generate 15 rupees payoff, and there is 37.5% chance that you generate 0 payoff. Correct? CU is 15, payoff is 0. Okay, CD is 0. So, this is future payoff, future call. I won't say C or C0, I will say future call value. So, this will be what? 0.625 into 15, because the second term is anyway 0. This is 9.375. 9.375. This is call value in the future. Okay. If this is the call value in the future, on day 0, what is the call value? 9.375 divided by 1.05, which is 8.93. So, here also we have got the same number 8.93. Here also we have got same number 8.93. Here also we have got same number 8.93. Where is that? All three methods will give you same thing. As far as risk neutral method is concerned, what we are trying to tell is the probabilities will adjust in such a way that the payoffs will generate only a risk-free return. If you take the expected value of payoff, the expected value of the payoffs will only generate a risk-free return, and the expected value of the payoff, present value of the expected value of the payoff is the present value of the call, which is the price at which you will price the call. So it is a principle of no arbitrage. That is, I will ensure that I will price the call in such a way that this call will generate only risk-free returns when you take expected value of the payoffs. That is the logic. What is the expected value? Expected value means multiplying with probability. So we have multiplied this 15 with 62.5, this 0 with 37.5. So you are generating expected value of the payoffs. Expected value of these payoffs is going to generate only risk-free returns. So I will price the call at the present value of the expected value of the payoff. That is the logic. So there is no arbitrage. I am not allowing, I will price in such a way my option that you cannot make money. See, please, in this kind of questions, there is one very, very important point. Risk neutral probability you have to find out. Does it mean that always the price will, there is 62%, there is 37% probability it will go up, go down and all that? No, that is not a thing. Eventually something else may happen. But in a risk neutral world, this is what will happen. In a risk neutral world, this is what will happen. So this is how you are pricing. When we see a problem, I will explain, because there are problems where they have twisted this logic and given it in a slightly twisted form. Okay, what we have done, we have priced a European call option, and buy call, sell call, whatever be the case, the price is going to be the same. What you are buying, somebody is selling, right? And we have seen it in three methods: your delta shares, portfolio replication, risk neutral. Then let us, we will come to Black-Scholes towards the later part, because I need to first solve problems with respect to this, so that you are fully, thoroughly comfortable with this particular topic. Because in a bunch of exams in the last 2-3 years, these questions have been asked on this topic, where they tended to confuse the students. Okay, so now after having understood this, let us go and look at the problems. What are the problems? 3, 8 and 11. Out of that, we have already finished 3 I think. Yes, we are in 8. When I said we are at 8, that is when I started explaining this whole story. Now let us go and solve problem number 8. So friends, now let us look at problem number 8, what we wanted to do. Mr. Dayal is interested in purchasing equity shares of ABC, which are currently selling at 600 each. He expects the price of a share may go up to rupees 780 or may go down to 480. It may go up to 780, go down to 480. Current price is 600. And this is expected to happen in 3 months. The chances of occurring such variations are 40% and 60% and 40%. So this is what I was telling you. They themselves have given a probability. What is this probability? This probability is probability that he is expecting. Is it risk neutral probability? No, you should never confuse this with risk neutral probability. Risk neutral probability is what you compute. This is his expectations. A call option, the shares of ABC can be exercised at the end of 3 months with a strike price of 630. So strike is 630. What combination of share and option should he select if he wants a perfect hedge? How many shares and how many options? What should be the value of option today if the risk-free rate is 10% per annum? And what is the expected rate of return on the option? Expected rate of return. What is the expected rate of return? Generally, when you price an option, you're expecting risk-free rate of return. But in this question, he is expecting some other price movement. So based on that, what is the expected rate of return? That is what you are required to compute. Okay, so let us basically look at the data what is given. 600 is the first spot, 780 up, 480 down, and 630 is the spot strike price. 3 months is the call option. Risk-free rate of return is 10%. Up is 1.3. What is this up 1.3? This is 780 by 600. So it will be 6 tens are 6 13s are. So 13 by 10 is 1.3. Then down is 480 by 600, which is 6 8s are, 6 10s are, which is 0.8. This is 0.8. What is the interest rate for 3 months? 10% into 3 by 12. That is 1/4, which is 2.5%. So future value factor is 1.025. Okay. Now, did they say which method you are supposed to use? Nothing. They said what is the combination of share and option that he should select. What is the combination of share? If you are selling one call, then you should purchase delta shares. What is delta shares? Delta shares is delta. Delta is change in option by change in share price. What is change in option value? If your share price is 780, you have a right to buy at 630. Call value is 150. If you have the right to buy it for 630, but the share price is 480, you will not exercise the call, it is 0. So the value of the option is 150. What is the change in share price? 780 minus 480. So 150 by 300, which is 0.5. So for every option, delta, as I said, number of shares that you should buy. So the share count will always be less than 1. So you should buy 0.5 shares to hedge an option. So the answer should be 0.5 shares to hedge an option. Is that the first thing? Sell one call and buy 0.5 shares. If he buys one share, he has to sell 2 calls. So if you're buying one share, sell 2 calls, or if you're selling one call, buy half a share. Okay, that is the first part. Second part, what should be the value of option today if the risk-free rate is 10%? Now, they have not said which method to adopt. Easiest and fastest is risk-neutral method, because other cases you have to sit and work. Right. So risk neutral method is what? E power RT. Did they say E power RT or anything? They just said 10%, so you can do normal 1 plus RF. So 1.025 minus D, this 0.8 divided by 1.3 minus 0.8. Right. So you get 1.025 minus 0.8 divided by 1.3 minus 0.8 by 0.5. You get 0.45. So P is 45%, 1 minus P is 55%, right? So P 45% into, what is the value of the share on the upside? 150 into 150. So 150 into 0.45, because the second value is anyway 0, is 67.5. 67.5 you discount by 1.025 or multiply it by 1 by 1.025, you get 65.85. 65.85 is the price of the option. This is the value of the option today. What is the expected rate of return on the option? See, when they are saying expected rate of return on the option, one way is under the risk-free method, you get 10% per annum. But the other method, which is what they have asked, what is it that they have asked? The chances of such variations occurring are 60% and 40%. So he estimates his own version is 60 and 40. So 780 minus 630, which is 150, into 60%, he expects 90 rupees to the gain, 90 rupees to the be the expected value of the option. Why is in the second case? What is the second case? 480 minus 630. That will not happen, so it cannot be negative. So it will be 0. 0 into 40%, which is 0. So 90 rupees is what he is expecting as value of the option, and at the end of the period, and he is going to invest how much? He is going to invest 65.85. So what is the return of the option? 90 is going to be the ending value, 90 by 65.85. This is over what period? So first let us find out what is this. 90 by 65.85. You are going to get, and minus 1. This is 36.67% over 3 months period. So over 3 months itself he is expecting this much. So on an annualized basis, this will be on an annualized basis, this will either be 36.67 into 4 or 1 plus 36.67 whole power 4 minus 1, 248% in this case, and here 146%. So I would tend to take it 146% rather than compound it again. Okay, so 36.6, he is expecting a 146% return. He invests 65, he gets 90, and over a 3 months period, he is generating 36.67%. If you annualize it, it will be 146.68%. Okay, that is the answer. That is the answer to this particular question. Now let us move to the next question. What did I say as the next question other than question number 8? 11, 14, 21. Now let us look at illustration number 11. What is illustration number 11? They themselves have drawn a binomial tree. Following is a 2 sub-period tree of 6 months each for share of CAB. 30, 33, from 33 is going to 36.63, then R going down 29, 27, 24.3. Using the binomial model, calculate the current fair value of a regular option on CAB stock with the following characteristics. X, that is strike price is 28, risk-free rate is 5% per annum. You should also indicate the composition of the implied riskless portfolio at valuation date. Riskless portfolio means, basically I told you, your delta shares minus call will generate only risk-free return. So it's a riskless portfolio. So you have to, basically you have to give how many shares you have to buy, basically compute delta. So now here you have a right to buy it at 28. So S0 is 30. From there it goes to 33 or 36, from there 36.6. So it going up by 10%. So 33 by 30 gives you 1.1. Same way it's going down from 30 to 27. So it has come down to 90%. And strike price is 28, period is 6 months. It is 2 sub periods of 6 months each. So it is totally 1 year, but each period is 6 months. Risk rate is 5% per annum. Right. Then what is the rate of return? 5% they've given. So 5% is per annum. So for half year it is 2.5%, which is what you have. 1 plus RF is 2.5%. Okay. Then they have said use binomial model. So if you use binomial model, you have to basically use the delta shares and your delta shares or your replicating portfolio. So in this kind of a question, right, when you have a two-stage binomial tree, creating a replicating portfolio or computing delta and using it is actually a tougher challenge. I'll give you a simple reason why. See, what is the delta at this point? Even though it's a European option, not an American option, at this point the delta is 33 minus 28, 27, which is denominator is 6, which is change in share price. Option is 33 minus 28, which is 5, and 27 minus 28, which is minus 1, but you ignore minus 1, so 0. So 5 by 6, that is 33 minus 28 is the payoff of the option, minus 0 by 33 minus 27, okay, 5 by 6. Now this is 5 by 6 is at the first level, but at this level when you come here, whatever is the change in share price will start reflecting in the change in the price of the option. So it becomes basically 100%. Why is that the reason? Because if you see here, what is the change in the price of the share? 36.3 minus 29.7, which comes to 6.6. 6.6 is the change in the price of the share. What is the change in price of the option? 36.3 minus 28, which is 36.3 minus 28, which is 8.3, minus 29.7 minus 28, which is 1.7. 8.3 minus 1.7 is 6.6. So delta becomes actually 1 here. And here the delta probably will be lower, okay, because in this scenario from here, from 27 onwards, it is only 1.7 here 0. So the delta changes after the price has changed. So creating a portfolio or a replicating portfolio beyond one step or one node, so each one of them is called as a node, beyond one, beyond the first stage is actually a challenge. So in this kind of scenarios, even though they have said using the binomial model, you can use the risk neutral approach and actually compute it. And why am I saying this? Because it becomes very challenging to create a portfolio that will give you same return when delta is changed. Delta is not constant. See, the whole assumption when we created the delta portfolio, replicating portfolio, delta hedging was that delta does not change. But here delta is changing. So you should not get into this business of trying to create a portfolio which will replicate the payoff of the call when it is a two-step binomial tree. Okay, so in this case you go directly with the risk neutral method. So we have found out risk neutral method. What is the probability? Risk neutral method is R minus D by U minus D, which is 1.025 minus 0.9 by 1.1 minus 0.9, which is, we got these numbers, this 1.025. So we get 1.0125 by 0.2, which you get 62.5. So 62.5% is the probability. So 1 minus P is 37.5%. Okay, from there on you draw the tree. So the stock is currently at what rate? 30. Can go up to 33, from there 36.3, then it can come down to 27, from there up to 29.7, or come down to 24.3. The probability of every up move is 62.5 and every down move is 37.5. You can actually check it, right? How can you check it? 29.7 from 33, if it has come down 29.7, how much has it come down? 29.7 by 33, which is exactly 0.9. So it has also come down by 90%. So when the up move and down move are consistent at 1.1 and 0.9 in first node as well as subsequent nodes, then the probability does not change. So the probability is going to be same 62.5 and 37.5. So when you have this kind of probability, how do you back work? See, if it was a single tree with single period tree, it was very easy, you discount. Now here at every node you have to compute the value and work backwards. So what do I mean by that? I'll erase this and then you'll see, you'll understand it better. So at this node, 36.3 is the price of the share. What is the strike price of the option? 28. So what is the gain you are going to make? 36.3 minus 28, which is 8.3. Okay, first compute all the values. Then second node 29.7. 29.7 minus 28 is 1.7. Third node 24.3. There you don't make any money option, it is 0. So what you do is this 8.3 is coming from 62.5. This 29.7 is coming to node D from A with a 37.5. So you do 8.3 into 0.625 plus 1.7 into 0.375. You get a value. What is that value? I did that here. 8.3 into 0.625 is equal to M plus, and 0.375 into 1.7 is equal to M plus, memory recall, 5.825. You get 5.825. This 5.825 is you're moving from these two levels. Basically, you found out an expected value of the option when you move from node A. At node A, what is the expected value? But this expected value is also future value. So present value of expected value of option at node A is 5.825 divided by 1.025, which will give you 5.6829. Okay, 5.689. So at this node, the value of the option is 5.68, or value of the option and payoff of the option both are same. Payoff of the option, the value of the option, the price of the option is the present value of expected payoffs of the option. Okay, present value of expected payoffs of the option. So you get 5.68. Same way now you do for node B. What do you do for node B? 1.7 is in this case, 0 in this case. So 1.7 is coming from 62.5. So 1.7 into 62.5, you will get 1.0625. 1.0625 you again divided by 1.025. You will arrive at 1.03 or 0.35659, which is 1.04. These are the two nodes. So from these two nodes, you again work out the expected value at origin point. So 5.68 is coming from 62.5 probability and 1.04 is coming from 37.5 probability. So you multiply those two and again take the present value, you arrive at 3.844. So at origin point, the expected value, the present value of expected value of the payoffs of the option is 3.844, which is same as the price of the option. Okay, or value of the option, whatever you want to call it. Right, so 3.844. Is that what they asked? Calculate the fair value of a regular, fair value, price, value, everything means same. So 3.844. Then they said you should also indicate the composition of implied risk hedge portfolio at the valuation date. So at valuation date, you look only at the first two nodes, first period. You don't go to the second sub period. You go restrict yourself to the first sub period, which is why you will get it as 33 minus 28 minus 27 minus 28. So this is minus 1, so this gets 0. So this is 5 is numerator. This is basically change in option price. What is change in or value of the option? What is the value of the option? Your market price minus strike subject to a minimum of 0. So market price is 33 minus strike of 28, which is 5. And second one is 27 minus 28, which is minus 1. So 5 minus 1 will not happen because minimum it can go is only 0. So 5 minus 0 is 5. 5 is the numerator. This is the change in the value of the option. Denominator is 33 minus 27, which is 6. 5 by 6, which is 0.833. So you should buy 0.833 shares if you sell an option. For every call option sold, one should go long on 5 by 6 shares in order to create a riskless hedge portfolio. Okay. So these are the tricky aspects of questions like this. You should be very careful. Just because they have given a two-stage binomial tree, you don't start creating a portfolio which will match the where the movement in option prices will match where the movement in share prices for delta shares will match exactly the movement in price of the option. It will not happen because the delta will keep changing when prices change. At first level, when the first price change happens, delta will not change, but after that, delta will change. Okay. So friends, now let us look at illustration number 14. Fresh Bakery Limited share prices suddenly started moving both upward and downward on a rumor that the company is going to have a collaboration agreement with a multinational company in bakery business. If the rumor turns out to be true, the stock price will go up, but if the number turns out to be false, then the market price of the share will crash. To protect from this, an investor has purchased the following call and put option. One 3-month call with a strike price of 52 with 2 rupees premium, one 3-month put with a strike price of 50 for a 1 rupee premium. Assuming a lot size of 50 shares, please remember this is given a lot size. So you can't buy and sell one put or one call, you have to do minimum 50 puts, 50 calls. Or rather, call for 50 shares, okay, that's the right way, or put for 50 shares. The investor proportion, if the collaboration agreement pushes the share price to 53 in 3 months, investors ending position, if the collaboration agreement fails and price crashes to 46 in 3 months. Okay, here, call option, put option. Now, first scenario, price goes to 53. So your expiry is 3 months, strike price is 52. In for call option, strike price is 52, put option, strike price is 50. So 52 and 50. What is the premium? In first case, you paid 2, in second case, you paid 1. So both of them you purchased. You did not sell. Only when you sell, you receive premium. If you purchase an option, you pay premium. 2 and 1. Then lot size is 50 and 50. Closing price is, in scenario A is 53 and in scenario B is 46. Okay. Now in scenario A, closing price is 53. I have a right to buy at 52. I have a right to buy at 52. How much money will I make? I will make 1 rupee. Right, but I have paid a 2 rupees premium. So my net loss is -1 for 50 shares minus 50. This is a very simple thing. So here you can actually also write payoff of call is equal to max of 0, spot on date minus K. Okay, so here we have on closing price 53 minus strike price of 52, 53 minus 52 is 1, so max of 0, 1 which is 1, which is what we have written here. Then same time, what is the payoff of put? What is the payoff of the put? Put, you have a right to sell it at what rate? At 50. If market price is 53 and your put is at 50, you will sell in the market at 53 only. Why will you sell it at the put strike price? So the put option will be unexercised. When you put option is unexercised, the premium of 1 rupee that you have paid is lost, -1 into 50, which is -50. So the total loss is 50 minus 50 minus 50, which is 100. In case B, what is case B? The price crashes to 46. So what happens for call option? You have a right to buy at 52. So this you will rather buy in the market at 46 than buy it at 52. So the call option goes waste. So the premium paid of 2 rupees is waste. So 100 rupees is the loss. Whereas when it comes to put option, you have a right to sell in the market at 50 versus current market price of 46. So you make a 4 rupees gain. 4 minus 1 initial premium, you make 3 rupees gain. The 3 into 50 is 150. 150 minus 100 is 50. So you make a your net flow. What is the exact word they said? Investors ending position. Investors ending position is -100 in scenario 1 and 50 in scenario 2. It's a very easy problem. Just that you should understand what is being asked. And think, in fact, this similar question was asked sometime in 24. Okay. Now, 14 and then what? 21 and 24. Before I go to question number 21 and 24, I want to solve this question number 19. Right. The reason is 21 and 24, though they relate to Black-Scholes and other concepts which you have not yet seen. But this 19 is something, I think I missed it in giving my important questions. This also is a fairly important one because this is valuing an American call option using a binomial tree, 2-stage binomial tree. So what is the whole point of American call option? It can be exercised anytime. Unlike a European option which can be exercised only on maturity, American option can be exercised anytime. So what is so unique about this? What is unique? I will tell you. Let us read the question. A two-year tree for a share of stock in ABC is as follows. Year 1 now 100, price may go to 108, from there 116.64, which is 8% I think. 108 into 1.08. Yeah, 116.64. So it is going up by 8%. Going up by 8% and coming down by 5% I think. Yeah, 102.6 minus 5%. So up move is 8%, down move is 5%. Consider a 2-year American call option on the stock of ABC with a strike price of 98. So you have a right to buy it at 98 and American. Anytime you can exercise. When you say anytime, You can exercise any day 1, day 2, day 3, day 4, but in our case we have been given year 1 and year 2, so you can exercise it in year 1 as well as year 2. That is what you need to remember. Current price of stock is 100, spot is 100. The risk-free rate of return is 5%. Okay. With a continuous compounding rate of E.05 is 1.05127. So they themselves are given E-values, so need not bother. Assume 2 time periods of 1 year each. Using the binomial model, calculate the probability of price moving up and down. What is the probability? Very simple. E power RT minus D by U minus D. What is E power RT? E power RT is 1.05127. minus D. What is down move? Down move is 5%. So it is 0.95 divided by 1.08 minus 0.95. So you will get 1.08 minus 0.95 is 0.13 as denominator, and numerator is 1.05127 minus 0.95, 0.10127 divided by 0.13. So you will get 77.9%. See, 77.9% is the probability of the up move. Probability of the down move is 1 minus that, which is 22.1. What did we do? Probability of price moving up or down, we already found out. Expected payoff at each node, N1, N2 and N3, round off up to 2 decimals. So you are supposed to find out expected payoff. Each node. Now what are the nodes? You have 1, 2, 3, 4, 5. This is also a node. At this point, what is the price? You just are not required to compute the value at these 5 nodes and run away. You are supposed to do it at origin point also. So let us see, 116.64. So I have written 116.64. At this point, you have a right to exercise the option at a price of 98. So it's a buy call, American call. So 116 minus 98 is 18.64. This is first case. Second case, 102 minus 98, which is 4.64. Then 90.25 minus 98, obviously value will be 0, because you will not exercise in such a case even if the option value is negative, because if the payoff is negative, you will not exercise it. So here the up move is 1.08, down move is 95%, right? Up move is 1.08, down move is 0.95. But what are the probabilities of this? It moves up by 8%, the probability is 77.9. It moves down by 5%, the probability is 22.1. So this you should definitely remember. So what would you do now? From these 2 nodes, you arrive back at this node. From these 2 nodes, you arrive back at node. What do you do? 18.64 into 77.9. 18.64 into 0.779 is equal to M plus, you get 14.52. Then 4.6 into 0.221. 4.6 into 0.221. You get 1.01. You add both, you get 15.53. Now 15.53 is the value of the option, but it is the future value. So you have to divide it by 1.0. What is that value? E power 05127, that is annual rate. So you can directly multiply. So 14.779, which is 14.78. Now at this point, what you do is you not only check for 14.78, you also check at this point, if I were to exercise, what is the price of the share? 108. If I were to exercise my share at current price of 108, how much will I get? See, this 14.78 is the expected value coming from next 2 nodes. But at this node itself, ignoring these 2 values, if I can exercise at 108, what will be my gain? 108 minus 98, which is 10. So is 10 higher or 14.78 higher? 14.78 higher. So even at node first year, what if they call that node? They have they given at first year, they have called it N2. At N2, 14.78 is the value. So you have to always check max of expected value, comma, current option payoff. You have to check necessarily for this. That is a key element in this. Okay. So if that is by chance that is greater, then you should consider that value. Okay. Now next, coming to the next level, which is you take 4.6 and 0. 4.6 goes up by 77.9, and so you discount it 4.6. 4.6 probability is 77.9. 4.6 into 0.779, you get 3.58. 3.58 divided by 1.05127, you get 3.4086 or 3.41. So 3.41 or 98 minus or 95 minus 98. 95 minus 98 is anyway negative value. There is no option will not be exercised. So 3.41 is the value. From this 14.78 and 3.41, you again discount. This is moved up by 77%, 14.78 and 22% for 3.41. So you do 14.78 into 77.9 plus 3.41 into 22.1, whole thing divided by 1.05. You get 11.67. So at first node N1, 11.67 is the price. This is the price of the option. In case of certain options, you may see a case where you can exercise node 1 or node 2, whichever node that is, and you may get a higher payoff from the option than considering the expected values. At that point of time, you should, instead, let's say argument's sake, instead of here this being 108, let's say it is 120. Everything else is same, this is 120. 120 minus 98 is how much? 22. So you will take max of 22 or 14.78, so you will take 22. That is what you will use to arrive at the value option at origin node. Okay, that is what you will use to arrive at the value of the option at origin node. That kind of questions may also be asked in the exam. Please be very, very wary of such kind of questions. Okay, now after having understood this, we now will move to Black-Scholes. Black-Scholes, something that a lot of people find it tough because the formula is unnecessarily large, complicated, confusing. I will try and simplify it to the maximum extent possible. Let us go and have a look at it. So friends, let us look at the next question. I'll first read out the question, then we'll go to the concepts that are relevant for this particular question. The following information is available for X company limited share and its call option. Current price is 185, option exercise price is 170, strike price is 170, risk-free rate is 7%, time of expiry of option is 3 years, standard deviation is 0.18. So, okay, calculate the value using Black-Scholes formula. Now, what is this Black-Scholes formula? We'll get to the Black-Scholes formula, but before we get to the Black-Scholes formula, I want to explain you 2 or 3 things. Okay, first, I want to explain to you something called put-call parity. Put-call parity. I will not get into the derivation of this because this derivation I have discussed in full-fledged class. There is no point trying to explain to you what is this derivation, but please think of it this way. This equation holds good, and it is basically the 2 portfolios which are having same value. If you find out the value of a put option and you find out the value of a call option, then C plus K into e power minus RT is equal to P plus S0. So this equation will hold good always. If you go to a NSE or BSE website, check for call price, check for put price, check the spot, check the present value of the strike price. Call price plus present value of strike price will be equivalent to put price plus spot. Okay. Now, how, why, I will not discuss this, discussed in full class. This is one thing you need to remember. Why do you need to remember this? Because in Black-Scholes, we have formula for call option. Price is C0 is equal to S0 into ND1 minus K into e power minus RT into ND2. What is ND1? What is ND2? I will explain. But again, for P, price of a put, again there is a formula like this. I don't want you to remember that formula. As it is remembering this one formula itself, a lot of people will get confused. I don't want them to remember this formula. Rather, if you know the price of a call, you can find out the price of a put by substituting in this put-call parity equation. This put-call parity equation holds good whether it is a risk neutral pricing or binomial model pricing or Black-Scholes pricing. Whichever way you price, put-call parity always holds good. Okay, so don't worry about it. So I don't want you to remember the put option formula for Black-Scholes. I want you to just remember the call option formula for Black-Scholes. And in this call option formula, once you arrive at the value of the call option, you can substitute the value of the call option here to get the value of the put option. Okay, that is what I wanted you to do. Now, the thing about this Black-Scholes is this Black-Scholes-Merton model. This basically assumes that there is no dividend. This whole formula is based on no dividend. But as we move forward, we realize that there is one more formula in which there is dividend. Now, this is without dividend. Then there is something called with dividend. We will come without. This is with. We will come to the with dividend formula later. But for now, let us first understand what is this without dividend formula. S0 into ND1. Here ND1 actually is delta. Okay, ND1 is delta minus K into e power minus RT into ND2. Now, what are these ND1, ND2? ND1 is normal distribution table, cumulative normal value in a normal distribution. cumulative normal value in a standard normal distribution. Cumulative normal value in a standard normal distribution for D1 and D2. So what are D1 and D2? D1 is equal to natural log of ln, natural log. We will come to it, don't worry about it. Natural log of S0 by K plus R is risk free. You know what is S0, you know what is K. Risk free rate of interest plus sigma square by 2 whole thing into T divided by sigma root T. What is D2? D2 is equal to D1 minus sigma root T. And what is, if let's say you get D2 value as -1, let's say D2 is negative, that is N minus D2 is equal to 1 minus ND2. So you find out the positive value, subtract that from 1, you will get a value for n of minus d2. So if you get minus inside the bracket, what you do is you compute 1 minus nd of that value. Okay, instead of taking minus value, directly bring it outside and compute it as 1 minus nd2. So n of minus d2 is 1 minus nd2. Okay, these are the things that you should remember. This is the formula. Okay, so now in our case, what all have they given? They have said time is 3 years. They have given standard deviation is 18%. Okay, this is 0.18 or 18%, and risk free rate is 7%. So this has to be necessarily done using exponent value only. Okay, you cannot use any other method to compute. So they will give you exponent value. Otherwise, I have taught you the calculator trick. Let us first see what is this whole function S0, ND1, ND2, all of this. Let us go and compute. Okay, I will also have to explain to you how to look at the natural logarithm tables. That also we'll see. So first solution, S0 is equal to 185, K is equal to 170, R is equal to 7%, T is equal to 3, then standard deviation is equal to 0.18. Now price of a call is equal to S0 into ND1. If you write multiple times, you will remember, minus K into e power minus RT into ND2. D1 is equal to natural log of S0 by K plus R is 7% plus 0.18 whole square by 2 into 3, time is 3 years, right, divided by sigma 0.18 into root 3. This will be natural log of, what is 185 by 70? 185 by 170. 185 by 170. What is 185 by 170? 1.08824 plus 0.18 into is equal to 0.0324, which is this value, divided by 2 plus 0.07. I have done till here, into 3 is equal to 0.2586 divided by under root 3 is 1.732 into 0.18, you get 0.31177. Okay, now let us look at natural log. So if you want to find out natural log, you come to my latest formula sheet where I am giving you natural log, common log, common anti-log. See, please note, common log is to the base 10. Common anti-log is also to the base 10. Natural log is to the base e. So you should not get confused. Natural log is to the base e. So in natural log to the base e, you have a table here, and in this you have to check 1.0888. Okay, that is what we have, right? Value is 1.088. 1.08824. So 1.088. So the value that you will get is this plus this, 0.0770 and 76. So add this 76 to this and last two digits. So what will it be? It is 0.0770 plus 0.76. Last two digits you have to add, 0.0770 plus point. So you get 0.0846. 0.0846. That you have to bring here. Natural log of this is 0.0846 plus 0.2586 divided by 0.31177. So 0.0846 plus 0.2586 is equal to 0.3432. See, in this, no, it is very important to write steps. Don't do a large computation in a single level, because if you make any mistake, you will never be able to go back. Okay, divide by 0.31177 divided by 0.31177. That is 1.1008. So D1 is 1.1008. D1 is 1.1008. Now, what is normal distribution value of D1 of 1.1008? What is the area covered in the normal curve when D1 is 1.1008? For that, instead of natural logarithm table, you have to move to the standard normal distribution table. What is that? 1.1008. 1.1008. Please note, unlike in a log table, here the issue is 1.10 and this is 1.18. So you have 1.1008, which is between 1.10 and 1.11. It is somewhere between these two. Okay. Please don't take this as this number, no, is 1.18. You should not take this. You should not take this at all. Rather, you should take 1.100, okay, which is closer to this. Or you should interpolate. For 10 it is this much, 11 is this much. How much is 11? 10 is 0.8643, 0.8665 for 11. So you should try and interpolate. If it is too far away, then you can directly take this value, which is 0.8643. So in our case, you cannot take this value. You should take only 0.8643. So let us come back. 0.8643. 0.8643. Now this is ND1. What is ND2? What is D2 first? D2 is equal to D1 minus sigma root T. What is D1? Please note, this is D1. So 1.1008 minus sigma. Sigma is 0.18 into root 3. So 3 under root 2 into 0.18 is one number, which is 0.3117, which I'll change to minus, plus memory recall of 1.1008, you get D2 is equal to 0.7890. So what is ND2? ND2, again go back to 0.7890. So you again go back. In exam, they will give you ND1, ND2 values. If they do not give you, there is no way you can basically solve. So it is impossible that they will actually not give you these values. Either they will give the table or they will directly give you the D value. Okay, and I am deleting this because I don't want it to appear again when I am looking at it. Look to get the next one. 0.7890, 0.70 and 0.7890. Right, 7890 is close to 79. So I will take this value, 0.7852. Right, 0.7852, 0.7852. 0.7852. Okay, now comes call option price. C0 is equal to S0 into ND1 minus e power minus RT into minus k into e power minus RT into ND2. What is S0? S0 is current spot 185, no? Yeah, 185, and k is 170. 185 into ND1. Where is ND1? Here. 0.8643 minus k is 170 into e power minus r is here 7% into 3, okay, into ND2. What is ND2? 0.7852. Okay, so 185 into 0.8643 is equal to 159.89 minus 170 into 0.7852 is equal to 133.484 into e power minus 0.21. Okay. Now, what is value of e power minus 0.21? If you recollect the calculator trick that I told you, here also they will give you e power value. If they do not give, okay, first enter minus 0.21 on the screen. What is e power minus 0.21? If you recollect the calculator trick that I told you. What is the calculator trick? minus 0.21. You write it on the calculator, 0.21, you change it to minus. Then you divide by 4096. So divide by 4096, you get a value. To that you add 1, you get another value plus 1. Then into is equal to 12 times. So into equal to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. You get 0.81058. So into 0.81058. So 0.81058 into 133.484 is how much? This is 108.199, and this is 159.89. If you subtract those, you will get 51.69. So value of a call option is 51.69. Let us see if that what we got here, 51.77. So here I have solved it in classroom with using Excel, because I fundamentally believe that this whole computation thing should not be something that should be tested in exam. They can test you about the formula, they can ask you how the formula works and all of that, but too many computations with too many things I usually don't think they will give. And please add this one more as a question that you will do last. If at all it is asked in the exam, don't do it in the beginning. Leave 2-3 pages gap and do it towards the end. Why? Because you will make mistakes, you will get confused, you will do something which will hit the confidence of other questions. So please do this towards the end. Don't do this in the beginning, because if you do it in the beginning, you will unnecessarily forget stuff or make mistakes, and which will spoil other stuff. Okay, so we got 51.67. When I do it exactly on Excel, I got 51.77. So that kind of variation is permitted. There is no issue absolutely. That kind of rounding off will not cause any cut, marks being cut as far as I know. Okay, so this is how you looked at a Black-Scholes model. Now you see in Black-Scholes, what are the various factors you have? You have time, you have standard deviation, you have risk-free rate of interest, you have spot, you have strike price. All of these influence the price of the call option. So call option price, or even put option for that matter, all these factors come into account. This is where our other logic, what I said, we will get back to it in terms of what are the various factors that affect, how do they affect. We will now go and understand that and link it with the Black-Scholes model, so that our understanding is perfectly clear, and then we'll come back and again solve problems. Okay. Yes, so now let us look at these aspects. How does time to expiry impact the pricing of an option? As time increases, what did I tell you? There is intrinsic value plus time value. As time increases, the volatility and time play together, and because of which the option value increases. Even if you look here in the Black-Scholes model, as time keeps increasing, what happens? This numerator has t, denominator has root t. So you are basically multiplying by t by root t is root t. So as time increases, the value of this equation, this term in the equation increases. The value of this term equation here increases, ND1 also increases. ND1 increases, ND2 is a lower value than ND1. So as ND1 increases, ND1 increases by a larger amount, ND2 increases by a smaller amount, the second term. So the gap increases, so the call option price keeps moving up. This is one way to look at it, but the logical, intuitive way is volatility has a greater chance to play if more time is available. So option premium is summation of time and intrinsic. Option series are always compensated with time risk. Both call and put options lose their value as expiration date approaches. The more the time for expiry, likelihood option to expire in the money, and out of the money with short tenure will have less value. So out of the money option with short, very small tenure will have very less value, and out of the money with long tenure will have more value than an out of the money with short tenure. In the money option with short tenure will have more value. Okay, how does volatility impact? What is volatility? Volatility is standard deviation. Volatility is a measure of risk. It can be seen as standard deviation of returns from the mean. Volatility positively impacts the value of call and put. Both call as well as put value increases. An increase in volatility increases the value of the call option and put option. Holder will only exercise the option that is favorable and choose to forego the premium when price movement is negative. Higher volatility means higher upside risk or higher downside risk. This is the reason why higher volatility makes call and put options more valuable. Let us look at the formula. So standard deviation, sigma square is in the numerator, in the denominator it is only sigma, right? So as the sigma value keeps increasing, as the sigma value keeps increasing, this term ND1 term increases, but ND1 increases greater by greater amount than ND2 term. So basically again, volatility and time, both of them have a impact on increasing the value of the call as well as put option. Then how do interest rates impact? How do interest rates impact? Interest rate is R. So if a risk-free rate of, again, it is in the numerator. If the numerator term keeps increasing, the value of the option also increases. An increase in interest rate reduces the present value of strike price and makes call option more valuable and put option less valuable. You see what happens here? Interest rate is only here, but it is also available here. So what happens? As D1 increases, this term value increases, this term value increases, and this term value decreases, the second term. So as R increases, this D1 increases. If D1 increases, this value increases. But there is K into e power minus RT, so this decreases. So call option may, the ND1 value increases, the second part K into e power minus RT into ND2 decreases, so the value of the call option will increase. In case of a put option, I explained to you put call parity. What is the put call parity? C plus K into e power minus RT is equal to P plus S. So if call option price increases, if this increases, K into e power minus RT, this decreases. So this has gone up, this has gone down. This is stable. This has, so this has gone up, this has gone down. But the impact, see the impact of higher risk-free rate is much more on K into e power minus RT than the call. So this comes down by a very, very large amount. So if this goes up and this comes down by a larger amount, P also has to come down so that the both sides of the equation match. Okay. Then high interest rate, call option increase in value, put option decrease in value. Low interest rates, call option decrease in value and put option increase in value. What are Greeks? Now you'll be able to understand Greeks better. Greeks are a collection of statistical values expressed as percentage that give the investor a better overall view of how the stock has been performing. These values can be helpful in deciding which option strategies are best to use. They are based on past performance. These trends can change drastically. Okay, forget all of that. That is not relevant. What is relevant is this, delta. What is delta? Change in price of an option divided by change in price of the stock. So you have to specifically write these terms. Delta measures the rate of change in the option premium due to change in price of the underlying asset. If you do not write this and just write the equation, they will give you only half marks. Please be aware. Delta for call option is positive and delta for a put option is negative. This is because put option and underlying asset price are inversely correlated. Delta is also called as hedge ratio. So, and then you have to write this formula, only then you'll get marks. What is gamma? Gamma is rate of change of delta. That is, it measures the rate of change in delta. It is always positive for both call and put options. It is change in the price of the option due to change in delta. So whatever is the change in delta is in denominator. What is change in price of the option is in the numerator. What is theta? Theta is people call it differently, theta, whatever you want to call it, THETA, that is what it is. Option sellers are always compensated for the time risk. Theta refers to the rate of decline in value of an option due to passage of time. Please note, theta is, earlier we said as time increases, option value increases. But here we are saying theta is change in price of the option due to passage of time. I am not saying total time duration. Here it can also be referred to as time decay. It is referred to change in price of option due to change in time. So it is the rate of decline in the value of an option due to passage of time. Here the time change in time period, because of the change in time period, what is the passage of time, not even change in time, passage of time, because of passage of time the value of the option falls. So it is basically decay. So it is not necessarily directly the change in time, it is due to the passage of time. Okay, so it refers to decline in the value of an option due to passage of time. So you have to again write this formula. What is Vega? Vega was asked in exam also. Vega is volatility. And please note again, you can't write change in price of option due to change in volatility. They actually did not give marks. They said it measures the sensitivity to volatility is the change in option price for a 1 percentage point change in volatility. So they were very, very specific. If you did not write this 1 percentage point, they actually in quite a few cases I saw they did not give marks. So you have to necessarily write what is Vega. In what is Vega? 1 percentage point in volatility. What is the change in price of the option? Then rho. What is rho? Rho is risk-free rate of interest. It is the rate at which the price of the derivative changes related to the rate in risk-free rate. Rho measures sensitivity in option portfolio to 1 percentage change in interest rate. So interest rate changes by 1 percentage point by 1%. Here also I will write 1%. Right? Change in the, what is the change in price of the option? So it measures that. Okay, then we anyway have discussed put call parity. Here it is written in a different form, SC plus k into e power minus rt is equal to p plus s0. You take the terms left hand to right hand, this is what you'll get. Okay, now we have looked at this put call parity also. Next topic is exotic options. We will understand exotic options, then real options and all of that. But before we do that, there is one small thing I want to show you. One small thing, exotic and real options and all of that, there are problems also, good problems. After this, I think 21, we have to go and solve 24. But I want to show you one thing, which is this illustration 23. There is one good point that I wanted to highlight. In illustration 23, how will they give you this standard normal distribution cumulative value data? They may directly give you a value, or they may give it to you in this form. What is this form? Number of standard deviation from mean, area of to the either left or right. So if it is point, see, they have given natural log value, they have given e power value, and they have given the normal distribution value. So if they give you normal distribution values, what are you supposed to do? If they give you normal distribution values, you will do all this computation. Okay, you got ND1, N of 0.58195. What is this 0.195? So if you look at a standard normal distribution table, this is the mean. They are saying number of SD from the mean. So if let's say it is 0.25 SD, then area left or right. So what is the exact terminology they use? Number of SD from the mean, area of the left to the left or right of the tail. If it is 0.225, then to the right of this tail, that is they are telling you this area they have given as 0.4013. So balance area is 0.5987. 0.5987. Now, what is our requirement here? N of 0.58195. Where is 58? 58 is here, between 0.55 and 0.60. That is, if you draw a thing here, 0.55, 0.60, 0.55, 0.60. So for 0.55, this area, 0.60, this is the area, 0.55, this is the area, right? Now, our value is 0.58195. So it lies in between these two. If it lies in between these two, you see, and again, please note, what have they given? They have given this value. We need total from here till here. And we need it till which point? We need it till this point, 0.58. So what you need to do is, first 0.55 and 0.60 you put it. For that, they have given certain values, 0.29 and 0.27. Okay. In fact, as SD keeps increasing, why is the area decreasing? Because they are giving you 1 minus the actual area. So here it is 0.29 and here it is 0.27. So 0.58 will be somewhere in between. So you do interpolation exercise and find out for what is the value here. You will probably get a value which is between 0.29 and 0.27, which is 0.28. Roughly take it as 0.28. So 1 minus 0.28. So 1 minus 0.28 if you do, you will get this value, 0.71960. You do an interpolation exercise and get that value. Okay, because what we need is this. What they are giving us is irrelevant information, or rather information which is 1 minus that. Okay, so they may give in exam questions like this also. Was this in past exam question? I don't recollect. Okay, I'm not written here, but if they give you something like this, you should be very well aware. And please note, the way to figure it out is, if you look at our table, right? If you look at a standard normal distribution table, from 0, as you move downwards to 3, the values are increasing. Why? You have a table like this, it is measuring from one end. Okay, when it is at mean is at this point, right? When you are when mean is 0, that is you are at this particular point, this is 0.5, this is also 0.5, right? So the area covered till here is 0.5. What is the value if you are 3 standard deviations away from the mean? That is, if you are 1, 2, 3 standard deviations away from the mean, we are computing the entire area this. So as in a cumulative standard distribution, as you move further away, the area increases. Whereas In our question, this question, as you increase the number of standard deviations, the area is decreasing. So basically, instead of giving the cumulative area, they are giving the 1 minus cumulative area. So you have to figure out what is the cumulative area. That is, this is another way in which they can ask. Okay, now after having understood this, let us move to exotic options and real options. They are very, very interesting topics, new topics that have been added in the syllabus, and I want you to pay a lot of attention to this because there is a very, very high chance that something can be asked from there. So friends, after having looked at the Black-Scholes model, right, now let us go to the next topic, which is real options. There are some more theory topics, we will come to that. First, let us finish this real options stuff and then we will go to the other theory topics. What are real options? It's an approach to capital budgeting that relies on option pricing theory to evaluate projects. Insights from these option-based analysis can improve estimates of the project value and therefore has potential in many instances. However, real option approach is intended to supplement and not replace capital budgeting analysis based on standard DCF. So, it is a method that can be used along with your normal DCF to figure out whether a project has life, a project has value or not. Whether if you were to put this whole real option things like evaluate, let's say you are digging for oil. At this point, you can continue to dig, or you, in which case you will get a lot of oil or gas. If you don't dig, you will have sunk some cost. So you try and evaluate various alternatives using the option pricing methodology. Let us see how it is done. What are differences between real and financial options? Financial options have underlying assets. Real options have projects that are underlying. They are not traded. Payoff, in most cases, it is specified in contracts and it is fixed for financial options. It is estimated from the project cash flow and hence can be varied. So real options payoff is basically linked to cash flow, so it can vary. Exercise period, mostly the exercise period of these options is short and go up to 1 year for financial options. Periods of these options mostly start from 1 year and is higher than financial options. So real options are not 1 month, 2 month, 3 month. For that, nobody takes uses option pricing methodology to decide whether they should invest or not, because these are all large projects. They take 5 years, 10 years, 15 years. Okay, approach. These options are normally traded in the market, hence they are priced. These options are used to make decisions, hence they are valued. So you price a financial option because it is also traded in the market, whereas a real option is always valued. You use option pricing techniques to value real options. What are various types of options that may exist? Long call, that is right to invest at a future date. Long put, right to sell something at a future date. Short call, promise to sell if counterparty wants to buy. Short put, if promise to buy if counterparty wants to sell. So basically, long call is you will invest at some future date. Long put is you will abandon some project at a future date at zero price or at some price. Short call is commitment to disinvest upon action of another party. Short put is commitment to invest upon action of another party. Okay, so we will understand this much better. How are they valued? They are valued using normal, binomial, risk neutral and Black-Scholes. Most often than not, we see Black-Scholes and risk neutral method used. Binomial is also used in certain cases. What are various types of real options? Growth option. Growth option is like European call. It is like a European call. Investment in R&D, heavy expenditure, initial investment, acquiring rights, acquisition of a plot. These are all growth options and they are like European call. Abandonment. Abandonment means you dispose of, basically sell. So it is like a put option. It is like an American put option. Please note, these are important things that can be asked in exam. Growth option, European call. Abandonment option, American put. Timing option is like American call. Growth is European call. Timing is American call. Why? Because you can invest it at any point of time. This is what they are. Now, let us go and solve one particular problem, after which you will actually understand how we use Black-Scholes method. We are going to look at this question 24, where we use Black-Scholes methodology, and I'll also introduce you to this new topic, or rather new concept, where Black-Scholes model typically does not have this dividend. But in this model, or rather in the formula that we use for valuing real options, we'll use the Black-Scholes formula that is modified to account even for dividend. Why is that required? We will have a look at the problem and you'll understand better. Okay, this is a very brief introduction. I do not want to go deep into it because you'll be able to understand this better only from problem terms. I've gone in depth in my full-fledged classes, in revision classes. This is what basic stuff is what is required for you from exam perspective. Okay. ABC Limited is a pharma company possessing a patent of a drug called Hedging, a medicine for AIDS patient. Being an approach drug, they hold the right of production of drugs and its marketing. The period of patent is 15 years. Please note, this is a very important point. after which any other pharma company is free to produce the drug with same formula. It is estimated the company shall require to incur 12.5 million for development and marketing of the drug. So, initial investment is 12.5. As per a survey conducted, the present expected PV of cash flows from the sale of the drug during the period of 15 years shall be 16.7. So, you invest 12.5, you get 16.7 for entire 15 years. So, please note something very clear, investment 12.5, PV, it is not NPV, it is PV 16.7 for 15 years. Then cash flow from previous similar types of drugs have exhibited a variance, sigma square is 26.8 of present value of cash flows. The current yield on bonds of similar duration 15 years is 7%, 7.8, R is 7.8. Given the value of the, determine the value of the patent, given natural log of 1.336 is some value, e power 1.005 is 0.3677 and e power minus 1.17 is 0.3104. Okay, now we will come to this, but first let us understand a few things. What is it in this particular kind of question? Even the previous question we saw, what did we see? We had to figure out in Black-Scholes. If you remember, we solved this thing on Black-Scholes, right? In Black-Scholes, we saw, we were given the value of what is pot, what is K. Whereas if you look at these real options, what are real options? And we are starting the real options with this first question itself. Real options are basically ones where you use theories of option pricing to evaluate real life project. To evaluate real life projects, you use theories of option pricing. Okay, so you basically use our normal, in this case we are because they have given natural log and e power something, they are referring to your Black-Scholes method only. So, if they do not give those, then you can use binomial model also. But in this case, it is very clear they want you to use a growth option using these particular data points, Growth option is like a call option. Okay, now they have given this natural log, they have given E, all of that. We have got some value of sigma, some value of R, some value of investment, some value of PV. Now, what are the other things that we need? If you come back to the formula, D1 is natural log of S0 by K plus R plus sigma square by 2 whole power into T. Okay. Now, we got natural log value, we have got R value, sigma square value, we got T value. What are S0 and what is K? What is S0, what is K? So, that is the underlying question that you have to understand, or rather you have to answer for yourself before you actually start embarking on these kind of problems. So, we have two numbers here. You are making an investment, you have a present value of cash flow. So, can we assume that one of them is S0, other one is K? Yes, but which one is S0, which one is K? What is S0, what is K? See, K is you agreeing to buy something. In normal options, when you refer to K, K is strike price, that is you are agreeing to buy, you are agreeing to commit to do something at a certain price. Here, what are you committing? You are committing investment of 12.5. So, this is value of K. This is value of K. And what is the present value of all cash flow? 16.7. If this is K, this is S0. This is first part. Second part, what you have to remember with respect to Black-Scholes is, we have learned this formula ND1 into S0 minus ND2 into K into e power minus RT. This is Black-Scholes without dividend. There is something called Black-Scholes model with dividend. What is this? This will be S0 into e power minus dt. Here d refers to dividend rate. Why am I talking about dividend in this problem? You will understand. Minus ND2 into K into e power minus RT, and D1 is equal to what? Natural log of S0 by K plus R plus sigma square by 2. This is our normal formula. Here you have to also subtract the dividend rate into T. So, the formula for dividend, including dividend, the Black-Scholes model is this. This is what you are supposed to use in this particular formula or in this particular question. Now, why is dividend required in this particular problem? Dividend is required because your spot value, whatever is there, that is consistently decreasing. Why am I saying consistently decreasing? I told you guys, this present value of 16.7 is for a cash flows over 15 years period. But these, so if you take the 16.7 for 15 years, for 14 years, how much will it be? It will reduce. Every year it will reduce, right? You have a 15-year timeline. Any time in 15 years, you can incur 12.5, and for next 15 years, you will not get cash flows. You will get only for the balance period of the 15 years. Why? Because the patent is for a fixed term of 15. So, if you start in between, you will get only for the balance period. That is, if you start after 8 years, you will get this cash flow only for 7 years. So, this present value, which is basically spot, continuously reduces. It reduces at what rate? It reduces at the rate of 1 by 15. Every year it reduces by one portion out of 15. Right? What is 1 by 15? 1 by 15 is equal to 0.0667. Now, this is the reduction. This is the reduction in the spot value. So, now you can actually come back here, and this is the formula what I gave. See here, this is the formula what I am explaining. ND1 into S0 into e power minus dt. I call it as dt, you can call it as qt. Q being the dividend rate. What is the dividend rate? We just now found out 0.0667, which is 6.67%. And what is strike? 12.5, risk-free rate is 17.8, spot is 16.7, which is what I told here, and strike we already wrote K as 12.5, then time is 15 years and sigma square is 26.8. Now, you have to substitute all these data points and arrive at the value of call. What will I do after arriving at the value of call? First, let us arrive, then I will tell you what you are supposed to do. Okay, so natural log of S0 by K. S0 is 16.7 by 12.5 plus, this is D1, I am computing D1, plus R is how much? 7.8% minus 6.67% plus 26.8% by 2 whole thing into 15 divided by 26.8 under root into 15. Sigma root T, sigma is square root of 26.8. So, D1 you will get as natural log of 16.7 divided by 12.5, which is 1.336. Have they given this value? Yes, they have given us this value, 1.336. Okay, then plus 7.8%, 0.078 minus 0.0667 is equal to 0.0113. 0.268 divided by 2 is equal to 0.134 plus memory recall, you will get 0.1453 plus 0.1453 into 15 whole thing by 26.8 into 15 is equal to square root 20.0499, so you can take 20.05. So, this will be natural log. What have they given? They have given us 0.2897. 0.2897. See, I have the solution here, but I am still solving so that you can solve with me. 0.2897 plus 0.1453 into 15. I have basically solved this, okay, is 2.1795 by 20.05. 2.1795 plus 0.2897 is equal to divide by 20.05. You get 0.268 into 0.15 square root. See, this is where I made a mistake. It is 0.268 into 15 square root 2.0. See, that's where I made a mistake. I was wondering why am I getting a different answer. 2 point. This is 2 point. So 0.2897 plus 2.1795 divided by 2.005 is 1.2315. Now 1.2315 is D1. What is ND1? We have to go back to our natural log table. In this question, they have not given. In exam, they will give you. Okay, so don't worry about it. 1.2315. So I'll clean up from previous problem whatever I've had. 1.2 and 2397. So 2315. So you can take in between these two, 0.8907. Okay, 0.8907 will come back. 0.8907 or 08. So here what have I taken? I have taken as 8910 because I got the exact value there. So in exam you can take, if it is very close, you need not work it. So you can take 0.8907. Then what is D2? D1 minus sigma root T. What is sigma root T? Sigma root T is this 2.005. What is D1? D1 is 1.23125. So 1.23125 minus 2.005. You get D2 is equal to minus 0.773. And when I told you, when you have minus value, it is 1 minus D2. So it is 1 minus n of minus n of minus D2 is equal to 1 minus n D2. So 1 minus natural normal distribution, standard normal distribution cumulative value of 0.7734. Let us see what is 0.7734. 0.7734. So it is 0.77 and versus 0.778. So it will be somewhere between these two, 0.7794 versus 7823. It will be 0.777800 or something like that. 1 minus 0.7800, you get 0.2200. See, you got 2.2196. They will give you these values, you need not worry. I am looking at the table and solving. If you are given the table, you do interpolation, arrive at these numbers. Okay, then what is the value of the call option? Value of the call option is ND1 into S into e power minus QT minus ND2 into K into e power minus RT. What is ND1? We have the value here. ND1 is this 0.8907 or 8910 is what they have taken, because we have taken a interpolated value, into S is spot, into e power minus 0.000667 into T, that is 15, e power minus QT, please do not forget that, which makes it e power minus 1.005. Then 0.2196, which is ND2, which is what I got here. Instead of 0.2196, I got 0.2200 into 12.5, which is the K value, into e power minus RT, which is minus 0.078 into 15. So e power minus 1.17. Have they given values, e values for both? Yes. If they have not given, you can use the calculator trick that we taught and you substitute them here. You substitute them and simplify, you get a value of the option as 4.6192 million. What does this value of 4.6192 million mean? See, this means that the option to grow has value of 4.6192. If it has value, what should you do? This is a growth option. If this particular option has value, then should you invest or not invest? The question they are asking is determine the value of the payment. The value of this particular patent is this. So if the patent is worthless, ideally they could have also asked, because you have the patent, should you go ahead and invest? Yes, you should invest because you are going to get this. The patent has some value, $4 million of value. So that is what is the answer you are supposed to give when you are asked questions like this. Okay, this is question number 24. Then next let us come to question number 25, 28 and 35. So friends, now let us look at a problem where we actually use the risk neutral pricing methodology. So IPL is in production of fertilizer and is considering a proposal of building a new plant to produce pesticides. Suppose the present value of the proposal is 100 crores without the abandonment option. So abandonment, what did I say? Put option. Okay. PV of the proposal is 100 crores without abandonment. However, if the market condition pesticide turns out to be favorable, PV of the proposal shall increase by 30%. So if things are favorable, it will go up by 30. In other hand, market conditions remain sluggish, PV shall reduce by 40. It will come down by 40 and not 240. In case the company is not interested in continuation of the project, it can be disposed of for 80 crores. If the risk-free rate of interest is 8%, what will be the value of the abandonment option? What did we just discuss? We just discussed abandonment is American put. So please note one very, very specific thing. Any kind of American option is more valuable than same type of European option. For given data of strike price, spot, if interest rate, time, variability and all of that, American option, because it has greater flexibility, it is always slightly more expensive than a European one. So if you get the value of a European one, it is as good as having gotten a baseline value for an American option, because there is no other than using binomial tree based approach, there is no other way to value an American option, whether it is put or call, it doesn't matter. So this particular American put, abandonment is American put, we will value as if we are valuing a European put, and then we will say at minimum this is the value. Okay. So let us see. What is U? U is 1.3. Why is it 1.3? Because they said it can go up to by 30% and it can come down by 40%, which is 0.6. So U and D are 1.3 and 0.6. What is the risk-free rate? Is 8%. And how many years is it? They have not given years. So here you assume 1 year. If they have not given year, you have to assume 1 year. See, ideally they should have given that year, but anyway, that is unfortunate. So you compute probability. What is probability? E power RT minus D by U minus D. You use the same thing. What do you get? 1.08, which is your risk-free rate is 8%. 1.08 minus 0.6 by 1.3 by 0.6. You get 0.6857. Please note, in this problem, there is a slight twist. What is this? 1 minus P is this. Now, the project is going up. The project overall value goes up to 1.3. Project comes down to 0.6. You are supposed to value a put option. What is a put option? Put option is right to sell. It is not, we are not trying to say whether we should invest in the project. We are saying whether we should divest in this project. That is, does the put option have value? Not the should we make any investment. What is this? Proposal for building a new plant. Suppose present value of proposal is 100 crores without abandonment. They are saying without abandonment, this is the present value. What if I can sell it off in between? Then what is it? If I invest 100, if I dispose off, I'll actually get 80. That is, if my business does not work out well, I will get 80 crores. If my business works out well, I'll get 1.3. 80 lakhs and 80 crores, and this is 130 crores. Okay, my bad. 80 crores and 130 crores. So when you are abandoning, present value is coming down to 0.6, but if you abandon, you will get 80 crores instead of the present value of the cash flows. So the way you look at it is, you and the probability of success of what? Of the project is 68. We arrived at what here? Some 68.57. So that is a probability of success. If it succeeds, put option will have value or no value? It will not have value. Put option will not have value. So there you multiply by 0. This is the critical thing in this problem. Whereas if you were to, the project were to fail, then what is the put option value? It is the difference between these two. That is your present value of cash flows, that is the price at which you can sell minus the present value of cash flows, which is 20. So negative, or rather if you have a negative outcome, you are going to get 20 crores more. That way you arrive at the expected value of the option in future. You discounted by the present value factor, you basically get the present value of the put option. So see, this is a slightly twisted problem, right? You are talking about put, so you are talking basically about abandoning. So basically you are selling. So if project is doing very well, you will not make money because you have a right to sell. Why will I sell off the project when the project is making more money? Correct? So this is a twisted problem which I want to showcase to you guys. Okay, we have done 25. Then let us go to next. There are a bunch of other problems also that you can actually go through on your own. What we will look at is some kind of questions, MCQs, type questions for real options. What are these MCQs? Again, these are various types of various scenarios. You have to identify whether it is an American call, European call, or whether it is an abandonment or growth or timing or what it is. Okay. This is not in institute material. This I have created. I have taken it partly from I think Burley Myers and a couple of other books. So let us see. Drilling rights to undeveloped heavy crude in North Alberta. Development and production of the oil is in negative NPV endeavor. The break-even price is 32 per barrel versus a spot price of 20. However, the decision to develop can be put off. Put off for 5 years. Put off means you can delay. Delay means timing. Timing, delay. Delay is timing. Timing is American call. That is, you have a right to invest whenever you want. Development costs are expected to increase by 5% per year. So let us see what we say. Let us see what is said here. The case depicts an American call regarding drilling rights for underdeveloped heavy crude oil. With an initial excise price of 32 per barrel and ability to delay development plan for 5 years due to increasing cost, it falls in the category of a timing option. Next, a restaurant is producing net cash flows after all out-of-pocket expenses, $7 lakh per year. There is no upward or downward trend in cash flows, but they fluctuate as random walk with standard deviation of 15%. The real estate occupied by the restaurant is owned, not leased, and could be sold for $5 million. This is what? This is a right to sell. Sell is basically abandon. If you're abandoning, it is a put, and you can do it anytime. So it is an American put option. Related to abandonment option for selling a restaurant's real estate, considering annual cash flows of $7 lakh, an excise price of $5 million, standard deviation of 15% in cash flow variability. So we're just summarizing what is given. In a variation to part B, that is above question, assume the restaurant faces known fixed costs of $3 lakh per year incurred as long as the restaurant is operating. Thus, net cash flow is 1 lakh minus 3 lakh, which is 7 lakhs. Annual standard deviation of the forecasted of the revenue less variable cost. Revenue minus variable cost is 10.5%, the interest rate is 10%. What is this? Here, the fluctuating cash flows of $1 million with 10.5% variation with fixed cost of 3 lakhs, not lakhs, indicate American put. This is also an American put, indicating an abandonment option with varying cash flows and exercise price of 8. How did I get exercise price of 8? Exercise price of 8 is, you get $5 million is the excise price, plus you will save $3 lakh per year if you don't have this. So 3 lakh by 10.1 is 3 million. So 5 million plus 3 million is 8 million inclusive of property sale and annual savings. Then a paper mill can be shut down in periods of low demand and restarted if demand improves sufficiently. The cost of closing and reopening the mill are fixed. You can close, open. What is close, open? Both. It is, you can start whenever you want, you can stop whenever you want. It's a mix of both call and put. So, paper mill's ability to temporarily shut down, restart with fixed closure and operating costs reflects a compound option, a combination of American put for abandonment and American call for temporary restart. A very unique kind of a thing. Then, a real estate developer uses a parcel of urban land as parking lot, although construction of either hotel or apartment building on land would be NPV positive investment. In this situation, you have to build either a hotel or apartment building. Both of them are building. Building means you basically are making an investment. If you are making an investment, but you can make an investment whenever you want. So it is basically a timing option. So it is a situation where real estate developer can choose between building a hotel or an apartment, both profitably. It represents an in the money American call. If it's timing, it is call. So please remember this: growth, European call; timing, American call; abandonment, put. Okay, then Air France negotiates a purchase option for 10 Boeing 787s. They must confirm the order by 2030, otherwise they will be free to sell all aircraft to others. You have to confirm. So, if your goal is to buy whenever you want, anytime before 2030, right, or rather confirm your purchase by 2030. So, it is basically an American call option, which is timing. You can choose when you want. This grants Air France flexibility to confirm purchase anytime, resembling a timing option rather than a growth or abandonment choice. Very interesting, right? So, you may or may not be asked this question, but I thought something like this will be really helpful for you to understand this concept of what is European call, what is American call, and what is American put with respect to real options only. Okay, now we have done this, then 25, 28, 35. Now, let us look at illustration 35. This is a November 23 question that caused a lot of heartburn. Okay. Let us see why. Following is information available pertaining to shares of Omni Limited. See, even though this is not part of the real options, this is actually a normal options question. I want to specifically do this because this is the kind of questions the institute is going to ask. Current market price is 420, strike price is 450, maximum price in next 3 months is 525 and minimum price is 378. Continuously compounded rate is 8%, e power RT is 1.0202. So, they have given already e value. Calculate 3 months call option by using binomial method and risk neutral method. What is binomial? I explained to you two things. Binomial is your delta shares approach or portfolio replication approach. Second is risk neutral is e power RT. Now, in exam, a lot of students, because there was binomial method there, they used e power RT methodology. That was it is unfortunate on institute's behalf, because in some problems they themselves have done that. But in this exam, if anyone who did it like that, they did not give marks. So, as far as the institute is concerned, this binomial method refers to delta or portfolio replication. Okay, and risk neutral is e power RT. This is what it is. Okay, even though they have given e power RT, you are supposed to use it here only. So what is it? Spot. Today market price is 420K. That is strike price of the option. They have said call option. Okay, strike price is 450. SU is 525. SD is 378. 525 by 420 and 378 by 420, you get 1.25 and 9.9, which are values of U and D. E per RT they have already given. So if you draw a binomial tree, I am not talking binomial method, I am just saying binomial tree, 420 can go to this level or this level when it is at, and strike price is 450. So here the value of the option payoff is 75, here the option payoff is 0. Now under binomial method, delta hedging using delta shares. What is delta shares approach? You basically sell a call option and buy delta shares in such a way that this portfolio gives same payoff as your option. So what is delta here? Change in price of the option is 75 divided by change in price of the share. 525 minus 378 is 147. So 75 by 147 is 0.510. So delta is 0.5102. Please be careful, round off to 4 decimals. Create a portfolio of long delta and short one. This is a short one call. This is what I was saying. Present value of this portfolio is today. If you have this portfolio, your S0 into today you have this portfolio, it is S0 current spot into this delta, which is what the shares that you will have, minus call. So 0.5102 into 420 minus call option. So 214.284 minus call option. This is equation number 1. Now what is the future value of this portfolio? That is when the stock value moves up. Stock value moves up to what? 525. It moves up to 525. It is 525 into 0.51 minus 75. You basically get 192 rupees. When it moves down, 0.51 into 378 minus 0, you get again 192 rupees. So both these portfolio, or rather this portfolio is giving same value whether the stock moves up or down. So this portfolio basically is, despite volatility, is giving you its value is not changing. So basically it is generating risk-free return. If it is generating risk-free return in future, the present value of this particular portfolio will be present value of the future value of the portfolio at risk-free rate, discounted risk-free rate. So what is the future value of this portfolio? In both scenarios, portfolio is 192. So 192 is the future value. What is the present value? Divide by 1.0202, or how did I get 1.0202? E power 0.08 into 3 by 12, because it's a 3 months option. So by 4, which is e power 0.02, which is 1.0202. Okay. So you get 189. 189 is the present value of the portfolio. What is the present value of the portfolio? 214 minus C0 is equal to 189. So 214, you equating these two equations, or looking at both these equations, you get the cost of the call, or the price of the call, as 25.247. Value of the option is 25.247. So using delta approach, this is how you solve it. Now using replicating portfolio. What is this replicating portfolio? You create a portfolio of shares and borrowing. Okay, that generates same returns of the portfolio will have same value, which is delta shares plus loan, which is what I was telling you, shares plus borrowing. Now you have 0.51 shares with current spot plus loan, which is 214 plus loan. Future value of this portfolio is 525, because the share price is going up, it will be 525 into 0.51 plus loan. If the share price is going down, 378 into 0.51 plus loan. So you get two values, 267 plus loan and 192 plus loan. Now this loan, if the future value of the portfolio is equal to future payoff of the call, what is future value of the portfolio? There are two values, these two, right? Payoff of the call in first case is 75, payoff of the call here is 0. So if you put that in this particular equation and solve for value of loan, then loan value is equal to minus 192, because loan is a negative number. If your investment is positive, loan borrowing is negative. So, and again, that is future value of the loan. So present value of the loan is 189. Present value of loan is 189, and you substitute in this equation number 1. What is equation number, or rather A, which is 214 plus loan is the present value of the portfolio. 214 plus loan, and loan we have already got. Loan value is how much? 189. So 214 minus 189 is present value of call. So present value of call is 25.244. How much did we get earlier? 25.247. Slight rounding of error. That's all. Either way you can use. In exam, both the methods will give you marks. Then risk neutral method. What is risk neutral method? You're not required to solve both methods. In risk neutral, you're supposed to solve, but in binomial only one. Risk neutral, e power RT minus D by U minus D, which gives you probability. So 1.0202 minus 90 by 1.25 minus 90. You get 34.34 is up move, 65.66 as down move. Present value of the call. Present value of the call is, present value of the payoff is the value of the call. So future payoff 75 with probability of 34, payoff of 0 with probability of 65, whole thing discounted at 1.0202, you get same 25.247. So even with this binomial approach, you get the same thing. Binomial also, there is one more way. Expected value of the stock based on option volatility is equal to expected value of future stock. So if there is a futures are indicating a price for a share, the options also should indicate the same price. So if you are getting a payoff from the futures, the same payoff should happen for option. Only then there is no possibility of arbitrage. So what is the expected value of the stock based on futures price? 420 into e power RT, which is 428.484, e power RT 1.0202. What is the expected value of the stock based on options? 525 into P plus 378 minus 378P. So that way also you can get value of P as 34.34, and we can again arrive at the value of the call. Value of the call is 25.247 or 25. Okay. Now, what is the second question? Are the calculated values both under same models? Of course, they are both under same models. Clearly state basis of valuation. This is where again a lot of students lost marks. What are the basis of valuations for both these? Under binomial method, we use delta shares to hedge, and each portfolio has same value, generating risk-free returns. Under risk neutral method, risk neutral probabilities are used, and based on the principle of no arbitrage, the value of option is arrived. So under binomial method, you create a portfolio that gives you risk-free returns. You don't use any risk neutral probabilities. Risk neutral probabilities are used only under the risk neutral method. And risk neutral method says that there is possibility of no arbitrage. That is, the probabilities are adjusted in such a way that there can be no arbitrage. If anyone, no arbitrage, because everyone will generate a risk-free return, right, no matter which way the option moves. That is the principle under risk neutral methodology. Whereas under binomial method, you basically are saying there are portfolios which will generate same returns, which will equate the value of the call. Here I am referring to the delta shares plus borrowing approach. If you use delta shares minus call, there also you are basically saying the portfolio value is equal, then it will generate only a risk-free return. Portfolio value is same under both circumstances, up as well as down. The volatility is 0, meaning it generates risk-free return. So that is how we arrive at the value of the call. So you are supposed to write that in this particular answer. A very interesting question. For both binomial as well as risk neutral, I have solved two methods. In exam, you need to solve only one. Okay. So this concludes our questions part of options. Now let us jump in back and go back to some theory. We have covered real options anyway. So what are the other things that are there in theory? You have something called as exotic options. What is exotic? We'll see. After exotic options, you have something about credit derivatives. These are two big topics: exotic options, credit derivatives. Then in credit derivatives, we'll talk about CDS, default events, main features of CDS, uses of CDS, parties to CDS, how is it settled, what is a credit linked note, asset-backed securities. All this is there. These are all important things. One question at least can come from this. What are CDOs? It may be a simple question or a complex question, doesn't matter, but something will come from this for sure. Types of CDOs, risks involved in CDOs. Okay, then we already saw real options. Then commodity derivatives, this has been asked in the exam in the past also. Participants in commodity derivatives, factors influence commodity pricing and trading in commodity derivatives, commodity options, commodity swaps, embedded derivatives, weather derivatives, issues in pricing weather derivatives. What are electricity derivatives, electricity forwards, electricity futures, electricity swaps, lessons from derivative mishaps. So you have 4 or 5 topics which are dense theory. Dense means thick, good element of theory. So this is what we are going to look next. We will start from beginning, which is first we'll start with exotic options, then we'll move to the other aspects. Okay. So now let's look at the first thing. What are exotic options? Exotic options are something which is between American and European, or where there is some problem between spot versus strike, where things can be different, where it is between call versus put. So any of the factors that go into pricing an option can change. Let us see what we mean. Exotic can vary in terms of payoff of time and exercise. They can be more complex. They are traded in OTC. They are not traded on exchange. What are the most common type of exotics? Chooser options. A chooser option is one provides a right to the buyer of option after a specified period prior to expiry to decide whether purchased option is call or put. Wow, 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 wow. What a great option. So you buy an option, depending on which way the price is moving, you will choose whether you want to call it a call option or a put option. And what will be the premium of such an option? It will be the highest of the call or put premiums at the beginning of the option. So you have a standard strike, standard spot, standard time. But whether it is call or put, you don't know. So you find out the price of both call as well as put. Whichever is highest, you charge that for buying this option. And then the buyer of the option prior to contract expiry at certain point of time will decide if it's a call or put. Premium will be the max of price of call or put at the time of initiation of the contract. Super option, no? Chooser option. Next is compound option. What is compound? It's also split fee option or option and option. That is, this option provides a right or choice, not an obligation to buy another option. So I buy an option to buy another option. Or I buy an option, buy another option at a specified price on the expiry of first maturity date. So I buy an option on the maturity date. I have a right to on the maturity date. This first option gives me a right to buy another option. So it can be said this option, the underlying is an option. The option payoff depends on the second strike price, on the strike price of the second option on the date of the exercise price of the first option. So if the second option is priced higher than what it originally was, then the first option will be exercised. So I pay 10 rupees. I now have a right to buy a call. Okay, so let's say I do a buy call for 10 rupees. Okay, what does this 10 rupees give me? I have a right to another buy call at 10 rupees or let's say 9 rupees. Now, when this particular option matures on this date, this is first option maturity date. On this date, if this buy call in the market freshly is quoted at 10, I will buy this at 9. If it is in the freshly in the market, if the new option, the second option is quoted only 8, whereas my right is to buy at 9, I will go into the market and buy it at 8. So it is a right to buy an option. An option itself is a right to buy something, but this is a compound option is a right to buy another option. Types of compound, you have a right, you have a call option to buy a call, you have a put option to buy, you have a put option on a call, that is you have a right to sell a call. You have a call on a put, that is you have to right to buy a put option, a put on a put, you have a right to sell a put option. Okay, very interesting, right? Then barrier option, this is something very interesting, which is unique feature of this option is that contract will become active only if the price of the underlying reaches a certain price during the predetermined period. Types of barriers are knockout and knock-in, further subdivided as down and out, further subdivided as down and up options. So what do you mean by that? You'll understand. Knockout. If the underlying asset price reaches a certain level, the option ceases to exist. So I have a right to buy something. So I have a right to buy something at 10 rupees. Okay. However, this is K. Currently the spot is, let's say 8. If market price or ST is 11, the option does not exist. If the market price is less than 11, the option exists. Okay, so if it goes up than a specified level, it is out, meaning the option does not exist. If it goes up and it in meaning, so I have a right to buy it at 10. If the market price crosses 10.5, then my option is existence. If market price is less than 10.5, then it is not in existence. Exactly ulta. You can have this for, see, I am telling you about a buy call. Okay, so this can be for a put also. So up and out and up and in, that is above a certain level. Down and out, down in means below a certain level. Below a certain level, and again down and out, down and in. Down, if it goes below a certain level, the option does not exist. If it goes below a certain level, the only then it exists is down and in. This again can be for a call or a put. Very interesting varieties of options. You will not get any questions in exam, please don't worry. So in exam, you need not explain this whole story of what I said. Okay, this is for you to understand. You can basically say what is a knockout option, what is a knock-in option. That is, knockout means if it crosses if it's a certain level, knockout, right? So if it's a certain level, it ceases to exist. Knock-in means if it reaches a certain level, it comes into existence. This can be both up and down. That is, up means if it crosses a certain level or if it goes below a certain level. Okay, so this is a very interesting option. Then you have something else, binary option, or also known as digital option. This option contract guarantees the payoff based on happening of an event. If the event has occurred, the payoff shall be pre-decided amount. If the event has not occurred, there will be no payoff. That is, and here also there are again two, cash or nothing or asset or nothing. What is this? Cash or nothing. If stock price reaches 10, I get 100 rupees. If stock price is below 10, I will not get anything. Asset or nothing. If stock price reaches 10, I will give you the stock. If stock price does not reach 10, I will not give you the stock. Basically, again, it's a call option because you are buying, right? You are getting money. Then you have something called as Asian option. These are option contracts whose payoff are determined by the average of the price of the underlying over a predetermined period of the lifetime of the option. So payoff is determined by the average of prices. So average payoff is what? Market price is replaced by average of market price. So Asian average buy call payoff is max of spot average minus strike. Put option is strike minus spot average. Instead of actual spot and due date, you take average of 3 days, 4 days, 5 days. Average strike option. So here first we saw average price option. Now we are seeing average strike options. Here the strike price is an average of previous prices. Here also the strike price is average of previous prices, whether it is buy or whether it is call or put. Then you have Bermuda. Bermuda, as a if you know geography, it lies somewhere in the Atlantic Ocean, somewhere between Europe and America, which is why it's called Bermuda, right? It is neither American nor European. Let us see what it is. It's a compromise between European and American. The exercise of the option is restricted to certain dates or on expiration, like European option. That is, you cannot exercise any time, but you can exercise any over 3 or 4 time periods. So you can exercise either on this day or on this day or on this day or at the end. So you get multiple options to exercise. Basket options. In this type of contracts, the value of the option is dependent on the value of a portfolio. There is a basket instead of a single asset. Generally, the value of the option is computed based on weighted average of underlying constituting the basket. So, instead of one asset, I have a right to buy something. I have a right to buy 3 shares of HUL, ITC, and Dabur. Okay, so there is a basket of these 3 shares. So I have a right to buy the value of the option in this type of contract. Value of the option depends on the value of the portfolio. That is, whatever happens to this portfolio, depending on that, I have an option. I have a right that kicks in. That is, I can buy all 3 shares at predetermined price. Then spread options. The payoff of these options, type of option, depends on difference between price of 2 underlying. That is, crude spread, bond spread. So I have a right to buy a bond if GSEC versus corporate bond AAA bond spread is more than 200 basis points or 300 basis points, something like that. You can create options which are on spread. Look back. In this option on maturity date, holder of option is given a choice to look at the most favorable strike price depending on minimum and maximum price of an underlying asset achieved during the lifetime. That is, example, a buy call, the holder can choose the lowest price at which the underlying traded during the life of the option. So I have a right to buy not at a predetermined price, but a lowest price in last 1 month. That is called as a look back option. Very interesting. So from an exam perspective, they will not ask you to, there is no valuation methodology and all of that in this. It is, they are going to ask you potentially they could ask you what are various types of exotic options. Explain barrier options, explain look back options, so things like that. So it is important that you study and go. You need not spend hours and hours together in all of this. These are interesting stuff. You please write down stuff, somewhere, or go through this once a day for 4-5 days. You will be able to remember this. It's not very, very fancy. It is very simple only. Okay. So this is about exotic options. Next we come to something called credit derivatives. Now this, I actually dislike what they did. They did not cover 2008 Lehman crisis, because that is the perfect example of credit derivatives gone wrong. And in fact, there's a movie also called Big Shot, which I've given as a reference in my full-fledged classes, where I say people should watch it. There's some age guidelines to that movie, but it's a very wonderful movie. Okay, now that is one. Second thing, what I have a problem is, this is a very, very detailed topic. Now what I have done is, entire credit derivatives full topic, it's I think a 2 or 3 hours something, I put it up free of cost on my YouTube channel. So if you want a deeper understanding of credit derivatives, please go there. Go to OneFin final or as well as the main channel, OneFin by IndigoLearn, and search for credit derivatives video. I have given the 2 to 3 hours, whatever video is there, fully is available. But in this revision, I am not going to cover this in that great depth because that alone will take 2-3 hours. I don't want to do that. So this is a revision. This is not a full-fledged discussion. So I will not be covering it in greater depth. If you want greater depth, there is a free video that you can watch. Okay. Now let us look at what are credit derivatives and look at the various types of credit derivatives. We are going to learn about something called as CDS, credit link note, asset backed securities, mortgage backed securities. Largely we are going to learn about these 4. Okay. First, what are credit derivatives? These are started in 96 to meet needs of banking institutions. These are typically if you are working in the markets, you are exposed to market risk as well as credit risk. Market risk means basically price, that is price changes and all of that, but there is also something called as credit risk. You use normal options, futures and all of that to hedge the price risk, whereas credit risk, in order to hedge the credit risk, you use credit derivatives. So it's also called as counterparty risk. Financial derivatives can be used to hedge market risk. Credit derivatives mitigate the credit risk. It is a mechanism whereby risk is transferred from risk-averse investor to those who wish to assume the credit risk. CDS and CDO are 2 types of credit derivatives. What are CDS? CDS are credit default swap. So credit default swap is, let's say initially there is a loan given, basically a credit is extended, and in of that there is a default. When you say default is also defined. Generally we think default means somebody is shut shop and ran away. No, there are various levels. You defaulted on some covenants, you delayed some payments, you don't make payments, the company is completely bankrupt. So you have various levels. Any of those, then we both swap liability. So if I as an individual am buying a credit default swap from you, I am selling the risk to you. You are buying the risk. So if anything happens to the company, let's say I have RIL bonds, and against RIL bonds I am buying CDS from you, then if anything happens to RIL's bonds, and the bonds price comes down or something happens, we will define an event, then RIL's bonds face a default event, the credit default event, then you will pay me X rupees, or we will swap liabilities. That is, I will sell you the bond at predetermined price and you will give me the money. Okay, so that is basically what a CDS is, very broadly. Buyer gets protection against default of a bond or a debenture from the seller. So I am a buyer of the CDS. I have the bond. I am buying the CDS from you. So I am shorting the risk and you are longing the risk. The buyer pays a periodic premium to seller who assumes the default risk. In case default takes place, there will be settlement, and in case of no default takes place, no cash flow will accrue. So that is, if RIL doesn't default, I keep paying you premium. Just like insurance premium, you don't pay me back anything. Just like an option contract agreement is terminated. Although it resembles options, since the element of choice is not present. That is, there is no choice. If there is a default, then there is automatically swap, which is why it is called as a credit default swap. What are various default events? Bankruptcy. A bankruptcy protection filing allows the defaulting party to work with creditors under supervision of the court. So basically, I was telling you various events. One is bankruptcy, failure to pay. When issuer misses a coupon or payment. Restructuring, when there is a restructuring. So when there is a restructuring, the financial restructuring or change in terms or anything like that. So any of these events can be called as a credit default event, and a credit default swap can be triggered. Now, can any of them be called? It depends on the CDS that you are entering into. The contract specifies what is a default event. What are main features of CDS is very simple. It is non-standardized, it is private between 2 parties, it is mostly OTC. Not normally traded on exchange, hence remains free of regulations. ISDA guidelines. So ISDA is an international swap and derivatives association. They have a documentation. They publish the guidelines and rules normally used to carry out the contracts. They can be purchased from third party to protect from default. So I have RIL bonds and I am buying CDS from you. Okay, I am not going to RIL to buy that. I am buying the CDS from you. That is, you are a third party when I have a bond with RIL. Individual investor who is buying bonds from a company can purchase CDS to protect investment, thus increase the level of confidence of investors. So for me, the confidence on RIL bond investment is increasing. The cost of premium CDS has a positive relation with the risk. Therefore, higher the risk, higher the premium. So if RIL is expected to default, you will charge higher premium. If RIL has very, very low probability of default, you will charge very low premium. Investor buys a CDS without being exposed to risk of the underlying, it is called naked CDS. So if I don't have RIL bond, in earlier case I said I have a bond and I am scared that RAL may default. So I am coming to you and buying a CDS. If I don't have a bond and come and buy a CDS from you, basically I am doing a naked CDS transaction wherein I am speculating. What are various uses of CDS? Hedging, arbitrage, speculation. Speculation I just discussed. Hedging is where I already have a bond and I am buying a CDS from you in order to hedge my credit risk. And what is arbitrage? Buying CDS and entering into an asset swap. For example, a fixed coupon payment of a bond is swapped against a floating interest stream. So you can do swaps also. About swaps, it is covered in the interest rate, risk management chapter. So in that part, you will study about swaps. But generally, if you buy a CDS and enter into an asset swap, that is, you convert, for example, a fixed rate of coupon of bond is swapped against a floating interest streams. So you can basically combine a CDS with a fixed plus floating swap in order to take advantage of any mispricing benefits or any advantage of any mispricing between fixed and floating rate bonds. Who are the parties to CDS? Initial borrowers. Initial borrowers are called reference entity. RAL is the initial borrower. Buyer called investor. I am the investor who is buying the CDS. I am buying the protection. Then seller, you are the seller, you are the one who's selling, you are also called as writer, you are selling the protection. So you receive frequent insurance payments and in case there's default event, you will give me money. Okay, that is you are a seller. How is CTS settled? You have two kinds of settlement, physical and cash. Physical means I give you the bond, I deliver the bond and you pay me the money, or cash settlement, whatever is the current market price of the bond versus the agreed price, the difference you pay me whenever there is a default event. What is a credit linked note? Now we have talked all about CDS. Now we are coming to the second one, credit linked note. What is a credit linked note? See, what happens in a credit linked note is people who do not have exposure to certain companies or certain sectors, but they want that exposure. They want specifically credit risk exposure. Okay, for which they want to be compensated. They take exposure for which they want to be compensated. So a bank, let's take some bank. This bank has originally lent to, let's take some example, Tata. Now there is somebody else who wants exposure to Tata. They don't want just the return of the Tata. See, if you give a loan, they just don't want the interest from Tata. They basically want both the credit exposure as well as the the exposure on borrowings made by Tata. Why is it? Because they have some idea of the group. They believe that they will default, may not default, whatever the reason be. So a third party is coming to the bank and saying, I want to take that exposure, but I don't want the loan. Now you yourself can give the loan, no, arey boss, but Tata will not borrow from me, whereas they'll borrow from me. Oh, okay. So the bank is lending to Tata. Third party is coming and saying, now you don't transfer me the loan, okay, don't transfer me loan. This is not securitization kind of a thing, it's something similar, but in any way. But I want now credit risk. So what they do is they create something called as a credit link note. Let us see what it is. It's a form of funded trade derivative. It is structured as a security with an embedded credit default swap. It is structured as a security with an embedded CDS, allowing the issuer to transfer specific credit risk to credit investors. So there specific, I want the credit risk, you will transfer the credit risk. Issuer is not obligated to repay the debt if a specified event occurs. This eliminates third party insurance provider. If a structured note issued by SPV or trust designed to offer investors par value at maturity unless reference entity defaults. In case of default, the investors receive a recovery rate. Purpose is to pass on the risk of specific default on to investors willing to bear that risk in return for higher yield. It makes available. The CLM themselves are typically backed by very highly rated collateral such as US securities. So I want credit exposure on Tata. There is a bank, or let's say you are the bank. So what I will do is, you as a bank have already lent to Tatas. So what I will do is, I will give you some money. Whatever your money you have lent to Tatas, I will give you the money. Okay. That money is put it in SPV, and that SPV invests it in government bonds. Okay. If you look here, that money is invested in SPV. It is put in an SPV. It is invested in government bonds. Whatever is the return on that comes to me because I am the investor. Okay. And the bank who does not want the credit risk, makes premium payment just like CDS, not CDS, same as CDS, like CDS, the bank keeps making payments to the SPV. So the premium payments are made. collateral return, whatever is the collateral, whatever is the return on that, plus this premium is passed on to the investor. So the investor is offering protection and it is funded. So the money is already in a trust. If a default event happens, this entire money moves to the bank. So the party who is putting in the money, instead of directly lending to Tata, bank has lent to Tata. These people are giving money to in an SPV, and the bank gets the money from the SPV in case there is a default event. For this, the bank continues to pay premium. The premium is transferred to the investor. The initial money put in by the investor also earns some return. That is also transferred back to the investor. So this is how it works. So they will get certain return. CLNs are bought by the investors, which are created at the time of issue loan itself, and then the interest rate is determined by the credit risk of the company, and then whatever I've discussed, actually that is what works out. Now we have something called as ABS. What is an asset-backed security? So you have to understand these two terms called ABS and MBS. Both are very similar. ABS is, you have various types of loans like a car loan, housing loan, then personal loan, credit card loan. Various types of loans are for various tenors. Some of them are 1 month, 2 month, 3 month, 1 year, 5 year, 10 year, like that. All these loans that are issued by a bank are pooled together. So you pool. Okay, this is like that same securitization what you've learned. Pooling of all the various assets of the bank. These are put in an SPV. The SPV combines all of these loans and creates again 4 different securities. See, there are multiple types of loan for $100 million. Then you have 3 securities of 80 million, 15 million and 5 million, basically 100 million. So you are combining everything and then separating parts of those loans and issuing new securities. That is what is an asset-backed security. It is a security, these are bunch of securities issued based on cash flow streams that are generated from multiple hundreds, difference of thousands of loans. So you are combining hundreds and thousands of loans. Their cash flows are pulled in, and from those cash flows you are issuing new securities. One is called senior tranche, where you get very low return because the risk is low. Then you have mezzanine tranche, where the risk is slightly higher. Then you have equity tranche, where the risk is very high, which gets a much better return. It's called equity tranche, but you get a return which is LIBOR plus 2000 bips. Whereas mezzanine is LIBOR plus 250 and senior is LIBOR plus 60. So you combine loans, then again parcel them, cut them into making pieces, join them as something separate and then sell off those. Now what happens in this is, if the cash flows are sufficient, first they are paid to the senior tranche. So when the cash flows come in from all these loans, they are first paid to the senior tranche. Whatever is left goes to mezzanine. Whatever is left after paying all of them goes to the equity tranche. So it is called as a waterfall of asset-backed securities, which is why the equity tranche has very high interest rate. Now, if something small happens in all these loans with mortgage loans, if let's say all home loan owners or all home loan borrowers suddenly say we will delay. Why? Because interest rates have gone up. Then what happens? All cash flows are hit. If all cash flows are hit, your equity guy gone for a sixer. Okay, so that is what happens. Now, what are CDOs? CDO is an ABS issued by a special purpose vehicle. CDO is collateralized debt obligation, consists of pool of debt such as so and so and another ABS. Wow. First itself, this ABS itself is a nightmare. It is a sin. Now, this is bigger sin. What do you mean by bigger sin? Not only are you combining cash flows from various other kinds of assets, other kinds of loans, you are also adding an ABS into it. Please read. A CDO consists of a pool of debt, mortgage loans and other ABS. So you will add one mezzanine tranche or one equity tranche into other auto loans, home loans, credit card loans, personal loans, and then create another, completely 3 or 4 new different types of security. It is absolutely, this is what caused the Lehman crisis. What are various types of CDO? You have cash flow collateralized CDOs. Basically, it is one which is backed by cash or debt market securities with low risk rate. Synthetic CDOs, it is similar to cash flow, but the difference that instead of transferring ownership of collateral to SPV, they are structured in a manner that credit risk is transferred by the originator without transfer of assets. So synthetic is where there is, see, in cash flow, entire assets are transferred. Here, assets are also not transferred. Okay. While in cash CDO, collateral assets are moved away from balance sheet, in synthetic, there is no actual transfer. Only economic effect. The effect of economic risk is achieved by creating a provision for CDS or CLN. So, In a synthetic CDO, the economic effect of all of these transfer of various assets is achieved by entering into CDS or CLN. This is used to hedge the risk rather than balance sheet funding. Technically speaking, synthetic CDOs obtain regulatory capital relief versus cash CDO. They are more popular in Europe. Now, synthetic CDOs can also be categorized unfunded, fully funded, partially funded. Unfunded is comprised only of CDS, fully funded is issued through CLN, partially is either partially through CLN, partially through CDS. What is arbitrage CDO? The issuer captures the spread between the return realized and collateral underlying the CDO and cost of borrowing to purchase the collateral. In addition to this, the issuer also collects fee for management. This arbitrage arises due to acquisition of relatively high yielding securities with large spread from open market. So there is a possibility of arbitrage also in this when you acquire high yielding securities. What are the various risks involved in CDO? Default risk, one party defaults gone. Interest rate risk. Interest rates have a very, very significant impact. Also called basis risk, arises due to different bases of interest rate. Asset may be based on floating interest rate, but liability may be in fixed interest rate. So you may create a CDO with a fixed payment, but all your inflows may be variable payments. Liquidity risk, liquidity as there is mismatch between coupon receipts and payments. So that you may get cash flow inflow at some time, but you may have outflows at some other time. Prepayment risk, a lot of people prepay when interest rates fall. What do you do? Right, so there is a prepayment risk. Then you have reinvestment risk. You may not be able to reinvest at the same rate. You may get cash. You have to pay somebody 10%, but your current market rate is only 5%. Where will you get the balance 5%? Foreign exchanges. If you do, this is ultimate. So if you invest in foreign currency CDOs, this is the height of financial engineering. Right. So these are various kind of CDOs. What is MBS? I said there is also something called as MBS. MBS it's an ABS created only of mortgage loans. Mortgage loans means housing loans. MBS is mortgage loans. ABS means assets, any kind of assets. CDO means various kinds of assets plus another ABS. Okay, that is called as a CDO. Very interesting, and actually these are the ones that really caused the 2008 financial crash. Anyway, we have finished one major part. Now let us move to the other one. What are commodity derivatives? This was asked in the exam also. So commodity derivative is a raw material primary product that may be related to food. So basically this is all basic stuff that you will know. So commodity constitute major asset class like equities, fixed income instruments and money market. They are basically raw materials or primary products used for consumption. The value of the price of the commodity changes as per demand supply situation. It is a contract whose value is derived from underlying commodity that is settled on a future date. Major commodity exchanges in India are MCX and NCDX. Commodity derivatives available for trading through exchanges are bullion. Bullion means gold or heavy precious metals, base metals like copper and zinc, energy like crude, cereals, oil seeds, spices, etc. Okay. Then who are the participants? You have arbitragers, hedgers, speculators. Arbitragers who try and get arbitrage opportunities, exploit arbitrage opportunities. Hedgers is people who have basically risk on that commodity. Speculators who are trying to make money. Please note one very important thing, FIIs and NRIs are not permitted to participate in commodity futures market in India, because this is where a lot of Indians do the hedging, whereas farmers are exposed and other farmers are hedge their exposure and all that, or traders hedge their exposure. The government did not want foreign money to come and play around with the Indian commodity markets. Then what are factors that influence commodity pricing? Demand, supply, government policies, global economic situation, currency movement, geopolitical tension, market sentiments, investment fund, weather dynamics, seasonal cycles. You know most of these. Benefits, diversification, inflation protection, hedge against liquidity, event risk, high liquidity, trading on lower margin. Commodity is highly volatile. The commodity market is very, very volatile. Okay, it experiences huge swings. What are commodity futures? Commodity futures is an agreement between two parties to buy or sell an asset in certain time in future. There are special types of forward contracts in the sense that formats are standardized exchange traded contracts. They are available for trading in exchanges. The price takes into consideration interest rate, storage cost and convenience yield. So if you remember, I was telling you E power R plus S minus C. R is interest rate, cost of carry plus storage cost minus convenience yield into T. What are commodity options? What are commodity options? There are two types of options call input. So just like normal calls inputs, there is no obligation, there is only an option. The call buyer has an option to buy, a put buyer has an option to sell. What are commodity swaps? So you can basically swap commodity returns. The commodity swap is a kind of a derivative contract where two parties agree to swap cash flows depending on the cost of the underlying. A commodity swap is used to protect against price fluctuations. Fixed to floating, they are just like fixed to floating swaps in interest rate swap, with the exception that both indices are commodity based indices. So you give me floating return in a commodity index, I will give you fixed return 5%, 10%. Commodity for interest, they are like equity swap in which total return on the commodity is exchanged for some money market rate. So please give me some money market rate or spread, and I will give you the return on a commodity index. How are they valued? They are characterized by some peculiarities. They include the following factors: cost of hedging, institutional structure of market, liquidity, seasonality, brokerage fees, credit risk, capital, and other costs. So these are the issues in valuing commodity swaps. Okay, we are not taught how the swaps are valued. That is not part of our syllabus, so unnecessarily need not worry about that. Then embedded derivatives. It is an instrument that is embedded in another contract, the host contract. The host contract might be a debt or equity instrument. Okay, derivatives required to be marked to market through income statement other than qualifying hedging instrument. This requirement of embedded derivatives is designed to ensure the mark to market through income statement cannot be avoided by including embedded derivative in the contract or financial instrument. So they explain how to account this. You have studied in FR. Then we move to something called as weather and electricity derivatives. These are also fairly interesting stuff. Weather, electricity derivatives, and finally lessons from derivative mishaps. So let us go and look at weather derivatives. So what are weather derivatives? What are weather derivatives? They basically are derivatives or weather events. Please note, they hedge volumetric risk. They are not about price risk. It is not crop insurance. Okay, these are basically what is the reduction in my volume due to some metric of rainfall or some adverse weather event. It has its underlying asset as a weather measure like rainfall, which influences the trading volume of goods. The primary objective is to hedge volume risk rather than price risk. The first transaction was OTC, Aquila Energy and all of that. Difference between weather derivative and insurance contract. That is, insurance contract provides protection to extreme low probability weather events such as earthquakes, whereas weather derivatives can be used to protect the holder from all types of risk, including uncertainty, normal conditions that are more likely to occur. So the whole point is, insurance is for extreme events, whether weather derivative is for normal, small, minor changes which can have a significant impact. In a weather derivative contract between a buyer and a seller, the seller receives a premium from the buyer, with understanding that seller will provide a monetary amount in case the buyer suffers any financial loss due to adverse weather conditions. In case no condition occurs, then seller will make a profit through the premium. This is a normal, any kind of derivative contract only. What are issues in pricing? First one is data, forecasting of weather, and temperature modeling. See, reliability of data is a very big channel, not only within India but across countries. Forecasting. Even though a lot of people are there who forecast weather, but it is still not it is not something that we have been able to perfect because there are way too many conditions. And temperature modeling is one of the most important underlying for derivatives. Now, temperature normally remains quite constant across different months in a year. Hence, there is no such model that can claim perfection and universality. Okay. Electricity derivatives, just like weather, you also have electricity. What are electricity derivatives? Spot electricity prices are volatile due to smaller market size, dynamic factors, change in fuel supply patient, weather conditions, so on and so forth. So you enter into derivative contracts to buy electricity at a predetermined price for a predetermined quantity. Okay, that is, we also have an India Electricity Exchange, IEX. If you are not aware, please go and check that. Hedging instruments that reduce price risk for market participants, that is generators, buyers and load serving entities are required. The derivative contracts linked with spot electricity price and underlying can help market participants to hedge from price variation. This will help the buyer to pay a fixed price irrespective of variation in spot. Like other derivatives, electricity derivatives are forwards, futures and swaps. Power contracts also play the primary role in offering future price discovery and price certainty to generators. Okay, so you can do forwards, futures and swaps. Electricity forwards represent the obligation to buy or sell a fixed amount at a pre-specified contract known as forward contract, known as forward price at a certain time in future. They are customized. Payoff from a forward is spot price minus the agreed forward price. Simple, very, very simple stuff. What are electricity futures? What are electricity futures? Same like forwards, but these are cash settled. Okay, that is standardized. You have traded on an exchange. All very similar features. But sometimes these futures may have small delivery portion, but largely it is physical settlement only. In addition, credit risk and monitoring in trading futures are much lower than those in forwards. Okay, gains and loss of electricity futures are paid out daily as opposed to forward contracts. Is also again daily MTM and all that. Compared to forwards, advantage of futures lies in market consensus, price transparency, liquidity, reduced transaction monitoring cost. Though there are limitations of various basis risk associated with routine future speculation. That is, you may not get an exact date related contract in futures. You may get an in between date or end of the month date, whereas you want to buy electricity on 13th of a month, but future contract is available only for 30th of the month. So you may have such kind of issues that will be there. What are electricity swaps? Electricity swaps are financial contracts that enable holders to pay a fixed price for underlying electricity regardless of floating price. These are typically established for a fixed quantity of power, reference to a variable spot price. They are widely used in providing short to medium term price certainty. Like financial swaps, these can be considered as a strip of electricity forwards. An electricity locational basis swap, that is, wherein the holder agrees to pay or receive the difference between a specified futures contract and other locational spot price for a fixed constant cash flow at the time of transaction. So, I will pay you fixed. You pay me the difference between electricity prices of two locations. Okay, locational basis swap. Then these are used to lock in fixed price at a geographic location that is different from delivery point of a futures contract, and hence are effective instruments for hedging risk based on different price difference between lower prices at two different physical locations. So, you pay me difference between Mumbai and Calcutta prices. I will every month keep paying you some 5 rupees. Okay, like that you can enter into swaps. Now, last point, there is something lessons from derivative mishaps. There's a case studies and all. We're not going to discuss case studies. Don't buy product that you don't understand. Do due diligence before making treasury a profit center. Specify the risk limits and separation of front, middle and back offices. Ensure hedger is not a speculator. Carry out enough stress test and scenario analysis. Now, for each of them, there is good explanation. Please go through it your own, because what happens is you need not know them fully with respect to case study, but you should know them, at least understand what to write there. There's no, it is very simple language. Please go through all of this. There's no value add from my side by explaining each of them, because all of them are simple statements. Don't buy anything that you don't understand. Complex things have complex problems. If you cannot model complex problems, please always try and work on simple problems, especially something that you don't understand. Do due diligence. If you make it as a profit center, then your treasury team will be doing trading. There may be huge losses, right? Like that, for each of them there is good explanation. Please go through that. So this concludes the derivatives chapter. We have discussed futures, we have discussed options, we have discussed new theory that has been added. So I strongly suggest that this particular chapter theory is very important for you from exam perspective, especially for the upcoming few attempts, because this has been added in the new syllabus and they would want to test you. Okay, so this concludes this particular topic. I suggest that you follow our channel, like this video, subscribe, refer it to your friends, share it with your friends and all of that. The reason being, we are going to be launching more such videos where you will be able to revise varieties of topics or all the topics that are there in CA Final AFM syllabus. So do stay tuned, and all the very best.